All right, guys. Hi. I know you guys have been waiting for the revision session. So we are going in the order. So first we started with Ind AS 21. Now we're going to go for Ind AS 115. That is going to be this video. After that, we're going to go for 2. After that, it's going to be 36, followed by income taxes 101, 103, 110, and 116. And certain students, they've also mentioned like 19 as well. Then probably I'll be going with that as well. But anyways, we're going to go in this order only. And now this is going to be the intro for Ind AS 115 revision. Now trust me guys, this is very important. Don't skip this. Okay. Now I personally feel this is one of the best revision sessions that you will ever see on Ind AS 115. Yes, the session is going to be nearly around 3.5 hours. But let me tell you guys, every single concept, let's say 90 to 95% is covered in this particular session. Now, concepts are covered and problems are covered indirectly in the form of examples. Examples has been reverse engineered from the questions only. Okay. Still, if you feel like, sir, we need few more sums to be done when it comes to 115, I kindly request you guys to comment, because unless you comment, how would I know? So hardly it takes, we put in a lot of efforts to do all these videos, right? So my request from from my side is that just comment. For example, you need problems or any specific problem. For example, KK Limited is one of the difficult sums people say when it comes to what? Ind AS 115. For that, I've put a video. Why? Because certain students have specifically asked me that. Like that, if you guys want at least, okay, sir, just do some X number of sums so that it will be better for us to understand the concepts. Once the concepts are done in this particular video, along with examples, which are nothing but problems, okay, which are reverse engineered. If that is fine, it's okay. Otherwise, if you still want some, then that also you comment. If you want any other Ind AS to be covered, then that also you comment. You comment, I'll reply each and every single comment. I've been promising the same, and you can check all the last 7-8 videos. I've literally replied each and every comment. I'll take a note of it and then I'll come up with the solution. Got it? Anyway, till May, we're gonna do this journey. I hope you guys enjoy 115. Right, guys? Thank you. All right, guys. Hi. So welcome to PK Sir Classes. This is me, Prasanna Kumar, PK Sir over here. Now, this is a very important session, Anna. So we're gonna revise Ind AS 115, one of the most important Ind AS in your syllabus as well as lengthiest. Some people even feel that it is the most difficult Ind AS. Now, difficulty, it is a perspective thing. People who are not really comfortable with theory dominated Ind AS, obviously they'll find this very difficult. Anyways, for others, it's a kind of decent standard. Now, what we're gonna do in this particular session is absolutely we're gonna go with a fast-paced revision. So this is a revision session, Anna. So usually when I go with regular classes or exam oriented sessions, I'll be going with a lot of logics. Now here, I will not have that much of time to cover logics because our intention is to revise the concepts as early as possible. Okay, you got it? Right. Having said that, let's start with the standard. So what do we have? Revenue from contracts with customers. So basically it's a revenue standard. So this standard tells you when to recognize the revenue. It's as simple as that. So you get money from the customer. Just because you got money from the customer for the good that you have sold or the service that you have provided, immediately you can't recognize the revenue. So Ind AS 115 says, just wait, I'll tell you when to recognize revenue, how much to recognize revenue, everything. So two questions will be answered by Ind AS 115 predominantly. One, when to recognize the revenue. Should you recognize today or after 6 months or after 1 year or on an average over the year or at a point of time? At the same time, how much you should recognize, that also Ind AS 115 will say. To put it very simple, this is all the standard is all about. Okay. Now, if you look at the scope of the standard, obviously it will not apply to leases, Ind AS 116, insurance contract 104, financial instruments, and non-monetary exchanges between entities in the same business. This is one point that you need to focus. Rest of the things is very easy to remember. 116, this will not apply. 104, it will not apply. 109, it will not apply. So pretty easy to remember. This is not that important. So let's get into the core principle of Ind AS 115. Now, if you look at this, I've highlighted revenue should reflect the transfer of control of goods or services to the customer. That is the core idea of this particular standard 115. Sir, what do you mean by this, sir? Very simple, Anna. There is something called Holy Trinity, which I usually call. You're going to learn something called performance obligation very sooner. And that performance obligation, as of now, you don't know what is performance obligation. Just remember, okay, performance obligations, based on this, we will go for something called transfer of control. And based on that, revenue recognition will happen. So there are three keywords that you have to remember throughout this standard. Performance obligation, transfer of control of goods or services, revenue recognition. There ends the matter. Just remember this. When time comes, I'll ask you to sync it. You'll automatically sync. Anyways, See, the core idea of this particular standard is that usually what we feel, because we are done with contract acts and so many other, where always the focus on these two words. When there is a transfer of risk and rewards, you generally recognize revenue. This is what we have seen it in so many other cases, right? But that is not the case when it comes to Ind AS 115. Ind AS 115 takes a totally different approach. It tells you, forget about risk and rewards, okay? Because that's your usual thought process. Come to something different. What is that? Focus on transfer of control. You see the situation, you analyze the situation of the transaction happening between the customer and the entity. You focus on the area of control, when the control is getting transferred. Whether you are providing good or you are providing service, that doesn't matter. When the control is getting transferred. These are all the keywords, Nana. This you have to repeat it as it in the examination to get the marks eventually. Okay. So transfer of control of goods or services, based on that only we'll be recognizing the revenue. Not based on risk transferred, not based on reward transferred. Usually we got used to listening these words, risk and reward, risk and reward, risk and reward. But that's not the case over here. Transfer of control of goods and services. So hence an entity should recognize in a manner that depicts the transfer of goods or services to the customer and the amount that reflects the consideration, means how much money you have got. That also Ind AS 115 will say. So two things are focusing over here. I mean, Ind AS 115 is focusing over here. One is transfer of control of goods and services. Other sorry. Transfer of goods or services to the customer. For example, today itself you are transferring a good. For example, this good is there. Today it is transferred. Today it is transferred now. So transfer of control has happened. Recognize the revenue. Okay. I am giving some service, like for example, subscription service for your internet. So how am I transferring the control of the service? This month something, next month, next month, next month, next month, like that over a period of time. Every month you will be receiving service now, which means as an entity I'll be giving you service. So in that case, over a period of 12 months, you need to recognize the revenue, because the transfer of control is happening over a period of time. You understand the point? Whereas for example, you're just buying this particular remote from me. I just give you this remote, you buy it. Transfer of control is happening at a point of time. Right now it's happening. Therefore, recognize the revenue. It's as simple as that. The other question is how much consideration. So for this transfer of revenue, transfer of control, when it is happening, how much money I'm getting, that will be recognized as revenue. This is the basic idea. Okay. So look at the simplified understanding. Revenue is not recognized when goods are produced or billed, but when the customer obtains control over these goods or services, meaning customer can direct their use and enjoy their benefits. So another point that you guys need to focus is, sir, you're using the word transfer of control, transfer of control. Okay, transfer of control means what? When can I say that a good or a service is transferred to the customer? Transfer of control has happened to the customer. Very simple. Look at the customer and see whether he is able to enjoy those services, if it is a service, or he is able to enjoy those goods. If he is able to do that, or he is able to control the use of those goods or services, or direct others how to use those goods or services. If any of these things are happening, it means that you need to understand that transfer of control did happen. Clear? So you have to look into the customer to understand whether transfer of control did happen or not. Clear? That's the basic idea. All right. Look at the example. You'll get better clarity. Suppose a car manufacturer sells a car to the dealer. Okay. They have signed the contract and all that. The moment they have signed the contract, can I say the transfer of control did happen? No. When the car is actually delivered and the dealer can sell it. It's not like he has sold it, but he's in a position to sell it, which means dealer is the customer over here. Can customer use the good? Yes. Only if he gets the good, then only he'll be in a position to use the good. In that case, transfer of control did happen. Okay. Merely signing a sales contract or receiving an advance does not mean revenue recognition. Transfer of control should happen. Transfer of control should happen means what? You look at the customer, you see whether he's able to enjoy the services or he's able to direct the use of the good. In this case, he's able to direct the use of the car which he has got from the company as a dealer. What do you mean by directing the use? He's able to sell it. That's his wish. So if he's able to do that, then transfer of control did happen. Then you start recognizing the revenue. Not with respect to transfer of risk and rewards and all those things. Forget about those terms. So this is the first basic thing that you need to get into your mind. Is this clear? Right. Now, before we get into the core of this particular standard, let's get the basic idea of the standard. Alright, Nana. See here, Jio is providing broadband services. Okay. On day one itself, they are charging 12,000 for the entire year. Jio is taking that much of money, which means as a customer, you are paying in advance. Now for this, Jio is providing 1 year of internet service, as well as he is also providing router as free. Okay. But if you look at the standalone selling price, which means if you want to buy internet subscription for 1 year separately, it will cost you 18,000. If you want to buy router separately, it will cost you 6,000. That's what we call standalone selling price. But whereas here, you're getting it put together for 12,000. You got the point. In that case, what Ind AS says is that you do one thing. Allocate this 12,000 which you have received from the customer in the ratio of standalone selling price, that is individual selling price. Okay, if you allocate that in the ratio, you get 9,000 for internet, 3,000 for router. Now apply the logic which I have told you. Transfer of control. You guys remember here that we have discussed transfer of control. Now in case of internet, transfer of control, when it is happening over a period of time, because it's a service. Now first month some service is done, so transfer of control happens next month, next month, next month, next month, like that it will happen over a period of 12 months. Whereas when it comes to router, it happens now itself at a point of time. Immediately router is given and then the job is done. So therefore, with respect to router, transfer of control already happened. So which means you can recognize revenue, which means 3,000 I can recognize today itself. Whereas 9,000 I need to recognize over a period of 12 months, which means 9,000 divided by 12. But today ultimately you have received 12,000 from the customer. You got the point. So bank account debit 12,000. To revenue, can I write 12,000? No, you should not write 12,000. Why? Because check the transfer of control. Okay, transfer of control with respect to router, it did happen. It went to the hands of what? The customer. So therefore, with respect to 3,000, recognize the revenue today. With respect to 9,000, you have to recognize over a period of 12 months. So therefore, today I'll recognize that as advance revenue divided by 12. Every month, that much I'll recognize, because that much every month transfer of control happens. So look at this entry. Bank account debit, you received 12,000 from the customer. Advance to revenue 3,000, because for this transfer of control did happen at a point of time. And with respect to this 9,000, transfer of control yet to happen. It happens over a period of time for the entire 12 months. Therefore, find out how much is per month. 750 at the beginning on day 1. Still service for internet did not start. Therefore, transfer of control of service did not happen. Therefore, entire 9,000 will be treated as advance revenue. 1 month gone. Now for 1 month you provided service, 1 month transfer of control did happen. To that extent of 1 month you can recognize 750. So advance revenue will be debited, revenue will be recognized. Same entry will repeat for a period of 12 months. Now 1 month is done, for another 11 months it will repeat. Clear? Did you get clarity? Now this is just a rough idea. We did not get into all those 5 steps and stuff like that right now, just to give you a basic idea. So the problem with this standard is, without examples, you will not understand this standard, or it will be very difficult to understand. That's why we have to go with examples. If you just read English sentences, this standard is very difficult to understand. Okay, and it is revision session, so I have to maintain some pace so that we can cover more in less number of hours, so that it will be helpful for you when revising the day before the exam. Anyways, now come to the core of the standard. The core of the standard is revenue recognition, when to recognize the revenue. As of now, we have just learned 2 basic things. You need to focus on transfer of control. Correct? If transfer of control did happen, accordingly you need to recognize the revenue. That's what we have learned so far, nothing else. Do not focus on risk and rewards. Right? Now coming on to 5-step model, we have got 5 steps. Once step 5 is finished, then we will know when to recognize the revenue, how much to recognize the revenue as well. So what are those 5 steps? Identify the contract with customer, identify performance obligation, determine the transaction price, allocate the transaction price to the performance obligation, recognize revenue as and when the entity satisfies the PO. It's very easy to remember. Otherwise, if you want mnemonics, you can just follow this: CPTAR, contract, performance, transaction, allocation, recognition. Although I don't recommend this, just remember, it's pretty easy. First, you need to identify whether there is a contract with the customer or not. Okay, there is a valid contract between customer and the entity. Okay, now find out how many promises each has made to each other. This guy will promise something. Entity will promise that I'll give you this, I'll give you this. Customer also will promise that I'll give you this much money, that, this and all. So identify the promises, which is nothing but we call it as performance obligations. Okay. Generally, we'll see it from entity's behalf, not on the behalf of the customer. Why? Because we are the entity. Entity only will do revenue recognition. So you need to think from the point of view of what? Entity, not from the point of view of the customer. It's as simple as that. Third point is, okay, now you have identified the performance obligation. Now find out the transaction price, which is actually the most difficult step out of these 5 steps. And it will take a lot of time as well when we revise as well. Which one? Step number 3. So out of all the 5 steps, step number 3 is the most important as well as complicated step. That is determining the transaction price. Transaction price is nothing but the consideration that you receive from the customer as an entity. Okay. Now in that there are so many variabilities. Fixed consideration will be there, variable consideration will be there, uncertainty will be there. Sometimes customer will give something to the entity. That there's a lot of complications are there. Out of all these complications, we need to work together, and then eventually we need to find the transaction price. Now step 4 is very easy, matching these two, step 2 and step 3. Sir, what do you mean by matching step 2 and step 3? In step 2, you have got promises performance obligations. In step 3, you have got wholesale transaction price. Now, multiple POs will be there in step 2, and this transaction price must be allocated to each PO. That's what you do in step 4. And now once you know, for this PO, this much is transaction price. For this PO, this much is transaction price. For this PO, this much is transaction price. You wait for the PO to happen. PO did happen, recognize the transaction price as revenue. Another PO did happen, how much transaction price already you have calculated in step 4, that much you recognize as revenue. Another PO did happen, finished, recognize the revenue. Here you can ask me, sir, just now you have told that transfer of control should be the base for me to recognize the revenue. That's where the Holy Trinity comes into picture. The moment PO is satisfied, it means that transfer of control did happen. Therefore, revenue should be recognized. Are you able to understand? This is where many students gets confused. So again, I repeat, just now you have told, sir, that transfer of control did happen, then you have to recognize the revenue. Now you are talking about linking PO with transfer price, with transaction price. The point is, once you are done with PO, which means once a performance obligation is satisfied, automatically transfer of control did happen, which means revenue will be recognized. So the first step is performance obligation getting satisfied. If this is satisfied, then transfer of control did happen. If this happened, then revenue has to be recognized, which we'll be doing in step 5. So basically, just first 3 steps you need to remember. Step 4 is a link between step 2 and step 3. Step 5 is waiting for performance obligation to happen and then start recognizing the revenue, which you have already calculated in step 4. So basically 3 steps only. So now it's very easy to remember once you know the flow. Now tell me, is there a contract between the customer and the entity? Right. Then identify the promises. Okay. Identify the transaction price. Okay. Match the number of promises with the transaction price. For this promise, this transaction price. For this promise, this much transaction price. And then you wait for the promises to do happen. And then once the promise is done, performance obligation is done, transfer of control did happen, recognize the revenue. 5 steps are done. Clear? Everybody? Now I have a complete picture. Now let's go one by one. So we'll start with step 1. Remember, out of all these 5 steps, the most difficult, most time taking and most important is step 3. What is that? Determining the transaction price. Accordingly, we'll focus more time on that. Remaining or relatively easier to understand. Anyways, let's start with step 1. Least important is step 1 only. Least important is step 1. Chalo. Alright, Anna. Let's focus on this. So first of all, there should be a valid contract between the customer and the entity. This is the least important step. So we'll just go with one example. Okay. Totally, we need to have 5 conditions that need to be satisfied to satisfy step 1. Okay. Approval and commitment must be there between the entity and the customer. Identifiable rights should be there in that particular contract, which means what the customer will receive from the entity, what the entity will deliver. That must be clean. Then you have identifiable payment terms. How are you going to pay? When are you going to pay? On what mode you are going to pay? All those things. Commercial substance. Commercial substance means whatever the kind of consideration that the entity gets, it should be so significant that it should be in a position to affect significantly the cash flow of the entity. If it does, we can say that there is a commercial substance. And finally, the most important condition upon which you will have problems is probability of collection. This is very, very, very important. I've marked over here, which means you will recognize the revenue. Of course, for that 4 more steps are there, but step 1 is important. You will recognize revenue only when there is probability of collection, which means you look at the customer, because revenue recognition will be doing from entity's point of view, right? In entity's books. So entity should look at the customer and see whether he has got the intent as well as ability to pay. Both conditions must be satisfied. If any of this condition is not satisfied, then this condition is not satisfied, which means there is no valid contract between the customer and the entity, which means there is no question of revenue recognition. Based on this, questions are there, so keep this in mind. Are we done with this? Immediately, let's get on with an example and we'll cover all the 5 points. 5 conditions in step 1. 5 conditions in step 1. See here. A car subscription between Zoom Auto and customer for 12 months. You know what is Zoom, right? Right now it is not famous, but once upon a time it was. Customer pays 20,000 per month for the car that he takes on rent from the Zoom. Zoom Auto provides car. Zoom provides insurance as well for the car. Maintenance services also is provided by Zoom. Agreeable contract is there. They have signed the contract digitally. Customer must pay 3 months penalty if cancelling early, because this is for 12 months. And full KYC verification is done. Collection is also probable. So now we need to check in this example whether all the 5 conditions are satisfied. Condition number 1, approval and commitment between 2 parties. So is that condition satisfied? Yes, because there is a digital signature which these guys have signed, and payment mode is also confirmed. Got the point? So this much and all those things. So you have approval right? And commitment. Second point, rights of each party has to be identified. Did they identify? Yes. Zoom Auto has got right to collect 20,000 per month, and customer has got right to use the car as well as insurance service from Zoom Auto as well as maintenance service from Zoom Auto. That is also clear. Okay. Third condition, payment terms identified. Yes. Auto debit will happen every month from the account of the customer for 20,000. Okay. Commercial substance is there. Yes. Entity is giving car to the customer and customer is actually paying solid money of 20,000 per month, which will change the cash flow significantly of the company. You understand the point? So there is commercial substance. Probability of collection. Yes. Auto debit is there. Credit score is checked. So it is sure that customer will pay. Anyway, that condition is already given in the question. Na? Collection is probable. So therefore, there is probability. Security deposit also usually they'll take. In case if some dent or something is happening, they'll cut that money and the balance will be paid. So all the 5 conditions has to be satisfied. So to put it very simple, if these 5 conditions are satisfied, step 1 is satisfied. That's all. Got it? Chalo. Approval and commitment, identifiable rights, identifiable payment terms, commercial substance, probability of collection, most important of the 5 conditions. Chalo. Few more examples I've given. You can just go through this. And one more point I forgot to tell you, that is you can check this website caprasannakumar.com and free downloads column. From that you guys can download this particular material. Okay. Chalo. So I hope that doubt is also clear. I should have told it at the beginning. It's okay. Now, another special case is when step 1 fails but the money is received. What do you mean by this, sir? It's a special scenario. See, sometimes what happens is that step 1, there are 5 conditions. Na? Any of those conditions will not be met. For example, even probability of condition will not be met. In that case, your step 1 fails, which means there is no valid contract between the customer and the entity. In that scenario, what will happen? Well, sometimes what happens is you cannot recognize revenue, but whatever the money that you received from the customer should be shown as deposit liability. Sir, what do you mean by that, sir? Let us look at the example. A customer pays 10,000 as booking advance for a service. Okay, sir. But later cancels it before the contract is finalized. So contract itself is not finalized, but cancellation has been done. So since the contract did not meet all the conditions, because there is no valid contract between the customer and the entity, step 1 is not satisfied. But you have received 10,000. Now this 10,000, how should I treat? Should I treat it as a revenue or should I treat it as a liability? That depends upon whether you have an obligation to pay that money back to the customer. Now, if the amount is non-refundable, which means you don't have obligation to pay that money back to the customer, then you will treat it as a revenue. But if you have an obligation to pay that money back to the customer, then treat it as a liability. Simple. Because you have an obligation to pay it back to the customer means liability only. Na? Simple logic. It becomes revenue only when the entity keeps the money. When you will keep the money, when it is non-refundable, when it is refundable, you have to pay. In that case, it becomes a contract liability. Simple. So say for example, day 1, what will be the entry? Very simple. You have received 10,000. As of now, you are not sure because the contract is not yet cancelled and the non-refundable class is there or not, all those things. So bank account, you will debit to deposit liability advance. Say for example, for real estate flat, you have taken money. Okay. Later customer says that no, I'm not interested to buy this particular flat. Whatever the token advance that you have taken, you can just keep it with you, because usually that will be the condition. They'll not pay it back. Why? Because when I've taken token advance from you as a real estate guy, I'll not show the property to somebody else. Na? So therefore, I'm losing an opportunity over there. So therefore, generally the deposit money will be kept with themselves. Once that confirmation is given by the customer that he is no more interested, then you convert this deposit liability into revenue. So therefore, deposit liability will be debited to revenue. Okay. The funny thing is, here you are doing revenue recognition without satisfying the further 4 steps, as well as in first step also 5 conditions are not yet satisfied. That is why we call this as a special case. So special case of deposit liability, where without satisfying any conditions, because of the uniqueness of the scenario, you will be recognizing your revenue. However, to recognize the revenue, this condition should be happening. What is that? Non-refundable condition. And the customer must cancel the contract and non-refundable clause must be there. In that case, you can recognize. Got it? Otherwise, you'll pay the money back. That's all. Initially, you'll recognize a deposit liability. If it is refundable, debit deposit liability to bank. That's all. You'll pay the money back to the customer. As simple as it. Are we done with this? Moving on. Next one is contract term. So what is the only point that you need to remember in contract term? Generally, the term of the contract is whatever you write in the agreement. In agreement, if there are 12 months, you feel that 12 months is the contract term. That is where you are wrong. No. For example, a gymnasium enters into a contract with a new member to provide gym access for 12 months. Okay. At 4,500 per month. All right. Which means contract term accordingly has to be there for 12 months. Now, wrong, because the member has right to cancel without penalty after 3 months, which means till 3 months, he won't cancel. That's what you get from the contractual terms, right? So which means 3 months is the contract term, because there is high probability that after 3 months he can cancel. If he cancels, then there is no contract for the next 9 months now. So how can you treat the contract term as 12 months when there is a probability of cancellation after 3 months? You get the point. So therefore here the contract term is only 3 months, because after that neither party has enforceable right. The customer can cancel without penalty. So this is one new point that you need to learn. All right. Moving on to next one. What is the next one? We have combining contracts. Combining contracts. Now, sir, what do you mean by combining contracts, sir? Sometimes 2 or more contracts are signed together with the same customer around the same time, and it must be treated as a single contract. So 2 or 3 separate contracts with the same customer pretty much around same point of time has to be treated as a single contract. How? Why? Very simple. First we'll go with the exam and then we'll come back to the conditions. Okay, chalo. Let's go with the example now. Now see here. Look at this, Nana. Infosys signs contract 1 ERP implementation for 80 lakhs. At the same time, it also signs employee training, because for implementing ERP, that particular thing has to sign, and employee training also 20 lakhs. Signed on the same day, negotiated in a single meeting, discount offered only because both the contracts were signed together. So you can easily find a link between both the contracts, correct? So therefore, even though there are 2 legal documents, commercial reality is that it is one single package. And as a result, combine the contracts, which means both these will be treated as one single contract for 1 CR, negotiated as a single package. One more example you will see. A builder signs with a customer, flat sale 70 lakhs, car parking also he sells for 5 lakhs, but they are entering into 2 separate contracts. But the point is, both of them are negotiated together with the same customer around same point of time. If the flat is cancelled, what will happen? Automatically car parking also will be cancelled, right? What he will do without the flat, the car parking in a residential building? Doesn't make any sense. So parking price also depends upon the flat purchase, right? Analysis, car parking consideration depends upon the flat contract. So as per Ind AS 115, both contracts must be combined into a single contract of how much? 70 plus 5, 75 lakhs. Consideration depends on the other contract, that is the condition, which means now you have seen 2 examples. Now let's come here. If any one of the following conditions exist, then you will be combining the individual contracts entered with the same customer at a single point of time, or at pretty much the same point of time. What is that? They are negotiated as a single package. ERP example. The consideration is one contract depends upon the price or performance of the other contract. Flat example, where depending upon how much you negotiate the flat price, parking contract, parking price will be there, which is nothing but we call it as amenities, right? Here if you are negotiating a lot, here the price they will not negotiate, right? One price is dependent on the other, or sometimes if you are negotiating the flat price, he will say, sir, we'll reduce the price in amenities. So one is dependent on the other. Third condition, the goods or services promised in the contracts are a single performance obligation. If any of these 3 conditions are satisfied, then you will be combining the contracts. Clear? Right, just try to remember that ERP package where you have negotiated that as a single package, 2 separate contracts, and try to remember the builder and parking lot, that is flat sale as well as parking place sale, right? One is dependent on the other. And one more point you need to see, goods or services promised in the contracts or a single performance obligation. Clear? You can see one more example over here. A company sells machinery and also provides training on how to operate it. If both are negotiated together and training is essential for using the machine, they should be treated as a single contract. Simple. So either both are negotiated together or one is dependent on the other. Or goods or services provided in the contracts or single PO. Got it? Then you will combine the contracts. Now coming on to the most important part of step 1. What is that? Contract modification. Now, what is this contract modification? This is where you guys need to understand. If you look at the wording in your Ind AS 115, it is called a change. Modification is obviously change in the terms of the contract. What terms? Price can change. That is very easy, sir. Price changes means I can easily understand. Scope also can change, or both can change. Sir, price change means I know. What do you mean by scope change? Scope change means additional goods are added with the existing contract or additional services are added. Then the scope changes. Price changes means you can easily understand. Price will increase or price will decrease. That's all. If any of these 2 changes, either additional goods are added or additional services are added, or price has been increased or decreased, in either way, contract modification is happening. So, for a modification to exist, there is a change in scope, price, or both. And it is approved by both the parties, obviously. And it is legally enforceable. Now, the next question that you need to identify is, modification is happening, Once the modification has happened, hereafter should I treat this as a separate contract or should I modify the existing contract as well? That's the major doubt that you'll have, correct? That is what we are going to do. Now, for that, we have divided things into two scenarios. Sir, what are two scenarios? Modifications that will be treated as a separate contract and modifications that will not be treated as a separate contract. Under this, again, there are two scenarios. So basically, there are three scenarios, okay? But you remember this way. Modification that constitutes a separate contract as one scenario. Modification that does not constitute separate contract as another scenario. For this also, we have an example. For this also, we have an example. For this also, we have an example. Got it? We'll see one by one. So let's start with the first one. Here. Look at this scenario, Nana. PK Limited is a service provider, okay? And he's providing office repairing and painting services for 50 days at 1800 per day. SK Limited is the customer. Fine. Total transaction amount will be how much? 1800 per day into 50 days, 90,000. Done. After 30 days, which means 50 days did not happen completely. In the middle, one more contract is entered between the same two parties, but this is a totally different service. Factory repair and painting. Office repair and painting is separate. Factory repair and painting is separate. And for that, the arrangement is 70 days it will take to repair the factory. Probably it is bigger than office. And same price, 1800 per day. So what is that you need to analyze over here? There is no discount on standalone selling price. Standalone selling price is 1800 per day. The price is the same. Whereas the service that you are providing right now is a separate service, distinct service, new service. Therefore, treat it as a separate contract. If you can see here, a modification will be treated as a separate contract if both the conditions are satisfied. That we have already discussed. One is it has to be a distinct service. The other one is the price has to be SSP. Simple. Services that are distinct and the price has to be SSP. Then treat it as a separate contract. Based on this example, easy to understand. Now, moving on to next one. Modification that does not constitute a separate contract. What kind of scenarios? Under this, again, there are two scenarios. Let's try to understand. Look at this example. It is an extension of the earlier example that we have done. PK Limited, same. SK Limited, same. Office repair and painting, same. 50 days at 1800 per day, same. Total transaction price, same. Okay. After 30 days, same contract. Factory repair and painting, 70 days. This is where the change happens. Not 1800 per day, but 1500 per day. The service is new service, distinct. Yes, one condition is satisfied, but two conditions must be satisfied to treat it as separate contract. And both the conditions must be satisfied. So, distinct service condition is satisfied, but second condition is not satisfied. It is not SSP, it is at a discount because already you have done one contract. Now, the new contract is at a discount. So, at a discount, right? Sorry for that, discount. Okay. So, can I treat it as separate contract over here? No. You got the point? One thing is quite clear that you cannot treat it as separate contract because there is a discount. So, I should write here no SSP. All right. Now, what should be the accounting that you should do? The word that you need to remember is prospective accounting. Sir, what do you mean by prospective accounting, sir? Anyway, one thing is clear. We are not going to treat it as a separate contract. Okay, then what, sir? Very simple. First of all, see what you have done so far. How many days are passed? 30 days, sir. Okay. 30 days, how much you would have recognized? 1800 per day, sir. So, how much you would have already recognized? 54,000, sir. All right. What is pending with respect to old contract? Sir, in 50 days, 30 days is done, sir. 20 days is pending, sir. For that 20 days, how much is the commitment? 1800, sir. So 20 days into 1800, 36,000. Fine, sir. What about the new contract? Sir, 17 days into 1500 per day, sir. Add that. Sir, total revenue is 1,41,000, sir. If you add these two, which means whatever is pending in the old contract plus the new contract, total revenue is 1,41,000. And total number of days is 90,000. Okay, divide both of them. Okay, sir, divided. On an average, how much it comes? 1566 per day, sir. From today onwards, recognize 1566 per day. From today onwards, do not touch whatever that has happened. Already 30 days you have recognized 1800 per day, 54,000 you have done, that you do not touch. Today onwards, this will be your revised number. This much you recognize. This is what we call prospective accounting. Retrospective means we'll touch yesterday as well. Prospective means we'll forget about whatever that has happened and we'll think from today about tomorrow. That's all. Clear? Right. If you look at the concept over here, new goods or services are distinct. Yes, sir. Factory repair and painting is distinct. But price does not reflect SSP. Yes, sir. 1500 is not reflecting SSP, which is 1800. Terminate the old contract and create a new one. The remaining revenue is adjusted prospectively on future basis. So, old contract is gone. Now, whatever that is remaining with the old contract plus new contract has been combined together, and then 1,41,000 divided by 90 days, you have got 1566 per day. Today onwards, you will be recognizing this much, 1566 per day in this example. Got it? Okay. What about the other case? The other case is, look at this example. Same example, same office repair and painting, 40 days at 1500 per day. Okay. Total transaction price will be 60,000. All right. After 25 days, the customer is asking for additional 10 days for existing contract at 1200 per day. So because of the customer, additional 10 days of work is happening for the existing contract itself, which is at 1200 per day. So there is no new service. It is not factory repair or painting. It's the same office only and same work. And as a result, because there is no new service, okay, there is no question of treating it as a separate contract. It will be treated as existing contract as well. But how will you do the treatment? Because there is no distinct service as well, you will do retrospective accounting. Sir, what do you mean by retrospective accounting? Very simple. If PK Limited, that is the service provider, knew that customer would ask for this delay for another 10 days, which means totally now it is becoming 50 days. But right at the beginning, they know that it is only 40 days. Now, because of the customer's modification from customer's point of view, of course, PK Limited has agreed for the same. But now they know that in the middle of the contract, after 25 days, that the contract will take 50, not 40. But at the beginning, they thought that it is 40. Now, just imagine that at the beginning itself, if they know that it will be 50 days instead of 40, then what would have been the revenue recognition? Imagination. So if PK Limited knew about this delay on day one itself, then the revenue recognition will be what? Very simple. So it will be 1500 for 40 days and 1200 for 10 days. Total revenue will be 72,000 for 50 days. On an average, you would have recognized 1440 per day from day one, which means for first 25 days, you would have recognized 1440 into 25, which means 36,000. But right now, how much did you recognize? 1500 per day, which means 1500 in 25 days, how much you have already recognized? 37,500. How much you should have recognized had you know about this delay from the day one itself? 36,000. Therefore, how much excess you have recognized? 1500. That much you reduce now. Revenue to be reversed on modification date, which means you are going back and disturbing it from day one. This is what we call retrospective change. The retrospective application, or the technical word that your Ind AS 115 standard uses, is cumulative catch-up basis. So from 26th day, you will continue with 1440 because you are rectifying from day one. This we call it as cumulative catch-up basis or retrospective. Chalo, see here. Remaining goods or services are not distinct. It is same. So there is no new service and therefore treat it as a part of existing contract, but you have to adjust revenue on cumulative catch-up basis, which means from day one you have to revise everything, which we call it as retrospective change. Now some of the students might get doubt, sir, what do you mean by why would customer will ask for additional 10 days? Because customer asks for some change, some modification, some customization. In the middle he will ask, sir, why would this guy accept, sir? Because those are all part and parcel of the game, Nana. If I give you a real life example, you'll understand. Because it's a revision session, I don't have time to explain all these things in detail. But anyways, I'll give you an example. Otherwise, you'll buy heart. See here. L&T is building customization, Nana. Building hotel. They're trying to build the hotel. Customer is the one who is paying LLT. L&T, Larsen & Toubro, is building hotel building for the customer. Initially, they agreed at a particular design and all that. The work is going on. L&T is doing the construction. Suddenly, midway, customer will ask, okay, change the external design. I don't like this design. Do it like this. Change influences the whole construction work, obviously. But design change is not sold separately in the market. You can't do that. Highly integrated work, because design and the construction work are merged together, obviously. Based on design only, you will do construction. So therefore, new work cannot be separated from the old work. It is single PO. Modification affects the same PO. It will take extra time, extra days because of the design change asked by the customer in the middle. Therefore, adjust revenue cumulatively on catch-up basis, because there is no new service over here. Got it? You're doing the same building. And why would customer ask for additional days? Means for that I'm giving you a reason. This is what happens in reality. Clear? I hope this example is clear. Chalo. Are we done with this? So with this, we are done with step 1. Let's continue with step 2, guys. Now this is a relatively small step and easier step, Nana. The real challenge will be for us when we go to step 3. Step 3 will take a lot of time. Again, step 4 and step 5 are easier. Chalo. Identifying performance obligation. In other words, simply put, we have to identify how many promises are made. Okay. A performance obligation is a promise in a contract. Step 1 is nothing but contract na to transfer. To transfer what? A distinct good or service. Distinct is the keyword over here. Or a series of goods or services that are substantially the same, have the same pattern of transfer to the customer. Sir, what do you mean by that, sir? Subscription service. Now you take Netflix subscription. It is a series of services. Month 1 service, month 2, month 3, 4, 5, 6, 7, 8. A series of services which are actually the same, and the transfer of service is also the same, the pattern is also the same. In that case, you will not call month 1 Netflix subscription as separate PO, month 2 as separate PO, month 3 as separate PO. No, all the 12 months put together we call it as one single PO, because pretty much you are repeating the same stuff. Housekeeping services as well. So anything where a service is being provided in the same way every single month over a period of time, then that entire period will be called as one single PO, will be referred as one single PO. Got it? Chalo. In simple words, performance obligations are the deliverables under a contract. For example, in a contract to sell and install an air conditioner, how many POs are there? Very simple, sir. First you deliver the air conditioner, one PO. And after that you have to install that air conditioner, another PO. Simple. Two distinct services. Now one is a good, the other one is a service. So one is a distinct good, which is air conditioner. The other one is distinct service, which is installing that, right? So two promises. Got it? Another important thing is each may be a separate performance obligation if they can be sold separately as well. Will you be able to sell air conditioner without installation service? Yes, you can buy it from Amazon and you can get installation done from Urban Company, isn't it? Or you understand the point? You have already bought air conditioner from somewhere else and then you can buy installation service separately from Urban Company, which means both of them can be sold separately. Now that's the point over here. Or they can be sold put together as well. But if there is a possibility of selling it separately, then you can treat it as separate PO. That's what we are trying to say over here. Clear? So in other words, Nana, PO means either it has to be a distinct, the keyword distinct, good or service. Okay? Or a series of substantially similar kind of services. Clear? That's all. Okay, sir. Now, sir, what do you mean distinct good or service? Now, this is very important. This is the most important part of the step. So focus carefully. This is where many students get confused. Now, for a good or service to be distinct, it has to satisfy two tests. Okay. What is the first test? Can the customer benefit from that particular good or service on his own? Sir, what do you mean by on his own? You deliver a good to the customer. If he is able to use that particular good and get the benefit from that particular good, then it means he is enjoying it on its own. Or that particular good with readily available services, whatever the things that customer has got, is he able to enjoy? If these conditions are satisfied, it means customer can benefit from the good or service. Sir, what do you mean by this, sir? Right now, you will not get clarity, Nana. We'll see examples. Right now, just listen what the concept is. Then you'll be able to sync it with the example. Okay. So first thing is, can the customer benefit from the good or service on his own, or together with other readily available resources which is already there with the customer, or he can buy it from outside? Sir, what do you mean by this, sir? Wait. This is first condition. Second condition is the good or service separately identifiable? Means it should be capable of being distinct if it is distinct within the context of the contract. Sir, what do you mean by that? There is no meaning for that. The meaning is only negative. Sir, what do you mean by negative meaning? It is distinct if it is not integrated with other goods or services. It is not highly interdependent. It is not significantly modifying or customizing some other good or service. So this is an easiest way to understand, but the actual wording in your Ind AS 115 is this one. It is not distinct if it is integrated, highly interdependent, significantly modifies. So the point that you guys need to understand is that the definition is negative for the good or service to be distinct. So negative definitions, generally it is very difficult to understand. Therefore, I converted that into a positive definition. So what is that? The good or service is distinct if it should not be integrated with other goods or services. It is not interdependent. It is not significantly modifying or customizing the others. Sir, we are not able to understand this. Yeah, I know that. Let's get to the example. Now see here. Look at this example. I hope you guys are pretty much aware of Apple, MacBook, Apple Care, data migration. Of course, in India, we are not aware of data migration services. For example purpose, just try to understand. Okay. Customer is buying MacBook Pro. Okay, sir. We know what it is. Apple Care plus extended service. All right, sir. Data migration service where Apple shifts your data from old laptop to a new one. These three. Okay. Now, first question, what are we trying to do? We are trying to understand what are the distinct good or service in this particular transaction, in this particular contract. What is the first condition? Can the customer benefit independently, which means on his own, or that product with the customer is buying with readily available resources? For example, you buy Apple iPhone, Nana. There is no charger with that. So, can the customer enjoy that iPhone? Yes, he can enjoy, provided he can use this particular product with readily available resources with the customer, which is the charger as well as AirPods. You understand the point? Suppose if charger is not there, can you use this iPhone? No, it will go out of battery. Then what you will do? So in that case, it is not a distinct good or service. You understand the point? It satisfies the definition provided. Suppose it comes with lifetime battery, Nana. You need not charge. There is a technology, something like that. In that case, you buy an iPhone. Can you enjoy on its own? Yes. Then the first condition is satisfied. Then it is a distinct good. Or if first condition is not satisfied, let's take the current iPhone. Obviously, the battery will get drained. So which means after 1 or 2 days, you can't enjoy the product. Correct. Therefore, first condition is not satisfied. So can you enjoy the good on its own or in combination with something else that is readily available at your home, at your place, or at the place of the customer? Yes, I have a charger. You attach with that, you are able to use it. Charger is with you. You did not buy the charger. So having a charger with you, in combination with the charger, if you're able to use the iPhone, that makes iPhone a distinct good. You understand the point? So look at the definition over here. Can the customer benefit from the good or service? A good or service is capable of being distinct if the customer can benefit from it on its own. Suppose infinite time battery for Apple iPhone. That's what I'm saying. That is the answer example for first condition. Or, it is not and or. If this is not possible, like in our case, if the battery is getting drained out after 1 or 2 days, together with other readily available resources with the customer. Customer already has got battery. Now, if you say, sir, no, sir, customer does not have battery, then can I say it is not a distinct good? No. Can he buy that from outside? Separately battery? Yes, sir, he can order from Amazon. That is also covered. Something that the customer already has or can easily get from other suppliers. Okay, sir, imaginary situation, sir. Customer is buying Apple iPhone with limited battery. Obviously, the battery will drain out after 1 day. And he does not have a charger. Apple also does not provide. And it is a very unique charger. Let's imagine. And it is not available to buy separately from outside as well. In that case, this is not a distinct good or service because you can't use it. You understand the point? Right. Now, other condition we have already seen. It is distinct if not 3 conditions are there. We'll see that. Now, let's come back to the example. So, MacBook Pro, Apple Care plus extended service, data migration service. Now, see here. Can customer benefit independently? This is the first question on its own. Yes, MacBook gives benefit by itself. You can use it. Of course, it also comes with the charger. So, that point is not there. Apple Care is optional. Customer can buy it later. Of course, it can be sold separately as well. Data migration is optional. Many third-party vendors do it. So, you can buy it from outside guys as well, which means step 1 is satisfied for all 3. You can enjoy it on your own and you can also buy it from outside. You understand the point? So, therefore, the first condition is satisfied. If first condition is satisfied, that does not mean that the good or service is distinct. Second condition also need to be satisfied. What is second condition? Are they not integrated, not interdependent? Tell me one thing. Selling MacBook is not dependent on selling Apple Care. Why? Because you can just buy MacBook and you can go. Most of the people do that only. They don't buy Apple Care along with that. So therefore, one is not dependent on the other. Okay. So which means it is not dependent. That condition is satisfied. Apple Care does not modify MacBook. Is there one good or service significantly modifying the other? No. So that condition is also satisfied. Data migration does not affect performance of the MacBook. It is just an add-on service. So one is not interdependent on the other. One is not significantly modifying the other. One is not integrated with the other. So which means all these 3 conditions are satisfied. It is not integrated. It is not highly interdependent. It is not significantly modifying. And as a result, first condition is satisfied. Second condition is also satisfied, which is a negative condition. Thereby the result, there are 3 POs. MacBook, Apple Care, data migration service. Got it? I hope this is clear. Let's move on. Okay. I gave some examples as well here. You can just go through it. Already I've covered an example. Chalo, now. This already I've explained. It is possible that there are multiple goods or services. Still, it may be considered as a single PO since these are interrelated or dependent on each other. For example, look at this. laptop plus charger plus carry bag. You cannot carry a laptop which is heavy on its own, so it is dependent on charger. Are you able to understand? It is also dependent on carry bag. So therefore, there is an intention to sell all these two together. So all these three put together, we'll call it as one PO. We'll not call laptop as one PO. We'll not call charger as one PO. We'll not call carry bag as one PO. No, because they are interdependent, which means not interdependent is not getting satisfied because they are interdependent. When it is not satisfied, this is not satisfied. When this is not satisfied, 1 plus 2 is not satisfied. When they are not satisfied, you cannot call them as distinct service or distinct good. When you can't call them as distinct good or service, multiple POs are not possible. All these three put together, we call it a single PO. Got it? Now, finally, the understanding is, are there multiple promises of goods or services which are distinct? Yes, sir. Then each and every distinct good or service will be referred as one single PO. That's what you need to learn. Sir, no, sir. Multiple promises or multiple goods or service which are distinct or not there, then all of them put together will be considered as one single PO. Clear? I'll give you one more example. See here. Suppose you are taking CA final coaching. What you will do usually? FR you'll buy it from somewhere else. AFM you'll buy it from somewhere else. Audit you'll buy it from somewhere else, right? There is no rule that you have to buy all the three put together for group 1, correct? Which means this is a single PO, this is a single PO, this is a single PO. One is not dependent on the other, correct? However, when it comes to CA foundation, that's not the case. Usually people buy all subjects in one single go. In fact, single subjects are not at all offered. When they are not at all offered, you have to buy it as a group. Then can I say all the 4 subjects, say for example in CA foundation, accounts as one single PO, law as one single PO, maths as one single PO. Can I say like that, economics as one single PO? No, because all those 4 being put together, it is sold. There is no option of getting them independently. You understand the point? In that case, everything put together, it's a single PO. For example, one more example I give you. Once upon a time when I was studying in Chennai, there used to be a costing class that we need to go and attend in a particular institution. There, if you want to buy costing class, you cannot buy costing independently. It has to be taken along with one more subject. Which other subject you can choose, but 2 subjects must be taken put together if you want costing. If you want tax, you can buy tax alone. If you want audit, you can buy audit alone. You understand the point? But costing, if you want, it has to be in a combination. Now tell me, in that case, can I call costing as something, a separate PO? No, here a combination only you have to take and call it as a single PO. You got the point? Yes. Chalo. I hope this is clear. Chalo, look at the series of goods and services, that is Netflix subscription. We have already seen that. Sometimes instead of one product, an entity provides a series of similar goods or services. Netflix is a service repeatedly over a period of time, that is 12 months, all of which follow the same pattern of delivery and transfer of control. Ind AS 115 says that entire series for 12 months, say for example in our case of Netflix subscription, will be treated as one single PO. This avoids unnecessary splitting of identical deliverables and simplifies the accounting, obviously. Lots of examples are there. Subscriptions, housekeeping, cleaning services, electricity supply, newspaper services, and all those things. Okay, in all these cases, each day's or month service is similar and transferred in the same pattern. Therefore, all put together for the entire year, we call it as one single PO. Every day you will not call it as a separate PO. It doesn't make any sense. Got the point? Yes. Chalo, with this we are done with step 2. So the summary of step 2 is very simple. Identify whether it is a distinct good or service. How to identify? Check whether customer can benefit with the product, if it is a good or service on its own, or that product or service, that good or service in combination with something that is available with the customer, or customer can buy it from outside and then with combination he can use it. This is the first condition. Plus, that particular good or service are not interdependent. They are not dependent on something else. They are not integrated with something else, which something else means some other good or services. They are not significantly modifying something else as well. In that case, both the conditions are satisfied. Then finally, you can call that particular good or service as a distinct good or service. Now, what is the use of identifying a distinct good or service? Once it satisfies these 2 conditions and you can call it as a distinct good or service, that transforms into one single PO. Got it? If it does not satisfy the distinct good or service, then all the goods or services put together will be called as a one single PO. Otherwise, each and every good or service, if the conditions, both the conditions are satisfied, will be called as a single PO. In that case, you will have multiple POs. You will have multiple POs. What is the importance of multiple POs? Because next step is transaction price, and each transaction price will be correlated with a single PO. Thereby, if one PO is satisfied, immediately to that extent, whatever the transaction price that you have allocated, that much revenue will be recognized. That is why this is important. Are you able to get me? Chalo. I hope we are done with step 2 as well. Now come to step 3, Nana, determining the transaction price. Let's continue with step 3, determining the transaction price. Now, Nana, this is the most important step and lengthiest of all the steps, all the 5 steps, as well as this is the toughest. Okay. So therefore, we will spend good amount of time on this particular step because there are a lot of points and concepts to be covered. Step 4 and step 5 will not take much of a time once we are done with this. This is the important. In fact, out of all the 5 steps, this is the most important. The least important is step 1 that I've told you, except for that one point. In step 1, there are 5 conditions now for determining a proper contract between the customer and the entity. The last condition is very important, where the payment should be highly probable. That you should have high probability of receiving the payment from the customer, which means customer must have the intention as well as the ability to pay. Keep this in mind. There are so many questions based on that particular concept. That's why I was stressing. Other than that, all other points are not at all important in step 1. Okay. Whereas when it comes to step 3, there are a lot of points which are repeatedly asked in multiple questions, like 10 questions, 15 questions, same concept. Okay. So when I'm going with the revision sessions, I'll highlight those points and then I'll go such that it will be totally exam focused and exam oriented for you, right? Chalo. Once performance obligations are identified in step 2, which we have already done, the next task is to find out how much revenue or consideration or transaction price the entity expects to receive for fulfilling those obligations. What obligations? Performance obligations in step 2. Okay. So here you can say in general terms, revenue is nothing but transaction price is nothing but consideration. Although little bit of technical differences are there, but in general parlance, we'll use them, like similar things like inventory, stock. Although inventory and stock are not exactly the same words with same meaning, there is a subtle difference, but still we use it in common parlance. Chalta hai. So same way, transaction price, revenue or consideration is nothing but the same. So we as an entity, we do some performance obligations. Okay, deliver some service or deliver some goods to the customer. In return, customer what pays us? I mean, customer pays us how much? That is nothing but you can call it as consideration or transaction price or revenue. Anyways, the transaction price is the amount of consideration, that is payment, that the entity expects to be entitled to receive in exchange for transferring the control of promised goods or services to the customer. Why has used the word expects? Because there are two types of consideration. One is fixed, the other one is variable. Variable is always, there is a question mark. So you expect this much to be received. Fixed consideration, there will be no doubt. That's why I've written here pakka. You'll get it for sure. There is no uncertainty. But when it comes to variable consideration, it is there. That's why we have used this particular word. Okay. One important point is very simple. If entity collects any amount on behalf of third parties, it does not belong to the entity. For example, even when we try to, sell our courses, right? If you buy FR, obviously it will be inclusive of GST, right? So that GST directly goes to the government, obviously. So can I say that that's the revenue for me? That's obvious. It's not. So anything that you collect on behalf of the third parties like GST, sales tax and excise duty must be removed. Very simple. If your invoice is 1,18,000, your actual revenue or transaction price is 1 lakh. Got it? So let's call this as transaction price or consideration. Okay, we'll call it as revenue after step 5. Okay, for our own comfort. So right now, let's call it as transaction price or consideration. So how many types of transaction price or consideration are there? Very simple, two types: fixed, variable. What is fixed? It is a fixed amount that is mentioned in the contract between the customer and the entity in step 1. And that too, customer will pay it without any condition. So you as an entity receiving that is pakka, right? It always included in the transaction price because there is no uncertainty. Got it? For example, a consulting firm agrees to provide services for 10 lakh fixed fee. Transaction price is 10 lakh because you will get it for sure. Sir, then what do you mean by variable consideration? Sir, there is always a question mark. Sir, what do you mean by that, sir? Because variable consideration depends upon future events or performance outcomes. Sir, what do you mean by that, sir? For example, performance bonus is a variable consideration. So if you perform, you'll get it. If you don't perform, you'll not get it. You understand the point? For example, I gave you a construction contract, Nana. You said that you'll be taking 2 years time to complete it. I said, if you can finish it off in 1.5 years, that is 1 year, 6 months, then I'll give you 20% bonus. Now, whatever that I've promised normally, let's say I promise that I'll be paying you 10 lakhs, no matter what, once you do the construction, irrespective of the time that you take to complete it. Okay. That 10 lakhs is nothing but fixed consideration. But when it comes to this 20% bonus, I gave you a condition. a future condition. If you can finish it off within 1.5 years, then I'll give you 20%. Otherwise, I'll not give you. So therefore, variable consideration always depends upon future events or performance outcomes. In this case, if you're able to finish it off within 1.5 years, then I'll give you that 20%. That 20% accounts under variable consideration. Clear? Penalties also. Suppose your normal timeline is 2 years. Same example we'll take. If it goes beyond 2 years, if you delay the project, then I'll penalize you. In that case, your consideration gets reduced. That's what I've written here. Reduction in fee. Discounts, rebates, refunds, everything is dependent on sales volume. All these put together, we call it as variable consideration. Now, what is the treatment when it comes to variable consideration? Sir, fixed consideration though very easy. Always you'll be including that in the transaction price without any question mark. Whereas when it comes to variable consideration, will you be doing the same thing? The answer is no. The entity must estimate how much variable consideration it expects to receive. So you do the estimation, based on that you recognize the variable consideration. Recognizing means that will be added to the transaction price. That will be added to the transaction price. So when you try to solve any question, the moment you see fixed consideration, obviously it will form part of transaction price. But when you see variable consideration, you need to think, you need to see how much the entity is estimating. Accordingly, some portion of it will be included in the transaction price. Clear? Okay. Look at the example. A consulting firm will receive 1 crore fixed plus 10 lakh bonus if it completes the work within 6 months. So 1 crore is fixed. That will be included in transaction price no matter what. 10 lakhs will be included if the company estimates that it will be able to finish off the work in 6 months. Otherwise, it will not be included. Got it? See here. If based on experience, the company expects a 60% chance of achieving this. Achieving what? Completing the work within 6 months. It estimates that variable consideration accordingly, which means it will be including that. Depend upon the method. Depends upon the method. Sir, what do you mean by that, sir? See, we have two methods for estimating variable consideration. What are those methods? Expected value method, most likely method. Sir, what do you mean by expected value method? What do you mean by most likely method? Very easy, Nana. You look at the possibilities in future. Sir, multiple possibilities are possible. Then you will choose expected value method. Sir, only two are possible. Either you will get it or you don't get it. In that case, you will be going for most likely method. Sir, can you explain it in detail? Yes, we'll go with an example. Look at this example. PK Limited enters into a contract with SK Limited for supply of a product in 6 months time. Okay, the fixed consideration is 6 lakhs. ये तो clear है. So 6 lakhs will obviously be included in what? The transaction price. 6 lakhs is by default included. Okay. Now look at the variable portion. A bonus is also payable for early delivery of the product. Okay. The amount of bonus and probability percentages are as follows. You've got how many possibilities here? See, 1, 2, 3, 4, 5. 5 possibilities means can I go for most likely method? No, here only 2 possibilities need to be there. Then automatically it will be expected value method. The expected value method is very easy. You just take each and every possibility, you multiply with the respective probability, you will be getting expected value. Which means your bonus will be 1 lakh if delivered within 3 months, 75,000 if delivered between 3 to 4, 60,000 4 to 5, 40,000 5 to 6, nil after 6 months. So simple, 1 lakh into 30% plus 75,000 into 25% plus 60,000 into 20% plus 40,000 into 15% plus 0 into 10%. That's what we have done here. And you got 66,750 expected value. Add that, fixed plus variable is your total transaction price. That's all, simple. Okay. Sir, what about this most likely amount? Sir, very simple. Look at this example. The amount of bonus is like this, same example only. Within 6 months, if you are able to complete, you will be getting 2 lakhs. Greater than 6 months, 0. That's all, only 2 options. It is not like this much, this much, this much. Here we have got multiple possibilities. Now here it's not like that, only 2. Either you will get 2 lakhs or you will get 0. So when there are only 2 possibilities, what you will do is that you will look at the most likely scenario. 75% probability that you will be getting what? 2 lakhs. 25% probability that you will not be getting anything. So which is most likely to happen? 75%. So therefore directly take 2 lakhs. Here you will not be multiplying with probability. You understand point? Most likely means only 2 options. Either you get it or you don't get it. See the probability which one is most likely, which means generally it is greater than 50%. Then that full number will be taken. Here again will not be multiplying 2 lakhs with 75% and then take the resultant number. No, entire 2 lakhs will be taken because out of these two we are thinking which is possible. This is most likely, take that number. So 2 lakhs will be added. Transaction price will be 8 lakhs along with fixed consideration. Fixed consideration by default will be included in the transaction price. Got it? That's what we have got here. See here. Ind AS 115 allows 2 methods to estimate variable consideration because when it comes to variable consideration you must estimate. Expected value method, most likely method. Expected value method when there are multiple possible outcomes, which is nothing but weighted average. You multiply the value with the respective probability. Most likely method when there are only 2 possible outcomes. Take the most likely outcome, as simple as that. It can be 0, it can be full. Take that full amount. Right. Are we done with this? Chalo, moving on to the next concept. Now, Nana, look at this, Nana. This is very, very, very important. I've written here clearly limiting recognition of uncertain variable consideration. See, already we know that variable consideration is uncertain because it depends upon future events, right? And what does Ind AS 115 say? You need to estimate it. Now, how to estimate it? There are two options, expected value method as well as what? Most likely method. Depends upon how many possible outcomes. If you have multiple possible outcomes, you go for expected value method. Otherwise, you go for most likely method if the possible outcomes are only two, either yes or no. Anyways, after that, see, look at the wordings here. That's why I've highlighted. Even after estimation, we have already estimated it. By applying either of these two methods, as the case may be, estimation of variable consideration is done, Nana. After that, you need to apply this condition. This is very important. Variable consideration should not be included in the transaction price only. Sorry, should be included in the transaction price only when it is highly probable that there will be no significant reversal of revenue later. Sir, I'm not able to understand this sentence. That's why I gave you alternative sentence. If there is low probability of significant reversal, then include the variable consideration in the transaction price. Already we were discussing about inclusion of variable consideration in the transaction price only. Na? For that only we have calculated this. We have seen the example over here. We multiplied using expected value method. For example, in this example, we got 66,750 and then we added 66,750. Now for adding this 66,750 after estimating, see, till here you have done estimation. Please try to follow what I'm saying. Otherwise, problem solving will be very difficult. Till here, what you have done is estimation because you have done the calculation. Now, the next step is to add it to the transaction price calculation, which you have added eventually. But to add this, you need to check for this condition. What condition? Is there any possibility of significant reversal in future? Which means, reversal means what? Obviously, the variable consideration which you are thinking that you will get it, you will not get it. Then what is the logic in including that in the transaction price? That is the logic, isn't it? That's why we are saying that if there is a significant reversal in future, for that if there is high probability, they do not include variable consideration even after applying either of these two methods. You understand the point? If there is no probability of significant reversal, that's what I've written, low probability or no probability of significant reversal, which means whatever that you add today, variable consideration, in our example it is 66,000. If you add 66,000 today, tomorrow you need not reduce it because there is no possibility of significant reversal. In that case, you can add today. But if you think that today you are adding 66,750 in our example, but tomorrow maybe there's a chance of reversal, thereby you might have to again revise the variable consideration from 66,750 what you have added today to 50,000 or 40,000, something like that. If there is a high probability of that reversal happening that you can see today, then why would you add 66,750? You understand what I'm trying to say? So this is a kind of a constraint. This condition is called constraint. Constraint means it is limiting your variable consideration recognition. It is limiting your variable consideration recognition. Got it? Okay. Sir, enough, sir. You have said all the concept. First of all, in what scenarios this will happen? Three cases are there. First, outside the entity's control. Sir, what do you mean by that, sir? I'll give you an example. For each scenario, I've got an example. So let's go with the example. Now, see here. That's why without examples, you'll not be able to understand anything in this particular Ind AS. Look at this example. ICICI Prudential AMC Asset Management Company is there. What is the contract? Portfolio management fee. If you look at the terms, the base fee is 1% of assets under management and bonus fee is 10% of the returns above Nifty 50. Now tell me, in this case, variable amount is nothing but bonus over here. Assets under management, wo to TK. To some extent, there is a certainty. But when it comes to bonus, it is 10% of the returns up and above Nifty 50. Suppose Nifty 50 is doing 10%. You should do more than this 10%, and in this additional how much extra you're doing, in that 10% will be your bonus. Now tell me one thing, is this under the control of the company? No, outside the control of the company. Na? Stock market movement, foreign flows, macro outcomes. Since performance depends upon external factors outside the entity's control, there is a high probability of significant reversal. Therefore, don't recognize. It's a constraint on recognizing variable consideration or adding variable consideration to the transaction price. So therefore, the bonus cannot be included in TP initially means transaction price. Why? Because there is too much uncertainty. Probability of reversal is high. If probability of reversal is high, do not add variable consideration in the TP. So recognize revenue only when the outcome is known. Got the point? Okay, so this is about first scenario. What is the second scenario? The uncertainty will not be resolved for a long period of time. 4 years, 5 years. For example, here 5 years. Sir, what is that, sir? I'll give you another example for that condition. See here. Pharmaceuticals is there, Dr. Reddy's. And what is the contract? Licensed drug to Novartis. Okay. There's a company called Novartis. Okay. Terms. Fixed fee will be 100 crore. Okay. Bonus milestone is 50 crore when the drug gets US FDA approval. Okay. Fixed fee 100 will be included in TP, transaction price. There is no doubt in that. 50 crore should be included or not in the transaction price. That is the question. Look at the FDA. That can be included once this clarity comes. Now, when does a US FDA approval will happen? Usually it will take 3 to 5 years. It also involves clinical trials, external influences, all those things, probably political stuff and everything. So therefore, now tell me, can I include this variable consideration? No, because the time gap is too long. So there's a high probability of significant reversal. Therefore, do not include. Got the point? That is the example for second point. Look at the third point now. Look at the last point, Anna. The entity has a history of changing terms, offering price concessions in future. Which means today they'll commit something, tomorrow they'll reduce that value. So when you know that tomorrow you are going to reduce that, why should I add it in the transaction price? Simple logic. For example, look at this. Zoho has given something called software SaaS with a flexible pricing. Who is the customer? Government. Annual subscription, initially Zoho says that it's going to be 12 lakhs. But if you look at the history of Zoho, always they negotiate later and they'll give 20 to 30% discount due to budget constraints, usually. That's what they have been doing. So once you know that you are Zoho, so you need to understand that anyway you're going to give that 20 to 30% discount. So reduce this annual subscription by 20 to 30% discount, and that much only you recognize today. So even though the signed amount is 12 lakhs, because there will be concessions later and you have a history of doing that, do not include full amount in TP. So this entire 12 lakhs should not be recognized as TP. Reduce this much, okay, and the balance only recognized in TP as of today. So reduce variable consideration to a lower amount that is highly probable, which means mostly you'll reduce 30%. Are you able to understand? For each and every scenario, I gave you an example. So when you are solving a question, if there is a scenario where it is outside the control of the entity, okay, or there is a scenario where things will happen after bonus is being given, but it is linked to 4 years, 5 years, or there is a scenario where there's a history of the company, always they'll offer discounts or concessions in future, not now. So today they haven't taken any decision. You understand the point? In these kind of situations, you will be restricting the recognition of variable consideration in the transaction price. You will reduce it. But when you're writing the answer, you should exactly use these words only, Nana, because there are key sentences. You have to use them as it is while writing the answer. Then only you'll get marks while writing ICA exam. So what is that sentence? There is a constraint condition for variable consideration where recognize variable consideration to that extent in the transaction price, only to that extent where it is highly probable that significant reversal in future will not happen. If you are sure that significant reversal in future will not happen, for that there is high probability, then you include that variable consideration in the transaction price. Fixed consideration is always included in the transaction price. There is no discussion over there. You got the point? Our discussion is only about variable consideration. This is very important point. I'm repeating again. I've seen so many questions based on this particular point. So many questions, which means in so many questions, one of the adjustment is based on this point. So therefore, you remember this. Got it? Next concept. Reassessment of variable consideration. This is very simple concept, Nana, because variable consideration is always uncertain. Initially, you did one assessment. After the year end also, you have to do one more assessment, na? Because it will keep on shifting because the probability will change. At the end of each reporting period, entity must reassess the transaction terms based on latest estimates. Look at this, Nana. If the estimates changes, adjust the revenue on cumulative catch-up basis. This is also important. So whenever there is a reassessment of variable consideration, in step 1 for contract modification, we have seen in one scenario where there is no distinct service, where there is no new service, and all those kind of things. In that case, what we will do, we'll do the change retrospectively. We'll do cumulative catch-up basis. Here also we have to do the same thing. When you do reassessment of variable consideration at the reporting date, that is on 31st March, you do the change retrospectively. Go back and change from day 1. Okay, so this is how it works. Revenue that should have been recognized till date from day 1 minus whatever that you have recognized till date, that will be adjusted in revenue, which means either you'll increase it or reduce it, which means you'll reverse the revenue as well, as the case may be. It depends upon the scenario. Got it? For example, 10 lakhs is what the revenue is recognized, but you should have recognized 7 lakh. Then today you will recognize additional 1 lakh. That's all. Suppose if it is 9 lakh, then you will reverse to the extent of 1 lakh and you will reduce the revenue. That's all. Simple. This is not that important, Anna, but just keep it in mind that you will reassess your variable component at the end of the reporting period. That's all. Not that important point, but just for your information. Sure. Now coming on to another important area of step 3, significant financing component. Now this is where I want you guys to focus. Focus absolutely. Now what do you mean by significant financing component? Very simple, Anna. See, I as an entity, I provide you goods or services. You make payment. That is nothing but we call consideration. So I provide you the goods today itself. You make the payment today itself. There is no problem. But I provide the good today. You pay after 1 year or 2 years or 3 years. There is a problem. Because whatever you pay after 3 years will not be just the transaction price. Now, in that interest element will be included, which we call it as financing component. That you can't call it as a revenue. So thereby you remove that. And that's where this concept comes into picture, significant financing component. Similarly, I provide services for a period of 3 years. But for 3 years, customer as you paid advance today itself. Full payment is done today itself. Which means in this case, you have paid me early. You understand the point? If you have paid me early, because you have paid 3 years early, definitely I would have given you steep discount. And that discount also includes financing component. Because you are financing me as a customer. See, when it comes to significant financing component, understand, Anna, either customer will pay early or customer will pay late. If customer pays late, okay, in that case, entity is providing finance to the customer, correct? If customer pays early, then indirectly customer is financing the entity. So when customer is financing the entity, because customer paid early as an advance, then in that case for entity, there will be interest expenditure. Whereas if entity is financing the customer, where customer is paying late after 2 years or after 3 years, then entity is financing the customer. Therefore, for entity, it will charge interest from the customer, and that becomes interest income for the entity, which should be removed from the revenue and shown separately. That is the whole intention. I hope you have got the entire concept over here. Ready? Okay. If there is a significant time back, that's why time gap. That's why I'm talking about like 2 years, 3 years, and all that. If there is a significant time gap between when the customer pays and the entity delivers goods or services, if there's a too much of a time gap, then that particular contract, whatever the transaction price you have got in that, it includes a financing element which you need to remove. In one case, you'll treat it as an interest expenditure. In another case, you'll treat it as an interest income. Got it? As the case may be, whether entity is financing the customer or customer is financing the entity by paying advance. Either the entity is providing finance to the customer, which means here customer is paying late. In that case, it will be interest income for the entity, or receiving the financing from the customer, which means customer is financing the entity. In that case, entity will get advance. If entity is getting advance, it has to pay interest to the customer. So therefore, it will be interest expenditure. Simple. Therefore, the entity must adjust the transaction price for the time value of money. In essence, discount or accrue interest to reflect the real value. The reason is very simple. The goal is to recognize fair value of the goods or service provided by the entity to the customer. Simple. But when there is a significant time gap, the transaction price will not just reflect the fair value of goods or service. It will reflect something extra or something less in case customer pays advance. You understand the point? So therefore, we need to adjust it such that whatever the revenue that we recognize or the transaction price that we take into the books should exactly reflect the fair value of the goods or services. Logical, right? Say for example, if customer agrees to pay 1,10,000 1 year after the delivery of goods, which is actually worth 1 lakh, then 10,000 is what? Financing component. Simple. This already I told you. Okay. Chalo. Let's start with first example where customer pays late, which means entity is financing the customer. That's what I've written here, late. Ready? Look at this example, Anna, to understand. PK Limited sold a laptop to SK Limited. Fine. The cash price of the laptop is 80,000, which means I give you laptop. Say for example, imagine this is the laptop. Immediately you give me money. So in that case, it will go for 80,000. But because you're gonna make the payment after 1 year, I'm charging you 88,000. So naturally, 88,000 is not the transaction price. It cannot be recognized as revenue. So you need to eliminate the interest element. So how the entries go? See here. Journal entry on day 1 where you have already transferred the control. Why? Because it's a laptop. Na. I gave it to the customer. So transfer of control is done. Why? Because customer is about to enjoy it now, right? So in that, what you will do? Very simple. You will debit debtors or trade receivable to revenue, which is 80,000 only. Why 80,000? Because that is the cash price, not the transaction price of 88,000. Because it is after 1 year, customer is going to pay late, which means entity is financing the customer. Definitely there is an interest income that the entity will get from the customer. Got it? So 80,000 is the cash price. To that extent only revenue should be recognized. Remaining 8,000 will go for interest. Got it? So then what you will do? You will increase the debtors to the extent of interest and recognize interest income. So now the debtors is showing a balance of 88,000 after these two entries. Once customer makes the payment, you will debit the bank account for 88,000 and cancel the debtors, which is trade receivable. That's all. Easy, done and dusted. So in P&L account, what you will show? Revenue will be shown to the extent of 80,000 only. Other income, interest income, you will show it separately as 8,000. Clear? Huh? So revenue. Otherwise, if you don't put this rule of significant financing component, you'll be inflating your revenue. Nah? You'll be showing it as 88,000. That's not correct revenue. Then you are hyping the revenue, which is wrong. Got it? Yes. Okay. This is one scenario where entity gives financing because customer pays late. If customer pays early, then what will happen? Let us see that. Where is that example? Yeah. Customer pays early. Look at this example. Nana. This example is enough, Nana, for you to understand the entire concept. Remaining this, based on this example only, I've written content. Now see here. PK Limited sold a customized product to SK Limited. We'll see real life examples also. Don't worry. The delivery date is after 1 year. Okay. The delivery date selling price product is 3,45,000, which means entity gives a product to the customer after 1 year. So today product is not given. After 1 year, when I'm delivering the product after 1 year, on that day the price is 3,45,000. But today customer has made the payment on day 1 itself, which is 3 lakhs. You understand the point? Which means who is financing whom? Customer is financing the entity. Which means who has to pay interest to whom? Entity has to pay interest to the customer. Which means it will be an interest expenditure. Now, customer did pay 3 lakhs on day 1. But the transfer of control of goods or services will happen after 1 year in future. On that day in future, the value of that particular product which is getting delivered is 3,45,000. Right? Okay. So on day 1, what happens? 3 lakhs worth of money you have received? Yes. So bank account debit. Simple. 2, can I recognize this as a revenue on day 1 itself? No, 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 no. To recognize revenue at the beginning of Ind AS 115, what did I say? Transfer of control should happen. Transfer of control, when it's going to happen? After 1 year, which means now can I recognize the revenue? No. So treat it as a liability, advance income or contract liability. Sir, in the previous example, when customer paid late, you have recognized revenue? Yes, because transfer of control did happen. Na? Here, you sold the laptop now. So transfer of control did happen. Therefore, you can recognize revenue only to the extent of cash price. That's the point. So to recognize revenue, that's why I started with the basics itself. At the beginning of Ind AS 115, when we have started, this was the point that I was stressing upon. Transfer of control must happen to recognize the revenue. Are you able to understand? So here, did transfer of control did happen as on day 1? No, it's going to happen after 1 year. So there is no transfer of control. In that case, you will treat it as a contract liability or advance income. That's all. This is your first entry. But you received the money. Okay. Because customer has financed you, you have to pay interest income to the customer. Sorry. You have to pay interest to the customer, which will be an interest expenditure. Yes. So to that extent, increase the contract liability. Okay. Interest expenditure is an expenditure, obviously. Debit that 45,000 to contract liability 45,000. All right. Then journal entry on the delivery date will be delivery date. What will happen is you are transferring the control of the good to the customer. Now you can recognize revenue. On the delivery date, what is the price? 3,45,000. That's the fair price of the product, fair value of the product. So recognize revenue at fair value of the product, which is 3,45,000. Are you able to get me? And you will debit the contract liability. Why? Once you recognize the revenue, there is no more liability. Why did you create liability? In case in future, if you fail to deliver this product, are you able to understand? Then there is a risk now today itself. If I recognize the revenue and tomorrow you are not able to deliver this product, then I have to reverse the revenue. Why to do all those things? Okay. So there is a little bit of uncertainty. So I'll treat it as a contract liability. So in case tomorrow if you fail to deliver the product, then I have to return this money back. Therefore, I'm recognizing that as a contract liability. That is the logic. You understand the point? Right? And then because customer has financed me, I have to pay interest. That's why this much of interest. The difference between this 3 lakhs and 3,45,000. To that extent, contract liability is increased. Now, total in case if I'm not able to deliver, I have to pay back 3,45,000 to the customer. You understand the point? But luckily I delivered. Therefore, today the rate is 3,45,000. To that extent, you recognize the revenue and there is no more liability. Na? So debit the liability and cancel it off. That's all. This clearly demonstrates a significant financing component where payment is received in advance and the interest expense is recognized over a period till delivery exactly as required by Ind AS 115. That's all. Once you are done with these two, the concept is done. Nana. That's it. Nothing else. You can see here. Case 1, payment by customer after the entity performs its obligations, which means payment by customer is late. This is nothing but late. Okay. The situation arises when the entity delivers goods or renders services first and the customer pays late, which means basically entity has given financing to the customer. Therefore, entity will charge what? interest income. That's all. You will recognize the revenue at cash price because transfer of control did happen on day one itself. Because entity has performed its obligation, na? Therefore, transfer of control did happen. Therefore, you can recognize the revenue, but do it at cash price. As in case of our example, 80,000 is there, na, that much. So therefore, look at the entries: trade receivable to sales revenue at cash price. In our example, what was that? In our example, 80,000. Got it? Then you will be having interest income, right? So interest income, and to that extent, increase the debtors, right? Because that guy has to pay you more. Finally, transfer the interest income to P&L account. That's obvious. Therefore, I did not write this entry in the example. Once customer makes the payment, debit the bank account and credit the debtors or trade receivables because there is no more debtors. Customer has made the payment. That's all. Simple. All right. Another point is how to calculate that cash selling price. In my example, I just gave you that cash selling price directly. If you can see here, where is this late example? Here it is. I gave you cash selling price directly here, 80,000. Now, what if it is not given directly? If that 80,000 is not given directly, what will happen? In that case, how will you find cash selling price? In case where the customer is paying the money to the entity in installments, in that case, what you will do? Very simple, find out the present value of future cash inflows using appropriate discount rate. Based on that, you will be able to find your cash selling price. Now remember, cash selling price means we are talking about selling price here. So always it includes profit. So therefore, cost of goods or services plus profit margin will be called as selling price. Are you able to understand? So normally cash selling price will be given in the question. In case if it is not given, if it is given as installments which the customer is paying in future over a period of 4 years or 5 years, just discount that. Okay, find out the present value at an appropriate discount rate, and that present value is nothing but your cash selling price. As simple as that. But ensure that when you are talking about selling price, it should be including cost plus profit margin, because in some questions this point also will be tested. That's why I'm telling this. Clear? Discounting rate, what you will use? Very simple, market interest rate will be used. In case if market interest rate is not given, then any rate that is given in the question, that will be used. Simple. Which means I've written here in brackets, the rate should not be tainted. It should not be an artificially inflated or deflated rate. It should be reflecting the market rate. See, we have already done so many chapters now. For example, you are giving loan to employees at 6% interest. Normally, the similar loan will be given at 10%. 6% is tainted rate now. That's what I'm trying to say. The rate should not be tainted. What you're talking here, the discount rate na, to discount the future cash flows, it should not be tainted. It should not be inflated or deflated discount rate. It should be correct discount rate, which shall be reflecting the market interest rate. Clear? That's the only point you need to remember. So when it comes to cash selling price, if it is directly given, then that's fine. If it is not given, then you take all the future cash flows, discount it at the discount rate, which should be the market rate, which should not be tainted, and then you should be getting your normal cash selling price. That's all. This normal cash selling price is the price at which you will recognize revenue on day one. Later, you will add interest, you will increase the debtors or receivables, and finally, once they make the payment, bank account debit to receivables or debtors. That's all. There ends the matter. Done? Chalo. In case 2, what happens? Customer pays you early in advance, which means customer is financing the company. In this case, the customer pays first, which means entity delivers goods or services later, meaning the customer is effectively financing the entity. This also we have seen. Entries also we have seen already. Contract liability. Okay, based on this example, that's all. Both are covered. This is a revision session, Anana. Once we cover the example, literally we have covered the concept. So I should not be spending too much of your time because we don't have time being a revision session. Okay, right. So with this, we have completed significant financing component. Now, what if in certain special cases, financing component is not significant, which means it seems like there is a financing component and you'll be tempted to treat it as a financing component, but actually there is no financing component. So these are all 4 different cases of financing component traps. You got the point? For each and every scenario, we'll see an example so that you'll understand concept better. Okay, shall we? Let's continue, guys. So there are certain scenarios where it feels like a trap, where you feel that financing element is involved, but actually it is not. So there are 4 special scenarios where you should not be considering financing component. All right. Now, what are they? Customer pays in advance, but the timing of transfer is at their discretion. Whose discretion? Customer's discretion. So customer pays money first, buys a recharge card, and then we never knows when he will recharge. Earlier it used to be the case, now it is not there. Earlier we used to buy a small recharge card and then there used to be a code, we used to scratch that and then we used to recharge for the prepaid mobile phones. You got the point? But that is in the hands of the customer now. You understand the point? So here, nobody is really controlling the others. Nobody is really financing the other party. So in this kind of scenario, do not consider that timing difference as what? Significant financing component. For example, you can see the example over here. Airtel sells 500 prepaid recharge on 1st January. Customer uses this balance maybe in Jan, maybe later, or maybe even in March. So customer decides. So it is at his discretion, at his choice. Okay. So even though Airtel has cash before service, but this is not financing. If customer wants, the moment he buys the recharge card, at that time itself he can scratch and he can use the service. He has chosen not to use it now and use it at a later point of time. That is at his discretion. So that you cannot call it as a significant financing component. Got the point? So because customer controls, this is one scenario. Another scenario is a kind of royalty based scenario, means substantial part of consideration depends upon future events. Because for royalty, the sales needs to happen. After that, only a percentage of that will come to you as a revenue, isn't it? So the nature of the transaction itself is that you have to wait for the sales to happen eventually. So if you look at this example, sales based royalty, Tata Steel licenses its technology to JSW. Okay. Payment terms is 2% of the sales. Now the payment from JSW to Tata Steel for the license will depend upon how much sales JSW makes, correct? So future sales volume, it depends upon that, market demand, customer behavior. So even though sales occur later, payment is made later. Once the sales occurs, on that 2% will be made by JSW to Tata Steel. The timing difference is not for financing because it's the nature of the transaction itself is like that. Royalty transaction in its nature itself is like that. See, when we talk about customer paying late, customer paying early, it is not in the nature of the transaction. Customer can pay at the point of time itself when the transfer of control of goods or services is happening. Eventually, that will lead to performance obligation getting satisfied. Eventually, that will lead to revenue recognition. This is what we know. The point is, there is a possibility of both happening at the same time, right? But they have personally chosen, okay, to delay it. You understand the point? Here, that is not the case. The nature of the transaction is such that you got to wait till the sales needs to happen. After that, only you will be getting 2% royalty. So therefore, here the timing difference between the payment and the sales and all that stuff, you cannot call that as a significant financing component, right? That is another situation. Third, the difference arises for other reasons and not financing. So what do you mean by that? For example, look at this example. Toyota is a company, obviously, you guys know that. Toyota sells cars to a dealer at 10 lakhs, okay? And dealer withholds 50,000 for quality inspection for 30 days, which means even though you have to pay 10 lakhs, dealer is not paying 10 lakhs. He keeps 50,000 with him and pays 9 lakh 50, and he holds this for a period of 30 days. And after that, if nothing is found, nothing wrong is found in the car, then the balance 50,000 payment will be done to the Toyota. Now the question is there a delay in payment over here? Yes. Time gap exists? Yes. But not because Toyota is financing the dealer. Toyota is allowing the dealer to what? Pay late. And therefore the timing gap, you can call it a significant financing component. No. The reason is dealer is trying to safeguard himself from any future dents or something going wrong with the car that he has received from Toyota. You understand the point? So customer retains money for assurance purposes, safety purposes. So in that case, that timing difference here, in this case, it is for 30 days. You cannot call it as a significant financing component. You understand the point? You cannot call it as an interest component. That is third scenario. Last scenario is practical expedient. Practical expedient means many a times Ind AS, when things are getting too complicated, Ind AS gives you an alternative saying that if you don't want your accounting to be complicated, you can just apply practical expedient. Now here also the last point is practical expedient means, okay, all this sounds really complex. Okay, significant financing involved, sometimes it is not involved and stuff like that. You can do one thing. If the timing gap is less than 12 months, then you forget about significant financing. If it is greater than 12 months, then we can think about that. This is what we call practical expedient. That is the last point. So the standard permits entities to ignore financing effects if payment and performance occur within 12 months. If it is greater than 12 months, you don't have a choice, Nana. If it is less than 12 months, you have a choice. Okay. So time gap is less than 12 months, or then there is no need of discounting. Infosys provides cloud services to HDFC Bank, obviously because it's IT company. Invoice issued on 31st March, payment will be made on 30th September, that is 6 months later. Now Infosys has performed now. Are you able to understand? That services is given to HDFC Bank, but HDFC Bank is paying the money later, which means Infosys is financing HDFC Bank, which means Infosys has to charge interest, which means Infosys will get interest income from HDFC Bank. Usually that's the case, but because here it is less than 6 months, you can apply practical expedient. And because the time gap is less than, did I say less than 6 months? Time gap is less than 12 months. It is 6 months, which is less than 1 year. Ind AS 115 allows practical expedient, and as a result, no need of discounting, which means do not talk about or think about the financing component. That's all. Simple. So 4 reasons are pretty simple to remember, Nana. I gave you examples for all the 4. First one is the choice is in the hands of the customer. Got it? The second one is royalty. Nature of transaction itself is like that. There will be a timing gap. And the third case is because of some sort of safety reason or assurance reason, there is a time gap between the providing, transfer of goods or transfer of services versus the payment. And the last point is practical expedient provided by Ind AS 115, where if you want, less than 12 months can be considered as no significant financing component, and greater than 12 months, obviously, you can consider significant financing component. Simple. That's all. It is not that important, Nana, honestly speaking, but then still you need to remember, because many times you get confused between certain situations or transactions where you get confused between having significant financing component and not having significant financing component. Therefore, these 4 special cases you got to remember. That's all. Nothing else. Let's move on to the next one. Non-cash consideration. What do you mean by non-cash consideration? See, whenever there is a transaction between the customer and the entity, obviously entity provides goods or services. In return, customer gives consideration. Now the question is, that consideration need not be cash in all the cases, in all the scenarios. It can be sometimes in kind. That's what we call non-cash consideration. For example, customer can give shares. Customer also can give something else as well. You understand the point? So therefore, if consideration is not in cash and if it is in kind, then how are you going to measure it? Transaction price. That's the biggest question. Now, if it is cash, means you know the value of the cash, and that's the transaction price. But if it is in kind, there comes a problem. Now, actually, it's a very simple concept, but here also I've seen students getting confused. The reason is, see here. Look at this example. PK Limited is the seller. Okay. He sold laptop to SK Limited, who is the customer. All right. Fair value of the laptop is 1,15,000. So logically speaking, once the laptop is given, transfer of control happened, which means PO is satisfied, performance obligation is satisfied, which means revenue can be recognized, provided if SK Limited pays 1,15,000 in cash, then there is no problem. Immediately transfer of control of goods or happened, PO is satisfied, revenue can be recognized. So PK Limited will recognize 1,15,000 as the revenue. Easy peasy. However, customer is not giving cash, consideration in kind, non-cash consideration. So he is giving shares of SK Limited. SK Limited is a customer. His company shares, he is giving it as consideration. In that case, what you have to do? Very simple. Your first preference is SK Limited is the customer. Customer has to pay cash. Now he is paying in kind. Find out the fair value of that kind. In this case, shares. Now, what is the fair value of the shares? That will be the transaction price. Simple. In this case, fair value of the shares is 1,20,000, which means 1,20,000 is your transaction price. That's your first preference. Sometimes, whatever the kind that customer gives, let's say it is unique, and you can't find fair value of it in the market. Fair value is nothing but market value, pretty much, most of the times. So you can't find market value because the kind of consideration, non-cash, that is in-kind consideration, which is given by the customer to the company, is very unique. You can't find fair value for the same. In that case, how to find transaction price? Then simple. Then see what the entity is providing to the customer. In this case, entity is providing laptop. Find out the fair value of the laptop itself. 1,15,000. Then that will be your transaction price. Now here only students get confused. Now please try to understand. See what's happening. Take this example only. I am the entity. You are the customer. I am giving you laptop which is worth 1,15,000. You are giving me shares which is worth 1,20,000. Please try to understand. Here 2 things are involved. Always the first preference is see what the customer is giving. Uska fair value try to find. Customer is giving shares. Fair value of the shares is how much? 1,20,000. That will be your transaction price. Suppose if this information is not available, whatever customer is giving you, it is really unique. You can't find fair value or market value. Then leave it aside. See what the entity is providing. In this case, it is laptop. Uska fair value how much? 1,50,000. That will be your transaction price. Is that clear? That is the concept over here. That's all. Are we done? Chalo. Moving on. So in the last concept, we have seen where customer is providing you consideration, not in cash, but in kind. In that case, we have seen the first preference will be fair value of the goods that is provided by the customer. If that is not available, fair value of the good provided by the entity will be your second preference. Done and dusted. Moving on to next concept. What is the next concept? Customer provided goods or services. Sir, what is this, sir? Just now you have talked about non-cash consideration where customer will be giving, shares or something like that. No, 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 no. This is totally different. Customer provided goods or services. Sir, what is this? Generally, goods or services will be provided by entity to the customer. Na? Customer will provide only consideration. Na? The job of the customer to give consideration. The job of the entity is to provide goods or services. But here, why customer is providing goods and services? Which means customer is entity. Na? No, 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 no. Once I tell you the example, you will understand. So for that, let's go to the example. Now look at this example over here. Look at this example, Anna. This is only for the purpose of understanding the concept, okay? PK Limited is the customer, SK Limited is the entity, okay? Customer is giving cloth to the entity. Normally, with tailors, we'll be doing now once upon a time. Now everybody is wearing ready-made clothes. Once upon a time, what we used to do is that we used to go to a garment shop and then we used to buy a cloth. And then we used to take that cloth and go to a tailor. And we used to give that cloth to the tailor and tailor will work upon it and then convert that into a shirt as well as pant and then give it back to us. And that's what we used to wear once upon a time, especially our father's ka jamana, right? But now everybody is going with ready-made unless it is a suit or something like that. So it's similar kind of a scenario, just imagine, okay? So cloth is provided to SK Limited. It's a very costly cloth and in large quantities. Let's say it is 20 lakhs. What SK Limited has to do, convert that into a garment. The value addition that is being done by SK Limited is 9 lakhs. Are you able to understand? And then this 9 lakhs is in return sold to PK Limited for a value of 29 lakhs. Are you able to understand? Now, if you see, this is a perfect example of customer provided goods because customer has provided the cloth upon which SK Limited has worked upon, correct? Now the point is how to give treatment, how to recognize the transaction price. Well, the answer is very simple. You just see from SK Limited's point of view, that is entity's point of view, whether whatever the goods that the customer has provided, does entity has got control over it or not? Logically speaking, in this case, because it's a cloth, SK Limited will have control. Na? So if SK Limited will have control, then imagine as if this is a separate transaction where SK Limited has purchased it, therefore show it as a expenditure. And then he's selling it with added value of 9 lakhs for 29 lakhs. So SK Limited can show 29 lakhs as revenue and 20 lakhs as expenditure. The net revenue will be 9 lakhs only, logically speaking, if he obtains control. In this case, obviously, he has to obtain control only. That's why I've put tick here. But just imagine only for understanding the concept. Imagine. Okay, even though it is not possible, imagine. SK Limited do not have control of cloth, just like a job work. In that case, you're not getting control. Na? So all you have to do is that you got a cloth, you don't have control over that. You just need to do the job, convert that into garments and sell it to what? The so-called customer. But doing that job, you are being paid 9 lakhs. In that case, just to show 9 lakhs as revenue. Simple. So if you get control, then sale and purchase. If you don't get control, then only sale. Are you able to understand? Just understand the concept. Okay. Now we'll go for a better example. Let's say Maruti Suzuki company is there. He is the customer. Everybody knows. Real life example I'm giving. This guy wants L&T, okay, to manufacture a plant, to manufacture EVs. He wants to manufacture electric vehicles. He wants to have a new plant in Chennai. So in this process, what happens is L&T is the entity who does the construction job. But to make the construction possible better, I mean, to help or whatever it is, Maruti Suzuki is providing cement to entity, land to L&T, and cranes also is being provided by Maruti Suzuki to L&T. Now, in this case, you need to understand these are the goods provided by the customer who is Maruti Suzuki to the L&T. Now, the question is whether the value of this should be included in the transaction price or not. In this case, it is included in transaction price. Now, 20 lakhs is included in the transaction price. Whether the value is included in transaction price or not depends upon whether L&T has got control over that particular goods provided by the customer or not. So ask yourself, cement, L&T has got control? Yes. If there is control, then in the transaction price, value of the cement will be included. Land, L&T has got control? No. You just use that land, construct the manufacturing plant and then hand it over to what? Maruti Suzuki only. So you don't have any control. In that case, with respect to land, you will not be including the value of the land in the transaction price. Cranes? No. Cranes belong to Maruti Suzuki. Even let's say operators also belong to Maruti Suzuki. L&T is just using them. So with respect to cranes, with respect to land, L&T has got no control. So you should not be including the value of the land as well as value of usage of cranes in the transaction price. But with respect to cement, L&T has got control. Therefore, to that extent, you can include the value in the transaction price. As simple as that. Here, if you look at this example, because cloth is under the control of SK Limited, the value of the cloth is included in the transaction price. That's why 20 lakhs is added to what? The usual value addition of 9 lakhs, and thereby the revenue became 29 lakhs. Of course, you need to recognize the purchase expenditure as well. But if there is no control, then this 20 lakhs, which is nothing but value of the customer provided goods, should not be added in the transaction price. In that case, your transaction price will be 9 lakhs only. That is the concept. Now, if you can see the example as well here. Just a second now. See here, L&T will build a large plant. Cement is being provided by Maruti, who is the customer. Same example only now, so I'm going straight away. Worth 4 crore, land worth 80 crore. Cranes and Maruti staff operate the cranes. Now evaluate. If the entity obtains control, you can add the fair value of the cement, because cement is usually in the control of L&T only. That's how he can build the construction. So therefore, cement is provided by the customer. Customer provided goods only, but L&T has got control, which means to the extent of fair value of the cement, it will be included in the transaction price. Whereas if the entity does not obtain control, in what cases? Land, no control. Are you able to understand? Even the crane also, L&T does not have any control. In that case, L&T does not own cranes. Maruti staff operate them. Land also, L&T doesn't own it because it is owned by Maruti Suzuki. So you don't have any control. Therefore, in these two cases, whatever the fair value of the land and fair value of the crane should not be included in the transaction price, because L&T has got no control. Therefore, no impact on TP. Did you understand the concept over here? That's what I've explained over here, right? Chalo, let's move on. Next, consideration payable to customer. We are still in step 3 only. I told you step 3 is very big and very important. We are still in step 3. Consideration payable to customer. I have written here very difficult and important. You will understand it. Why is it like that? Right now, we will not be discussing completely, because after that, there are certain special cases. There also this consideration payable to customer will come. Right? Ready? Sometimes you will also pay something back to the customer. Now, this point itself is a little bit weird. Why? Because why would entity pay something to the customer? Because usually what happens is that entity gives goods and services and then customer makes the payment. So this is the usual stuff. So whenever something happens opposite to the usual stuff, it's really weird for us to understand and adjust accordingly. For example, just now we have seen that the customer will provide goods to the entity or service to the entity. So that cloth example we have seen, that Maruti Suzuki, as well as what L&T construction example we have seen for EV plant. So those are certain weird situations where customer will provide goods or services to the entity, whereas usually what will happen, entity will provide goods and services to the customer. Correct? Same logic here also. Usually customer will pay consideration to the entity, but there are certain special scenarios where entity will pay some sort of consideration to the customer. Sir, what is that, sir? If you look at the examples, cash amounts, some credits or coupons, future discounts for additional purchases, loyalty points, something like that. We'll discuss this in detail. Right now, you guys need to just get the basic idea. All right. Now, in this case, what will be the accounting treatment? Very simple, as per 115. First of all, you as a company, when you are paying something back to the customer, you need to ask yourself, I'm paying something back to the customer now. I'm paying consideration to the customer now. That consideration which I'm paying to the customer, is it for a distinct service or good that customer has given to me? Are you able to understand? For example, let me put it this way. Some big brand is there, Nana, Raymond brand, for example. We'll be seeing this, but anyways, Raymond brand is there. Raymond, say for example, in Reliance Fashion. So they have given their clothes, garments. Okay? Are you able to understand? Let's say Raymond has asked Reliance that you place your garments at the beginning of your showroom on the left side top view, so that any customer who enters your showroom, okay, so they should be in a position to see that. That's what we call it as slotting fee. So that is different. Here, if you see, Reliance Fashions is the customer. Raymond is the entity. You understand the point? Now what is happening? Because Reliance Fashion will keep the Raymond garments in a specific location, which we call it a slotting fee, which we'll see it later. Who has to pay money to whom? Raymond has to pay money to Reliance, because Raymond is the entity, Reliance is the customer, logically speaking. But because customer has given a small preference of a preferable slotting area in the entire showroom. Therefore, Raymond is paying. So basically here what's happening, Reliance is the customer. Usually for the garments, ready-made garments that Raymond has given to the Reliance, Reliance is the customer. Reliance has to make payment to Raymond. That will happen. In addition to that, Raymond also will make some payment to Reliance because you have asked Reliance to keep your products at a specific location at a premium place, and for that Reliance will not do it for free. So they'll ask you something, they'll charge you something, so where you will be paying to your customer. This is one scenario. But here distinct service is not getting provided. As a result, whatever the money that Raymond pays to Reliance for that special place in the Reliance Fashion Mart, for example, in that entire place, for that you are paying fee na, that will be reduced from the transaction price. This is the treatment. Suppose same example, same scenario, Raymond is asking Reliance to place a separate LED TV and then advertise Raymond products, Raymond garments inside the Reliance Fashion Mart. Now here what's happening, the customer who is Reliance is providing special service, distinct service, which we call it as advertising services to Raymond. In this case, you have to treat it as a separate contract as such. So the question is payment related to distinct good or service received from the customer? Customer is Reliance Fashion Mart, entity is Raymond in our example. If it relates to a distinct good or service, that advertising LED TV, what I'm talking about, then recognize purchase of good and service and record sale to the customer separately. So two transactions you should see it separately. Means Raymond sending those ready-made garments, selling those ready-made garments to Reliance Fashion will be seen as a separate transaction, and Raymond will record sale for the same because he has sold his garments to what? Reliance Fashion Mart. At the same time, Reliance Fashion Mart has given distinct advertisement service to Raymond. For that, Raymond will make the payment and that will be shown separately as purchase of advertising service. So record purchase of advertising service separately and record sale of garments separately, because it belongs to distinct service. Are you able to understand? So whatever the consideration that you paid to the customer, that is Raymond has paid to what? Reliance Fashion Mart, belongs to distinct service, that is advertising service. Therefore treat it separately. Suppose it does not relate to any distinct service, like first one, slotting fee, which I was talking about, then you just set it off with the transaction price. That's all. You'll be getting money from Reliance Fashion because you are selling your garments to Reliance Fashion, and Reliance Fashion has just kept it at a prominent place, which we call it a slotting fee. And Reliance has to pay the money for all the garments that they have purchased from you, correct? They will just set it off that slotting fee and then balance will be paid over. So you just need to reduce the transaction rates, that's all. You need not recognize that as a separate transaction. Clear? Of course, in between there is one more point. What is that? Sometimes if it relates to a distinct good or service, but consideration is not on par with fair value, they are trying to manipulate. In that case, what you will do, you will just reduce that, whatever the manipulation that they have done. For example, see this example, you will understand the manipulation. Already I gave you example for distinct good or service, which is separate advertising LED TV, and I gave you example for not a distinct good or service, which is slotting fee, which we'll see again. For this, I'll give you example, that is nothing but this one. See, PK is the customer, SK is the entity. Okay. PK has purchased a product A from SK, SK has paid 800. Alright. SK also has sold product B to PK and PK pays 1000. Alright. Now, what is the situation over here? Sorry for that, the error mark was wrong. Now I've rectified it. Now, look at this situation. Presuming that whatever the price at which product A, okay, is sold by PK to SK, for which SK has paid 800, let's presume that it is SSP. Standalone selling price, so which is a fair value, so there is no manipulation. Same 1000 is also, there is no manipulation, and presume that this belongs to a distinct good, because distinct good is being sold by the customer to the entity. In that case, if the distinct good or service condition is satisfied, what you will do, both the transactions you will show separately. We need to think from entity's point of view. So because this is a distinct good, entity will show the purchase separately, 800, and this sale transaction will be shown separately. Therefore here customer has purchased product B from entity for 1000 rupees, that will be shown separately as a sale. This is what we have understood. So if it belongs to distinct good or service, recognize purchase of good or service separately, sale separately, purchase separately, sale separately. Clear? Now we are talking about this example where there is a manipulation in the price. Look at this. Same example only, which I picked from here, but the price of product A has been sold by customer to entity for 900, which is a manipulated price, which means it has been inflated by 100. Similarly, SK Limited has sold to PK Limited a price of product B, which is at 1100, which is again manipulated, which means both these guys have got understanding. I'll sell to you at a higher price by 100. You also sell to me at higher price by 100. You will inflate your revenue. I'll inflate my revenue. Both our books will be inflated, manipulated, and people will see that, oh, you have done really good sales. You understand the point? 115 says, obviously, I caught you guys. You can't do fraud with me. So thereby, that 900 you can't show. 1100 you can't show. You should show it at SSP only. That is fair price. Purchase and sale inflated by 100, reduce it by 100. That's what we have seen in the second point. It relates to a distinct good or service. Of course, it's a continuation example. So therefore, this is distinct good in both the cases. However, consideration is greater than fair value, inflated by 100 in this case. Then the excess amount is treated as reduction from the transaction price. That is what we have done here. Clear? Logically speaking, we have seen examples for all the three, but then still we'll continue the same discussion. See, common examples for consideration paid or payable to customer. First one is slotting fee, then we have price protection, then we have cooperative advertising arrangements. These things are specifically discussed as examples for consideration payable to the customer because based on this questions are asked. Now from this we are not going to learn, obviously we're going to go with examples. So look at this examples, Nana. Examples for consideration payable to customer. Ready? Look at this, Nana, same stuff. So we have few examples: promotions, coupons, slotting fee, advertisement reimbursement, cashback. The only question is, does the payment to the customer relates to distinct good or service? If it is yes, treat two separate transactions, one as a purchase transaction, the other one as a sale transaction. Otherwise, reduce it from the transaction price. So look at the examples over here. Suppose Colgate sells toothpaste to Big Bazaar. Okay. Now, Colgate pays 20 lakhs to place toothpaste on a particular shelf. Placing toothpaste on a particular shelf means it is like a slotting fee. So therefore, it comes under slotting fee, which means there is no distinct service, only to promote Colgate sales. Therefore, whatever the payment that you pay to Big Bazaar, because Big Bazaar is the customer, Colgate is the entity. So you are paying consideration to customer, but that is not for a distinct service. It is just for mere promotion. Therefore, the net effect will be there is no distinct service, reduced from TP. Got the point? So therefore, this 20 lakhs will be minus, in the sense it will be reduced from the transaction price, whatever the transaction price it is. Look at the next example. Samsung sells TVs to Reliance Digital. I have taken all the real life examples only, okay, at 2 lakhs each. All right, Samsung is the entity, Reliance Digital is the customer. In the contract, there is a clause. What is that clause? If selling price gets reduced by 50,000 in future, within 60 days of this particular transaction, then Samsung shall refund 50,000 to Reliance Digital. See, this is like a price protection, Nana. Simple logic. See, Samsung has sold TVs to Reliance Digital for 2 lakhs. And after 1 month, Samsung is reducing the prices of all the TVs because of whatever the reasons. Okay. And then Samsung is directly selling at 1,50,000. Then what will happen to your Reliance Digital? He'll be in a very worse situation. Thereby, generally, these kind of transactions, especially B2B, this is B2B, na? Business to business transaction. They will always have a clause of price protection. Price protection means suppose in future Samsung suddenly reduces the prices within 6 months. In this example, it can be, sorry, within 60 days. It can be any timeline. It can be 3 months. It can be 6 months. In this example, I've taken it as 60 days. Then Samsung, the entity, has to pay compensation to the Reliance Digital, that is the customer. In this case, he has to refund 50,000. Now tell me, is there any new service happening here? No. But the same service only, it is a kind of price protection. So therefore, there is no distinct service. If there is no distinct service means you need to reduce from the transaction price. That will be your treatment. So which means we have discussed this as well as this. Okay. Next, look at the last example. Nestle pays 10 lakh to DMart to run Maggie ads in LED panels inside DMart. This example already I told you from the perspective of Raymond and Reliance Fashion Mart. Same stuff only. So now DMart place Maggie ads inside the LED panel inside DMart. Now that's an advertising, na? It's a distinct service. So when there is a distinct service, whatever Nestle pays to DMart, because Nestle is the entity, DMart is the customer, whatever it pays, it will be considered as a purchase cost or advertising expenditure. So separate transaction. And whatever DMart pays to Nestle for all the Maggie that DMart has purchased from Nestle or any other Nestle products for that matter, that will be treated as separate transaction, separate sale transaction. So Cooperative adds distinct service, therefore purchase cost and TP will remain untouched, which means you will not reduce it from TP. That's what I mean to say. Purchase cost will be dealt with separately, separate transaction, it will be debited, sale will be debited separately. That's what we have done here as well. Purchase separate, sale separate, because distinct good or services. So all the three I've covered with real examples. Are we done? I've given few more examples also. If you want, you can see. We can just go through this as well. Now, you guys want to go? Yeah. See here. Alan Solly is the entity. Shopper Stop or Lifestyle is the customer. Sale value is 25 lakhs. It has sold its garments. Okay. Now, Shopper Stop is charging entity, that is Alan Solly, for choosing shelves to ensure products receive prominent placement. This is nothing but slotting fee. Amount is 1 lakh. So there is no distinct good or service. Therefore, what you'll do, reduce it from the transaction price. Transaction price is 25 lakhs. This 1 lakh has to be reduced. Reduce it. So the net transaction price will be 24 lakhs. Easy. Next, price protection. PK Limited is manufacturer, SK Limited is retailer, sale is 15,000. And there will be a clause in the contract where PK promises to SK, that is entity promises to customer, that if the price gets reduced in the next 6 months, in our example, we have seen 60 days. Now here it is 6 months. Then I will reimburse. Here also there is no distinct service. So whatever the price protection that you promise to reimburse, if that happens, you reduce it from the transaction price. That's all. You'll get 14,500. Next, cooperative advertising arrangement. Same Alan Solly and Shopper Stop. It charges, say for example, it puts an LED panel and then Shopper Stop advertises for Alan Solly garments. In that case, it's a separate distinct service. Advertising expenditure 80,000. So therefore, you have to show it separately. Advertising expenditure in this 1 lakh. 1 lakh or 80,000? Okay. Amount is not 80,000. It is 1 lakh. That's okay. It is a distinct service, Nana. Therefore, show the advertising expenses separately, revenue separately. Got the point? All right. Normally, this is what will happen, Nana. There are certain unique situations where this also will happen. Right now, don't confuse yourself. This we will see later. Till here, it's done. Right, chalo. So we have seen two examples for slotting fee, price protection, as well as cooperative advertisement arrangement. Chalo, done. So with this, we are done with step 3, the biggest step as well as the toughest. Now step 4 and step 5 is pretty easy for us. So fatafat, let's look at it. Step 4 is what, Nana? Matching step 2 and step 3. What is step 2? Identifying POs, performance obligation. What is step 3? Identifying the transaction price, finding out what the transaction price is. Now in step 4, what we are going to do is that we're going to match step 2 and step 3. So which means if there are multiple POs and if there is a single transaction price, this single transaction price has to be allocated to multiple POs. That's what we are going to do. Matching step 2 with step 3. Performance obligations with transaction price. That's all. After determining the total transaction price, concentrate on the word total. Okay. We need to allocate it among various performance obligations identified in the contract. If there is only one PO, there is no question of allocation. If there are multiple POs, obviously you got to allocate. How will you allocate? Very simple, in the ratio of SSP. That's all. Look at this example. An entity is selling 3 distinct products A, B and C to a customer at a transaction price of $40,000. Okay. The SSP of the 3 products, for A 20,000, B 12,000, ignore dollars. Okay. Just look at the numbers. A 20,000, B 12,000, C 16,000. Total SSP is 48,000. What do you have to do? This 40,000 transaction price should be allocated to A, B and C in the ratio of SSP, which means 40,000 for A into, for A what is the SSP? 20,000 divided by total of SSP is 48,000. For B, it will be 40,000 is the transaction price into 12,000 divided by 48,000. For C, it will be 40,000 is the transaction price into 16,000 divided by 48,000. That's all. Simple. See? You have done with the allocation. That's all. So once you are done with the allocation, that's all. Step 4 is done. Step 4 is all about allocating your transaction price to the multiple POs. That's all. To the multiple POs. There ends the matter. So product A, B and C are distinct performance obligations. The transaction price is less than the total SSP. Yes, total SSP is 48,000. Transaction price is 40,000. Obviously, when you are buying multiple products, definitely there will be a bulk discount. Na? We call it as bulk discount or bundle discount, whatever it is. The transaction price is less than standalone selling prices, indicating a discount. As per 115, the discount is allocated proportionately. See, once you allocate transaction price in the ratio of SSP, automatically difference between SSP and allocated transaction price is nothing but discount. Na? Simple logic. Right? So revenue for each product is recognized based on allocated transaction rate. Means now you have allocated this much, 16,667, 10,000, 13,333. But this PO, this PO, this PO. Now you wait for this PO to get completed. PO must be satisfied. Okay, when PO will be satisfied? When there is a transfer of control. When there is a transfer of control. In this case, all the 3 are goods. Na? So transfer of control or goods, then PO is satisfied. then what will happen eventually? Revenue will be recognized. Simple logic. That is what I called Holy Trinity. I'll show you here as well. Where is it? Just a second, Nana. Here. Control is getting transferred. Then PO is getting satisfied. Why PO is getting satisfied? Because control is transferred. Once PO is getting satisfied, then I'll be recognizing the revenue. So generally people will say once PO is satisfied, recognize the revenue. PO satisfied means automatically control has been transferred. That is the logic. Anyways, you'll understand it once I go to the last step. Chalo. Now the first example is clear right now. Are we done with this slide? Let's move on to the next example. Now look at this. There is a combo of product A and B. Transaction price is 24,000 for both the products A and B. Okay. SSP is given. Then you have total SSP. Since the combo price is lower than SSP, obviously what you will do, allocate the transaction price. These two are two POs. So allocate it in the ratio of SSP. So what you will do, 24,000 into 18,000 divided by 30,000. This is 24,000 into 12,000 divided by 30,000. That's what we have done. And the difference is discount. Clear. Okay, nothing much to study. But continuing this example, now this is interesting. Now this you focus. Continuing from previous example, there is a reason behind continuation. See here. SSP of product A is 18,000. Here also 18,000. Product B is 12,000. Here also 12,000. This is small bundle because only two products are there. This is big bundle because I'm going to add one more product over here. Okay, product C. Now see what's happening. For this small bundle, the combo price is 24,000. If you add SSP, the total is 30,000, which means there is a discount of 6,000. That's what we have got here. Correct? If you look at the big bundle, after adding product C, the transaction price is 44,000. If you calculate the discount, again the discount is 6,000 only. This is a very important point to note, which means a small bundle of two products has got a discount of 6,000, which is A and B. After adding A, B and C also, the discount is still 6,000 for a bigger bundle, which means literally C does not have any discount. That is the logic. For A and B, the discount is 6,000. For A, B and C, if the discount is 6,000, C does not have any discount. Therefore, you should not give any discount to C. If you look at the allocation, look at the allocation, 18,000. Okay, how much is the allocation? 14,400. Earlier also 14,400. This is 9,600. Same stuff. And for C, we did not give any discount C because that 6,000 should be allocated only to A and B. Got the point? So look at the analysis here. Product A, B and C are distinct performance obligations. But the discount on larger bundle, which is A, B and C, is exactly equal to the discount already observable on the smaller bundle, which is 6,000 in both the cases. So then what Ind AS 115 says is that if the discount is entirely attributable to one or more specific performance obligations and the evidence exists from observable standalone bundles, then entire discount is allocated only to those specific performance obligations, which means what you have to understand is that for two products the discount is 6,000. By adding the third product also still the discount is 6,000. Then literally third product has got no discount. So therefore you should not give any discount. That's the logic. Simple. That's all. So discount is allowed only to A and B. C is priced at standalone selling price. So the key point is when a discount on a larger bundle is same as a discount on the smaller bundle, the entire discount is allocated only to the goods in the smaller bundle. Simple. Done? Okay. Now let's try to understand what is SSP first, because we are discussing about that only. In step 4, we are saying that allocate the total transaction price in the ratio of SSPs. Now the question is, what do you mean by SSP? If SSP is directly given in the question, then very simple. That's what we call it as observable price of the good or service, where if the entity regularly sells a particular product or service, then obviously you will know it's SSP. You got the point? But sometimes SSP will not be available. SSP will not be available means then we need to calculate. Now the question is how to calculate. That is what we're gonna see. You can see that we are talking about estimated price of good or service. Here we'll see how to calculate the SSP. But first of all, let's try to understand what is SSP. Standalone selling price is the price at which entity would sell a promised good or service separately to the customer, individually. That's why it is called stand alone. Stand alone, alone, separately, individually, it will be sold to the customer. Either a good or service. Okay. Why SSP is important? Because it's a fair price, as simple as it. It provides an objective basis for allocating the transaction price, ensuring that each PO receives its fair share of total consideration, total transaction price. That's why total transaction price is allocated in the ratio of SSP. Now, how to find SSP? Obvious question. Generally, it will be given in the question. Given in the question is nothing but observable price. That's what we have seen here. Okay. But if it is not given in the question, if it is not directly observable, then we need to calculate. We have to estimate. How to do that? That's where we come to the second point. Estimated price of the good or service. Okay. If the standalone selling price is not directly observable, in other words, it is not directly given in the question, then you need to estimate. Now, how to estimate? For that, we have certain methods. First one, adjusted market assessment approach, expected cost plus margin approach, residual approach. In this, residual approach is important. Okay. Let's start with the first one. Now look at this, Nana. When it comes to adjusted market assessment approach, what happens is that, to put it very simple, you do not have your observable price. So you don't have SSP straight away. It is not given in the question. So now we need to find out. How to find out? Very simple. Look at your competitor's price. That's all. And if your product is exactly identical as your competitor's product, then copy paste the price. That's all. That will be your SSP. Suppose if your product is not identical, but it is similar, which means there are some changes, then adjust for the changes and then have your market price, which is nothing but SSP. That's why it is called adjusted market assessment approach. For example, look at this. TCS, everybody knows TCS. Cloud HR solution is a kind of service that it is offering. Okay. It does not have any SSP, right? So what it does is TCS will observe the price of similar cloud HR solutions offered by the competitors. For example, you can see Oracle, similar kind of a cloud HR service, which is being priced at 45 lakhs. SAP, which is similar kind of cloud HR solution, which is being priced at 50 lakhs, for example. Now, what TCS does is that, okay, fine. When compared to these products, let us see our product is either superior or inferior. It feels that our product is superior when compared to the product offered by Oracle. However, our product is little bit inferior when compared to SAP. Then it means your SSP has to be in between 45 lakhs and 50 lakhs. And that's how it has been priced at 48 lakhs. As simple as that. This is what we call adjusted market assessment approach when observable price input is not available for SSP calculation. So, evaluate market prices of similar goods or services offered by competitors. It is similar. If it is identical, you'll just copy paste. Generally, it will not be identical. It will be similar, which means with some changes. Adjust for entity specific factors such as brand, quality and geographical advantage. If competitors sell similar software for 5 lakhs and your product is more advanced, probably you can have your SSP more than 5 lakhs, say for example 5.5 lakhs. When compared to this is a real life example which I gave you. I hope this is clear. So if observable price input or SSP is not readily available, then you will estimate the price of the good or service as the case may be. In that, the first method is adjusted market approach. Got it? You can just remember it as adjusted market approach. It's easy to remember rather than adjusted market assessment approach. I hope this is clear. Chalo, moving on to second one. This is even more simpler. Expected cost plus margin approach. Okay. Even that is also not working out. Simply look at your cost, add your profit margin, you get your selling price. That's all. If it cost 8,000 to manufacture and usually your profit margin is 25%, 8,000 plus 25%, that will be your SSP. That's all. Got it? 1/4 of 8,000 is 2,000. Your SSP will be 10,000. Pretty simple. And this is important from problems point of view out of all the three approaches. Okay. Important for solving questions. All right. What is this residual approach? Okay. Now, when it comes to this residual approach, you will not know it straight away. So what I'll do is that let's go to an example. From that, we'll try to understand. Look at this example. Okay. I'll write here residual approach. Ready, Nana? Easy only. It's not difficult. An entity sells 4 distinct products A, B, C, and D for a total transaction price of 60,000. All right. Ignore dollars. The SSP are available for A, B, and C, but not available for D. All right. So standalone selling price and discounts, it will be given in the question. Okay. 18,900, 18,900, 12,600. But product D SSP is not available. But total transaction price is given, which is 60,000, which means we'll find SSP of product D as a balancing figure. So what we'll do, usually we'll go with the same columns, product, SSP, discount, allocation. You know the SSP and discount. For first 3 products, SSP, discount, SSP, discount, SSP, discount, copy paste. You get your allocation, right? Allocation of TP for first 3 products. You know total transaction price is 60,000. Then automatically this will be calculated as a balancing figure. Got it? So which means as per residual method, your SSP of product D is nothing but total transaction price minus the total of allocation of all the remaining products. As you can see here, 60,000 minus 17,100, 17,100, 11,400, you got the answer. You got it? Chalo, done with this. Now, sometimes there will be a range that will be given for a particular product. Sir, what do you mean by range, sir? See here. Here, for product D, is there any range given? No. So in that case, whatever the balancing figure that you get, that will be the value of D. Value means I'm talking about SSP. Okay. Sometimes for D, range will be given. Look at this example. Continuing from the previous example, you have 4 distinct products A, B, C and D. SSP available for A, B and C. SSP not available for D. Same stuff. Total transaction price is given. How much is that? You have 60,000 and total allocation to A, B and C is 45,600. Same like previous case. Okay. Which means usually what you'll do 60,000 minus 45,600 balancing figure for residual, for product D. That will be your residual method. You got how much? 14,400. Fine. But there is additional condition given in the question. What is that? The range constraint for product D is given in the question as 12,000 to 22,000. In that case, you need to just check one more condition. Sir, what is the answer that you have got? 14,400. Is it within the range? Yes, which means the answer is correct. If you look at case 2 scenario, the range is given as 12,000 to 22,000, whereas the answer that you have got is 24,400 as balancing figure. So that is outside the range. Therefore, that cannot be called as a SSP. So when there is a range constraint that is given, the ultimate balancing figure that you calculate should be within the range. If it is within the range, it is correct. If it is out of the range, then you cannot use that particular method, which means residual method you cannot use. So look at the conclusion. Residual amount exceeds the observable SSP range, which is 12,000 to 22,000, but you have got 24,000. As per Ind AS 115, residual approach cannot be applied blindly. Allocation to product D must be restricted to its range. Entity must reassess SSP estimation or use another suitable method. 2 more methods are there, na? Adjusted market assessment or expected cost plus margin method. You can use it. But in this case, because it is outside the range, residual approach is not appropriate. So for the purpose of exams, this is the summary. Residual approach can be used only if the resulting allocation, that is balancing figure, lies within the range. If it does not lie within the range, then this method will not apply. You go for the alternative method. Simple. That's all. Are we done? Right. Fantastic. Then there is one more point, that is special variable consideration. What is that? Look at this. Look at this example. Entity is selling 3 distinct products A, B and C at 30,000 to customer. SSPs of all the 3 A, B and C are there. But here comes a special point. Also, there is a variable consideration of 800 on product C, which means this consideration should be given only to product C. So now what you will do, you take this allocation, you allocate to A, B and C in the ratio of SSP, which means you take the transaction price, which is 30,000 into 15,000 divided by the total of this, right? You will do the allocation. Like that you have allocated 12,500, 7,500 plus 10,000. But after that, what you need to do is that this variable consideration of 800, because it specifically belongs to C, you should be adding it to C separately, and thereby the allocation of TP for C eventually becomes 10,800 and the total allocated transfer price of all the 3 products becomes 30,800. This is one new point. All you have to remember is add that separately. That's all. That's what we have discussed here. Allocation of variable consideration. Variable consideration like performance bonus or penalties should be allocated only to that performance obligation to which it specifically relates. In this case, this specifically relates to product C. So therefore, you should add only to product C. Got the point? That's what we have given here. Right? Allocation of discount allocation, those things we have already covered. So with this, we are done with step 4. So when it comes to step 4, it's very easy, and all you have to remember is you have to allocate it in the ratio of SSP. SSP will be generally given in the question. If it is not given, you have 3 methods. In that, the first method is adjusted market assessment method. The second method means cost plus profit margin. These two are not that important. The third method, residual approach, is very important. In that case, what you'll do, you'll find it as a balancing figure, and you see whether there is any range constraint. If there is a range constraint, it should fall within the range. Then there is no problem. If it does not fall within the range, then that method will not suit. You have to go for alternative 2 methods. That's the only way you can find SSP. Ultimately, the summary is you need to allocate your transaction price, total transaction price, in the ratio of performance obligations, in the ratio of SSP to the performance obligations that you did find out as a result of step 2. So ultimately, the summary of step 4 is where you try to match step 2 with step 3, where you take the total transaction price, allocate that in the ratio of SSP to all the performance obligations that is available as a result of step 2. Got it? Done. So now we're gonna go for last step, that is recognition of revenue. All right, guys, let's continue with the revision session. In the last session, we have seen it till step 4, right? Now let's look into step 5. Fadafat will go. Anyways, what is step 5? The last step is recognizing revenue. That's obviously. Now the question is how to recognize the revenue. Very simple. Whenever a performance obligation is satisfied, in shortcut we call it as PO. When PO is satisfied, at that particular point of time you have to recognize the revenue. Now the question is why PO satisfaction is very important, because when I say PO is satisfied, it means control is transferred, whether in case of goods or in case of what, services. So when I say PO is satisfied, it means control is transferred. So when control is transferred, PO is satisfied, and thereby you can recognize the revenue. This is what you got to remember. Okay, now the next question is, okay, fine, PO gets satisfied only when control gets transferred. Now the next question is when transfer of control happens. Obviously, that is why we're going to discuss transfer of control. Now transfer of control can happen two ways, either over a point of time or over a period of time or at a point of time. Now the question is, over a period of time means what? This is important because over a period of time is specifically given. So as you can see the criteria, any one, if any one of these conditions it fits in, then your transfer of control happens over a period of time. It is specifically given. 3 scenarios. If your transaction does not fit into any of these 3 scenarios, automatically it becomes at a point in time. If none of the above criteria apply, revenue is recognized at a single point of time. Are you able to understand? So which means the definition for transfer of control at a point of time is negative. The definition for transfer of control over a point of time is specific. 3 specific situations are given. If your transaction fits into any of these situation, any of this scenario, then transfer of control happens over a period of time, which means PO gets satisfied over a period of time, which means revenue should be recognized over a period of time. If it does not fit into any of these criteria, your so-called transaction between the customer and the entity, then automatically transfer of control happens at a point of time, which means PO gets satisfied at a point of time, which means revenue has to be recognized at a point of time. I hope this is clear. Yes? All right, fantastic. Now, let's look into these 3 specific scenarios. Customer simultaneously receives and consumes benefits. Cleaning services, payroll processing, maintenance, cable TV, security. This particular point we have already seen in step 2 when we were looking at the definition of PO, right? There are certain services where you'll be doing the same service again and again over a period of time for a whole year, like Netflix subscription or cleaning services, pest cleaning, whatever it is. Sorry, not pest cleaning, housekeeping. Okay. Now the point is because they do the same thing again and again over a period of time. So every single day you can't call it as a separate PO, right? So therefore we said that the entire year will be taken as a one single PO. So we are talking about pretty much the same kind of a scenario where customer simultaneously receives and consumes benefits. Netflix subscription is there. You consume the benefit every single day. The service is getting received by you as and when you watch, right? Same goes with payroll processing. Same goes with maintenance. Same goes with cable TV. Now nobody is using it. Anyways, same goes with security services for your apartment. Got it? Right. So this is very easy. Nothing much is there in this. These two are relatively important. In this specifically, the B point is important. Let's try to understand what is B point. Okay, we'll do one thing. B point will come at last. First, let's cover C. Asset created has no alternative use to the entity and the entity has right to payment for work done. Sir, what is this, sir? I'm not able to understand. Very simple, Anna. Sometimes you try to do customized service or customized any construction services for a particular client, for a particular customer. Now when you're doing customized services or customized any sort of a thing that you're building which is customized, there is always a risk that if the so-called customer tries to cancel the contract midway, then whatever the work that you have done goes waste, right? And you have to recover the cost that you have incurred. So thereby, in these kind of scenarios, there will be a particular clause which says that in case if there is cancellation on behalf of the customer in the middle, then whatever the cost that I've incurred so far as an entity plus a little bit of profit margin on that should be compensated. So because of this clause, because of this condition, this scenario, this particular transaction, customized building of services or goods, whatever as the case may be, falls under transfer of control over a period of time. I'll show you an example. You can see here. Just a second. See, Rana. Infosys builds customized payment software for SBI. Okay, highly customized for SBI system. So which means it cannot be sold to anyone else. Okay, there will be a sentence in the contract between Infosys and SBI that if SBI cancels the contract, because SBI is the customer over here, midway, Infosys gets cost plus a little bit of margin. Because of this, control is transferred over a period of time, not at a point of time. You understand the point? Because of this condition. Therefore, what you guys need to understand is that it's a specific scenario, it's a customized scenario. The moment you see such a kind of scenario in the question, you know that, okay, transfer of control is happening over a period of time, which means your PO is getting satisfied over a period of time, which means revenue has to be recognized over a period of time. That's it. Now, what is important for us out of these three is the second one. Customer controls the asset as it's created or enhanced. For example, construction contracts. Based on this only, we have all this input method, output method, and all that stuff. We'll see that. Now, let's get to the example. Look at the example, Nana. So, for example, L&T builds a particular warehouse for Amazon. So, L&T is the entity, Amazon is the customer. Okay. Amazon supplies design, but at the same time, Amazon owns the warehouse under construction, correct? Right? L&T's job is just to build. And for building, it will get something from Amazon. But who owns it eventually? Amazon, right? So that is the point that we have written here. Customer controls the asset. Amazon controls the warehouse as it is created or enhanced. Got it? Chalo. All right. Now, if any of these three specific scenarios, if your transaction doesn't fit in any of these three, automatically it will be what? Considered as transfer of control at a point of time. There ends the matter. Now, let's focus on these areas. Okay. So, in these two scenarios, basically what's happening is that you are actually constructing big projects, right? So, when you are constructing big projects, and we have already seen here that transfer of control happens over a period of time. As a result, PO gets satisfied over a period of time. As a result, revenue has to be recognized over a period of time. Now the question is how to recognize the revenue. Now you can't recognize obviously the total revenue. So you need to recognize revenue based on the percentage of work completed or the measurement of progress, which we can call it in other words. Now the question is percentage of work completed, how to find. For that, we have two methods. This holy trinity already I told you, right? Output based method, input based method. These are all the two methods that we have got to find out percentage of work completed. Now the question is, what is the difference between output based method and input based method? Very simple, Anna. Output based method means you are trying to calculate the percentage of work completion from the point of view of revenue creation. Okay, revenue creation. So cost plus profit, that particular point of view. When it comes to input based method, this is purely based on cost. If you look at the formula also, you'll understand. For input based method, it's very easy. Percentage of progress is what? Cost incurred till date divided by total estimated cost. Very simple logic, na? If you're estimating the cost to be 100 CR and you have incurred 30 CR so far, 30% is what? The work completed, I mean percentage of work completed. Although there are a lot of twists and turns here that we will see later. Right now, this is the basic idea, correct? When it comes to output based method, what is the situation? It's from revenue point of view. If you can see, fair value of goods or services transferred. What do you mean by fair value? It includes the profit margin as well, divided by total fair value. That is nothing but market value into 100. So in a way, this is cost incurred till date divided by total cost that I'm expecting to incur into 100. Here, revenue that you have earned till date divided by total revenue you are expected to earn. In a way, it is like that, right? In a way, it is like that. Please try to understand. I don't know whether you are able to understand my sentence over here. Anyways, now you can ask me, why is that they are going with fair value of goods or services divided by total fair value? How can you find fair value? See, fair value you can find only with respect to output. That's why it is called output based method. Now the question is, what kind of output? That's what example I've given in brackets. Units delivered, milestones delivered. Sir, can you give me examples so that we can we can understand output based method? All right. So I'll just go with few examples over here. See here. You need to understand what do you mean by milestones achieved. Okay, for example, L&T is the entity. Okay, it builds metro station for government. Who is the entity? L&T. Who is the customer? Government. Okay, now in the contract, it has been mentioned clearly by the government that I'll make you payment based on the milestones that you achieve. Now the question is, what do you mean by milestones? For example, foundation completed. Government promises that in the contract 20% of the value will be given to you of the total value. So here we are talking from revenue perspective only, or in a sense fair value perspective. So it is not from cost perspective. That's what you need to understand. Structural framework, if it is completed, I'll give you 30% of the value. Utilities or roofing is completed, I'll give you 30% of the value. Finishing or commissioning is done, I'll give you 20% of the value. Now this is what is there in the contract. Now let's say in reality, say after 2 years, foundation is done, structural framework is done, which means relatively how much percentage is done? 20 plus 30, which means 50% is done, which means 50% will be transferred, which means it will be considered that 50% of the work has been done or 50% progress is done. You understand the point? Got this? Okay, one more example. PK Limited is a contractor. In the contract, it is like this. Design, if it is done, I'll pay you 20 crore. Supply equipment, 50 crore. Installation and commissioning, 30 crore. Total fair value is 100 crore. Till today, if you see, design part is only completed. What is the fair value of that? 20 crore. So 20 crore divided by what is the total fair value of the work? 100 crore. 20% is the measurement of progress of work. That's all. Simple. Is that clear? So I gave you this examples only to understand the wording over here. What do you mean by output based method? It can be units delivered. It can be what? Milestones delivered. It can be anything. That's why the word used is output. Anyway, from problems perspective, this is not that important. Input based method is important for us. Right. One more sentence I've written here. Goods or services transferred to customer as of today relative to total goods or services promised. However, we talk from the point of view of the fair value, which obviously includes the profit element. Here that profit element will not be there. We talk from the point of view of only what? Cost. That's what makes input method different from output method. But when it comes to problem solving perspective, which is more important for us, input based method. Okay. When it comes to input based method, what is the measurement of progress? Very simple. Cost incurred till date divided by total estimated cost into 100. All right. It sounds very simple. Yes, it sounds very simple, but there are certain twists. What are that? Exclusions from cost in the above formula. Okay. What are they? Abnormal loss and wastages are not included. They're totally removed. They're totally removed. The logic is very simple, Nana. Abnormal loss and wastage is your inefficiency. Okay, if your competitor does not do any inefficiency, then you and him cannot actually do business. You having inefficiency, then accordingly your cost will get inflated, accordingly your selling price will be inflated. You will not be able to actually do business. Thereby, when it comes to abnormal loss and wastage, that will be totally removed when it comes to percentage calculation over here. Is that clear? However, this is the twist. Cost of major components delivered but not yet installed, like elevators and stuff like that, will be removed initially. Initially, when you are calculating this particular formula, when you're using this formula, it will be removed from both numerator and denominator. Numerator is cost incurred till date, denominator is total estimated cost. As well as from transaction price also it will be removed. Later, again it will be added back. Sir, what is this, sir? Why is it? See, the logic is very simple because you did not do any value addition when it comes to, see, for example, understand, when you try to build big projects like, for example, gated communities and stuff like that, at the beginning itself, they'll buy all these elevators. But then unless the entire structure is done and that elevator is ready, once you install it and then do all the other stuff like programming and stuff like that, then only the value addition you're doing. So as a contractor, what is the value addition that you have done? If you have just purchased elevators and kept it in the site, there is no value addition that you have done. Na? You understand the point? Therefore, to the extent of cost of elevator that you have incurred, that I'll reimburse. That you can add. But upon that, you cannot enjoy any profit margin. That is the logic over here. You understand the point? Because what is the reason behind finding out percentage of progress? Say, for example, after putting this formula, if you get percentage of progress as 40%, what we will do is, we'll see total revenue and then we multiply with 40% and that much revenue will be recognized. You understand the point? So therefore, if you add the so-called, what is this elevator, then that will increase this 40% work completion to 50%. In reality, you did not do any work. You just purchased elevator and you kept it like that. And then you will be recognizing 50% of the total revenue, which is wrong, na? Because you did not do any value addition on elevator, na? You understand what I'm trying to say? Yes, that's the point over here. So, cost of major components delivered but not yet installed, example, elevators purchased and delivered but not installed in a building project, will be removed from both numerator and denominator and transaction price. Later it will be added. Sir, what do you mean by that, sir? I'll show you a solution here so that you'll get clarity. See here. Input based method, okay? Percentage of progress, cost incurred till date divided by total estimated cost into 100. This number will be given in the question. You got 20%, okay? Revenue to be recognized. Total transaction price without elevator. Got it? So you'll remove the elevator, you'll take total transaction price without elevator, you multiply with percentage of completion. So total is 35 lakhs into 20%, you got 7 lakhs. Then cost of the elevator will be added. Now the total revenue to be recognized is 22 lakhs. What it means is, in this, there is profit element. Why? Because you have worked something as a contractor and you deserve the profit. Are you able to understand? Because you have done some value addition work. Whereas when it comes to elevator, you did not do anything. You have yet to install that and do all those programming, that, this, and everything. You need to sync it now with the building, all those things. You did not do anything. There is no value addition from your part. However, because you have incurred expenditure and it's a capital component, it's very costly. Therefore, I will reimburse the cost. So to that extent, it will be added back to the so-called 7 lakhs, and ultimately 22 lakhs will be recognized. Do you understand the point? See, there is a difference between treatment of abnormal loss for inefficiency as well as the elevator cost. Abnormal loss will be totally ignored. When it comes to elevator, it will be ignored initially and later the cost will be added back. That's what we have done over here. So I gave you that clarity over here. See here. Students, doubt cleared, because many students have asked me this. Types of cost and treatment. Normal construction or service cost included in percentage of progress. Abnormal loss excluded completely. Major component like elevator, turbines, they are high value, distinct and delivered early in the project, excluded from percentage of progress, but after that cost of them will be added back. I hope this is clear. Right. Are we done with this? Yeah. Now, let's look at examples from your problem solving perspective. Output based method. PK Limited enters into a contract to construct a customized software system for a client over a period of 12 months for total contract price of 20 lakhs. PK Limited determines that PO is satisfied over time, obviously, because it is customized software system, right? We know that over here, it fits into the third category. Now, and it chooses to use output method to measure progress based on the milestone achieved. Okay. That output method milestone completion is given. Design phase, it will take 4 months. Percentage of completion is 40%, which means out of the total transaction price or contract price, which is 20 lakhs, 40% will be recognized as revenue. Simple. After 9 months, another 35% development phase work is done. So 20 lakhs into 35%, that will be recognized. And after 12 months, 25% testing and development is done. 20 lakhs into 25% will be recognized. That's all. Very simple. You just see the percentage of, this is not cumulative percentage of completion, Anna. This is individual percentage of completion with respect to the respective works. Got it? Input based method. PK Limited enters into contract for construction of warehouse for customer. Contract price is 50 lakhs. Total estimated cost to complete is 45 lakhs. Cost incurred till date is 18 lakhs. PK Limited uses input method to measure progress. Very simple. Cost incurred is 18 lakhs divided by total cost is 45 lakhs into 100, 40%. So the revenue total transaction price is 50 lakhs. 50 lakhs into 40% will be recognized as revenue, which is 20 lakhs. That's all. Because this is a small example, I did not include all those elevator and all that stuff. I hope this is clear. Done? Everybody? There are certain special notes over here, Nana. Calculation of amount due from to the customer. It can be contract asset or liability depending upon that. See, because what happens, these are all big projects, Nana. So you calculate this input based method, output based method, and you know that this much revenue is recognized, and you expect that much of cash to be received from the customer. But usually it will not match now. Either customer will pay more or customer will pay less when compared to your revenue recognition, right? So in that case, you'll be having either contract asset or liability. For example, cumulative revenue recognized till date, say for example 40 lakhs according to your calculation based on input method or output method. Okay. Payments, cash payments received from the customer is, say for example 35 lakhs. Then you need to further received 5 lakhs, which is nothing but due from customer. So if it is due from customer, that much you need to receive. So obviously it becomes a contract asset. That's all. Or in simple words, debtor. Suppose you have done only 35 lakhs of work. In the sense, 35 lakhs of revenue is recognized in your books, but you received 40 lakhs from the customer. Then it is negative balance. 5 lakhs, you have received more from the customer. So whenever you receive more from the customer, always we see it as a liability, because if something goes sideways, you need to pay it back. Therefore, it will be seen as a contract liability or the income or revenue that you are yet to earn. Simple common sense. Nothing much to discuss over here. Clear? Right. Moving on to next one. Calculation of work in progress. Now, calculation of work in progress, what is the situation over here? Work in progress means capital work in progress is what we are talking about, right? Work in progress represents the cost of work done that hasn't been recognized as expense or when revenue is yet to be matched. Cost incurred till date less cumulative cost recognized in P&L till date, the balance will be WIP asset. For example, if 5 lakh is the cost incurred but only 4 lakh is allowed to be debited in P&L account, 1 lakh will be shown as WIP asset. Whatever that you incur, everything will not be allowed to be debited in P&L account. Please try to understand. It's not that important, just a point to note. That's all. All right, so with this, we are done with all the 5 steps revision In a very quick time, we have done it. So now we'll go for special cases. Let's look at the next case, Nana. Principal versus agent. All the 5 steps are done. The major part of the Ind AS 115 is done. Hereafter, we'll be going with some special cases. Okay. In that first, we'll start with principal versus agent. Now, look at this. Let's say there is an airline company. Okay. So first, the airline company name is, let's say it is PK Limited. And this PK Limited is a travel agency. Now, what this PK Limited does is sells tickets on behalf of airlines and receives commission of rupees 500 per ticket sold. Selling price of the ticket is, say for example, 10,000. Now the point that you guys need to observe here is who bears the risk of not selling tickets? Airline company. Who fixes the selling price of the ticket? Airline company. Everything is decided by airline company. The travel agency just receives commission for a ticket that is sold. There ends the matter, that's all. And that is flat 500 per ticket, which means here the kind of relationship that the airline company and the travel agency have got is airline company is principal and travel agency is agent. Simple, that's all. Entity does not bear inventory risk as well, nor has discretion in setting prices. Inventory risk means inventory of tickets I'm talking about, okay? Nor discretion in setting prices means, discretion means your choice. You cannot set ticket prices at your choice, na? You means I'm talking about travel agency, which is PK Limited. Whatever the selling price that is being set by the airline company, PK Limited has to just follow and sell at the same selling price. You got the point? All it will get is commission. So in this case, the relationship between the airline company and the PK Limited is a principal agent relationship. Got it? Now, in that case, obviously, airline company, what it will do? It will recognize the entire revenue of the ticket. And for that, commission will be recognized as an expenditure, as simple as that. When it comes to PK Limited, because PK Limited is agent in this scenario, its revenue will be only commission income, as simple as that. So it's a very simple scenario here. Now, this is interesting. See here. In this case, if you look at PK Limited, what is happening? PK Limited purchases tickets from airline company in bulk at reduced rates. You understand the point? Like for example, 1,000 tickets, 10,000 tickets, whatever the quantity as the case may be. First, PK Limited will buy it from the respective airline company, Indigo or whatever it is. And then he will sell at his discretionary prices. Whatever the price he feels like. You got the point? So buy specific number of tickets, so which means you have inventory risk. Suppose if tickets go unsold, in that case you need to bear the risk. Pays for those tickets even if not able to sell them. That's what we call inventory risk. Entity determines price at which the ticket will be sold to the customer, which means you have independence. This travel agency in this scenario has got independence. Thereby, in this case, the relationship between airline and the travel agency PK Limited is principal relationship. That's what we have written here. Now, in case of principal relationship, how to recognize the revenue? Very simple. See here. If your role is principal, then just recognize revenue on gross basis. That's all. As simple as that. Whatever the amount that you collect from the customer, that will be your revenue. Got it? Chalo, fantastic. Of course, the cost of purchase will be your cost. As simple as that. Because you have bought tickets, na, that will be your cost. And whatever you are selling to the customer, that will be your revenue. As simple as that. Revenue minus cost is your profit. So that's what I've written here. I hope this is clear. So I will not be getting into all these details because already the concept has been explained. You can see the indicators that an entity is a principal. Primary responsibility will be there. Inventory risk will be there. Pricing discretion will be there. If all these qualities are there, then the entity is referred as a principal, which we have seen in this case. So thereby I'll not be covering this again because it's a revision session, Nana. We need to cover ASAP. I hope this is clear. Chalo, moving on. The next concept is non-refundable upfront fee. It's again another special case scenario. So what is this? Let's try to understand with this example. See here. Suppose customer joins gym and it charges joining fee, which is non-refundable. How much? 4,000. It's a kind of one-time fee. Okay. Plus membership fee is 12,000 for 12 months. All right. Total you have to pay 16,000. Now, we are talking about this 4,000. Now, the focus is on 4,000. Now, see here. Case 1. For this 4,000, whatever you have paid as a joining fee for the gym or one-time fee, as the case may be, whatever you call, gym kit is provided by the gym, which includes t-shirt, bag, bottle, and all those things. So from this, what you have to understand, this 4,000, whatever you have paid for that, are you getting any distinct service in return? Yes, I've got some distinct goods as well as some distinct service. So 4,000 is not just like that. For that, I'm getting something in return, which means because you're getting some sort of distinct service or good in return, this 4,000 will be treated as separate performance obligation. Got it? And because that separate performance obligation, in a way, transfer of control of these goods did happen on day one itself, which means PO for this particular 4,000 got satisfied on day one itself. Therefore, to that extent of 4,000, you can recognize the revenue on day one itself. Clear? What about 12,000? This is service is being provided over a period of time. Na? Therefore, transfer of control happens over a period of 12 months. Therefore, PO is satisfied over a period of 12 months. Therefore, revenue should be recognized over a period of 12 months. Simple, that's all. Now, coming on to case 2, here, the same 4,000 you have paid, but nothing is given to you for that 4,000. In that case, you will not treat it as a single PO. So that 4,000 will be mixed with 12,000 and entire 60,000 will be treated as a single PO for gym. That's all. So therefore, 16,000 will be divided by 12 months. In that case, you will be getting 1333 per month. And in this case, your so-called transfer of control happens over a period of time for 12 months. And the PO is getting satisfied over a period of time for 12 months. And thereby, over a period of time for 12 months, revenue will be recognized. For 12 months, it is 16,000. So per month, it will be 1,333. So first month is done. This much of revenue will be recognized. Simple. That's all. Are we done? That's what I've written here. Clear? Chalo. Moving on to the next one. The next concept is sale with right of return. Let's look at this example. You'll be able to understand that. Now, the next concept is sales with right to return, Anna. Very simple. All these entries and the concept, everything, I'll try to explain you with the help of a simple example. Okay, see here. PK Limited sold 600 units of a product A to SK for 1200 each. Cost per unit is 900. 30 days is the return policy, which means before 30 days you can return. PK Limited expects 40 units to be returned. Now, what is the concept that we are discussing? Sales with right to return, which usually we do every day in Amazon and all the online, especially when we order clothes, right? Chalo, anyways, now in this case, the point is, even though you have sold 600 units, you have received money for 600 units, 600 into 1200, 7,20,000 you have received into your bank account. So you'll debit the bank account. There is no doubt in that. But the entire 7,20,000 cannot be recognized as revenue. The reason is you are already expecting that 40 has to be returned, which means to the extent of 40, you have to pay the refund. When you know that to the extent of 40, it will be returned and you need to make the refund, how can you recognize revenue to the extent of 600 units? So then, logically speaking, revenue has to be recognized to the extent of 600 minus 40, which is nothing but 560. Got it? So 560 into 1200, you'll recognize the revenue. And the balance 40 will be kept under something called refund liability, because you know that on the date of the sale itself, you know that 40 is expected to be returned, which means to the extent of 40, you need to refund. That's a liability on your part because you have an obligation to refund. So it's a refund liability. Got the point? This entry is very easy to understand. What students usually miss is this entry. Immediately, it should be followed by inventory or right to receive asset. See, when you create a refund liability, when you say that I have an obligation to repay the money back, the customers also have got an obligation to give you your asset back. Sorry, it's not an asset, inventory back, isn't it? You understand the point, right? So that 40 also needs to be returned. Na? So therefore, you have a right to receive the asset. Got it? In this case, I'm talking about inventory. Okay. So right to receive the asset, debit, how much? 36,000. Why 36,000? Because when I say right to receive, I need to debit that because it's an asset na inventory with its cost only. Now, what is the cost of the inventory? 900. So 900 into 40. So to the extent of 36,000 only, you can recognize the asset. Now you can ask me, sir, why are you recognizing the asset right now? Because the moment when the sale did happen, I'll be reducing the inventory stock because 600 units has left my godown and went out. To the extent of 600 units, I would have reduced the inventory. You understand the point? Now, because I'm expecting 40 units to be returned, to that extent, I have to increase. I have to make sure that that much of inventory will increase. That much of asset I need to recognize. You understand what I'm trying to say? So therefore, I'm recognizing the asset to that particular extent. And of course, to cost of sales. Because earlier you would have debited cost of sales. Now to set it off, you'll be creating cost of sales to the same extent. You got the point? Later, two things can happen. Nothing can be written. As you have expected, units are written. Now this is easy. As you have expected, units are written means what you will do? You will make the payment to the extent of 48,000 for which you have already created the liability. Once you make the payment of 48,000, which is to bank, automatically this liability needs to be cancelled out. Therefore, you will debit the liability. Job is done. Now, don't say that, sir, okay, sir, you have received 40 units. Now, to that extent, let's recognize the units or inventory because inventory also will increase by 40. No, that you have already done. So which means logically speaking, when you are putting this particular entry, only on paper your inventory has got increased by 40. In reality, you don't have that inventory increase. Later, once the return happens, physical stock will increase and then it will match with your paper entry or electronic entry, as the case may be. Are you able to understand? So that's why I've written here to clarify that doubt only. Physical stock will anyway increase, but you will not again increase it in the paper by putting an accounting entry. Why? Because you have already done that. So when you are actually passing out this entry, in reality, physically inventory did not increase because inventory is still with the customer. But because you have recognized liability expecting 40 units to come, you need to recognize the asset increase, inventory increase to the same extent of that 40 units. That's what you have done over here. I hope this is clear. Yes? Okay. Moving on. If nothing is returned, then you will cancel the liability. Okay. And you will recognize the revenue. Simple. And for this, you will put a reverse entry. Because expecting return only, you have increased the inventory. Na? If nothing is written, what you will do? You will decrease the inventory. Therefore, to inventory and cost of sales will be debited as an expenditure. That's all. Here, why are you creating cost of sales? Because already you would have debited when the sales did happen to the extent of 600 units. You got the point. But you know that 40 will be coming back. To that extent, you are trying to set this off. That's all. I hope this is clear. Right. Another small point which you'll come across when you're solving problems with respect to this particular thing is restocking fee. What do you mean by restocking fee? For example, if you look at this example, I'm just giving full refund. Full refund means 1200 is the selling price. Now, entire 1200 is being given as refund to the customer. Usually that will not happen because when customer opens the cloth, the garment, whatever it is, t-shirt or whatever it is, whatever the kind of dress it is, and tries to wear it down and then tries to return it back, then the packaging charges, all those costs will be there. Na? So to that extent, what the companies usually do is that it will not give you 100% refund. They'll not provide you 100% refund, like let's say 95%, 98% or something like that. In this case, the selling price is 1200. Let's say the restocking or repacking or shipping fee is 100 rupees. So they'll not be refunding you the entire selling price. They'll refund you only 1100. Which means what will be the changes in the entry that we have already passed? Very simple. To the extent of 100, your revenue will increase because to that extent, your refund liability has got reduced. Na? You know that for 40 units, you need to refund. Nana. Earlier, you'll be doing full refund. Therefore, your refund liability is 40 into 1200. Now, you'll not be doing full refund. Na? Therefore, your refund liability will be 40 into 1100. Simple. Now, where does this 100 go? Very simple. It will be added to the revenue. Because while doing the sale itself, you know that when the refund happens for the 40 units, I'll not be refunding the entire 1200. I'll be refunding only 1100, which means that balance 100 is revenue for me. So therefore, you add that. So in a way, this 40 into 100, which is 4000, has shifted from refund liability to revenue. That's all. When it comes to this entry, there will be no change. There will be no change because this entry is based on cost. This entry is based on cost. 40 into 900. 900 is cost per unit. So therefore, this entry will not change. Only this entry will change when there is restocking or repacking or shipping fee. I hope is this clear? Everybody? Right. Fantastic. Now, next concept is warranties, Nana. Very simple when it comes to warranty. All this stuff we'll try to understand from the examples here. Nana, when it comes to warranty, please try to understand that there are two types of warranty, okay? One is assurance type warranty, the other one is service type warranty. You need to remember these words, okay? If you can see here, assurance type warranty and service type warranty. Assurance type warranty means when you try to buy a car, say for example, Creta car you are buying, Hyundai Creta, whatever comes along with the car by default, we call it as assurance type warranty. Because it's a kind of assurance from the manufacturer na, that the Creta car will be good for at least 3 years. And then if you want, you can buy extended warranty for another 2 years by paying additional fees separately. That extended warranty, we call it as service type warranty. Am I clear? So let's take case here. In this case, you are buying laptop, okay, plus 6 months warranty. By default, it comes with the laptop, which is mandatory. So you're not paying anything separately for this warranty. Please try to understand. It comes with the product. Same in case of Creta, the first 3 years warranty. So thereby, you should be considering this entire thing, the warranty plus the laptop, the product, put together as single PO. Eventually, entire revenue will be attributable to the product. So which means, let's say this plus this, where warranty comes by default, we call this as assurance type warranty. Put together, it is 60,000. Entire 60,000 will be recognized as revenue on the day one itself. When the transfer of control of goods, that is laptop in this case, is transferred to the customer, transfer of control is done, PO is satisfied, revenue will be recognized, including the warranty as well. Got it? You will not be seeing this warranty as a separate PO because it's a assurance type warranty. It comes by default. You are not charging for it separately. Whereas, look at case B. Laptop and 6 months warranty, that is assurance type warranty. This is single PO that we have already discussed over here. So there is no denying the fact. But when it comes to 3 years extended warranty, if you are purchasing it specifically, because everybody won't do that, this should be considered as separate PO, which we call it a service type warranty. So then what you will do for both these things put together only, you have made the transaction price now. So therefore the transaction price should be allocated to these two POs. Now the question is, in what ratio you will allocate? We have already studied that in step 4. Allocate the total transaction price in the ratio of SSPs. So find out the SSP, standalone selling price of laptop, and extended warranty. In that ratio, you just allocate. Once you have done with the allocation of total transaction price, which you have paid for both this to laptop as well as extended warranty, laptop ka transfer of control happened on day 1 itself. Therefore, day 1 itself revenue will be recognized. Whereas for extended warranty, it will happen over a period of time. Therefore, you need to recognize that revenue over a period of 3 years. Simple. That's all. Got it? Everybody? Right. So with this, we are done with warranty, Nana. Chalo. Look at the next concept, Nana. Bill and hold arrangement. Now, the moment you look at this, it's a very unique thing. Why? Because I'll tell you, once we go with the example, you'll understand the concept. Okay. Let's say PK Limited entity is there. He's selling air conditioning to SK, who is the customer. Sale, billing, payment, everything happened on day 1 itself. But only thing that is missing is physical delivery. The customer says, I'll not be taking physical delivery now. I'll take it after 4 months. That is the problem. That's where all the problem comes. If he would have taken delivery on day 1, then everything is very simple. You would have recognized revenue on day 1. But if he takes delivery after 4 months, now the biggest question is, does it mean that transfer of control is happening after 4 months? Which means, does it mean I have to recognize revenue only after 4 months once the delivery actually happens? That is the first question. The second question is, this 4 months, I have to keep that asset with me, na? So do I need to charge any custodial services for the customer? In that case, how that has to be recognized? Which means whatever customer pays, in that a portion should be going for custodial services, remaining portion should go for revenue. So this is the confusion. So generally, sorry. Right. Generally, PK Limited may charge for warehousing, in essence, custodial services. Total transaction price, let's say it is 90,000. Okay. Now, what you will do, obviously, when the total transaction price is 90,000 and this is being charged by the entity both for product, that is AC, as well as custodial services, what you will do? You will say that, yeah, there are two POs. So obviously, you have to allocate the transaction price in the ratio of SSPs. So sale of AC, custodial services in the ratio of SSP. SSP of AC is 85,000, custodial service is 50,000. In this ratio, you try to allocate this 90,000. You get 76,500 and 13,500. Now the question is, 13,500, I know, because this custodial services is provided over a period of 4 months in this example. So over a period of 4 months only, I'll recognize this. There is no doubt in that. The problem is with respect to 76,500. What should I do? Should I recognize it on day 1 or I should recognize it after 4 months? Because physical delivery did not happen. So which means transfer of control of the good did not happen. That is the biggest question. So that is where when it comes to bill and hold arrangement, what you need to do is that you need to ask yourself certain questions. What is that? We are talking from entity's point of view. Now, this request to hold the delivery for 4 months or to deliver after 4 months is requested by whom? Is it a decision by PK Limited or SK Limited? Now, it should be at the request of the customer. That is first condition. And the second condition is, whatever the air conditioning specific unit which the customer has purchased, that should be marked and kept aside, and it should not be sold to anybody else. You understand what I'm trying to say? Look at the conditions over here. Customer requested the arrangement. It is not for seller's convenience. The product is identified separately and then ready for physical transfer, but it is kept separately and it is not sold to anybody else. See, generally when it comes to ACs, what is the same model, na sir? We'll sell it. When the customer comes after 4 months, on that day, similar kind of model, whatever the unit is there, the piece, that will be sold, means it will not work, Nana. You understand the point? That specific unit which the customer has purchased 4 months back, that should be kept like that only. You understand the point? So in that case, if these 3 conditions are satisfied, requested by the customer and that specific unit is kept aside and it is not sold to anybody else, then even though physical delivery did not happen on day 1, it will be deemed to be delivered. Deemed. We will imagine as if it has been delivered and we will recognize the revenue on day 1. But the most important point is 3 conditions should be satisfied. So customer requested the arrangement. The product has been identified separately and ready for transfer, and the entity cannot use or redirect the product for other customers. In that case, the control is deemed transferred and thereby you will be recognizing the revenue before the physical delivery as well. That's it. Are we done? Chalo. sale and repurchase arrangements, agreements, as the case may be. Sale and repurchase. This is not something new, Nana. This we have already seen in financial instruments. It's not something new. Once I start discussing this, you will automatically understand that this is not something new. We have already seen this in financial instruments chapter. Okay. Chalo, come to the example. Through the example, we'll try to understand. If you guys are ready, we'll start. All right, Nana. Now look at this example. There are two companies, PK Limited and SK Limited, two entities. Okay. Now, PK Limited on day one sold goods worth 25 lakh to SK Limited. There's nothing wrong in that. Once there's a transfer of control for the goods, immediately PO is satisfied. You'll recognize that as a revenue. Who will recognize PK Limited? Naturally, because it will get the revenue. However, there is a problem. After 1 year, PK Limited will purchase from SK the same goods which earlier it has purchased for 25 lakhs. Sorry, it has sold for 25 lakhs. Now it will again buy back for 30 lakhs. The same goods. Now why to eventually sell and why to buy again? You understand the point? Then this actually looks like a financing arrangement only. If you apply substance over form logic, goods are just like a security for you, isn't it? Like mortgage. So which means you're just keeping, this guy is just keeping the goods and giving you a finance of 25 lakhs, which after 1 year you are paying it with interest for 30 lakhs, and as a result you're getting your goods back. That's what is happening. Even though the name, the form that they are saying is that it is sales and purchase, that is a form. But if you look at the substance, it seems as if it is like a financing arrangement. Same concept we have seen in financial instruments as well. So therefore, this is just like a financing arrangement with goods as mortgage. Okay. Ind AS 109 applies here because that's what we have already seen this in financial instruments. Your repurchase price is 30 lakhs, your sale price is 25 lakhs, which means initially you got 25 lakhs money, you gave goods as a mortgage. After 1 year, you paid 30 lakhs, that is with 5 lakhs interest. Are you able to understand? And then you got your goods back because there is no more mortgage left over. So repurchase price is greater than sale price. In that case, you should be treating that difference of 5 lakhs between the sale price and the repurchase price as interest or financing cost. Look at the entry. First, because this is a financing arrangement, when you look at the substance, Ind AS 109 says you cannot recognize this as a revenue. Ind AS 115 also says the same. So as a result, once PK Limited receives 25 lakhs for selling the goods to SK Limited, which already has an agreement that after 1 year he'll purchase it back, then normally what will be your entry? Bank account to revenue, presuming that the transfer of control has happened. Okay, PO is satisfied. But now you can't write to revenue. You should be writing to financial liability because it is like a loan only, what he has taken. So loan is a financial liability because you have got an obligation to pay back. So bank to financial liability 25 lakhs. Then because you have to pay back 30 lakhs, extra 5 lakhs you need to add as an interest. So interest to financial liability, to that extent your financial liability will be increased. Already it is 25 lakhs. You'll increase it to 30 lakhs by adding 5 lakhs again. Correct? And then you debit the financial liability to bank once you are paying it back. When you're purchasing means you'll pay back the money. So obviously to bank and financial liability will be debited. As simple as that. So if you look at this whole setup over here, is there anything new that we have learned when compared to what we have already done in Ind AS 109? Nothing. Nothing. So whenever there is an agreement of sale and buyback, you need to understand this is the same concept, sale and buyback, which we have seen. Here it is with a different name, sale and repurchase agreements, which is nothing but sale and buyback. So when it is a sale and buyback and you're buying it at a higher price, then obviously it's a financing arrangement where you're paying what? Interest. As simple as that. So treat it what the Ind AS 109 says. So Ind AS 109 says treat it as a financial liability. Therefore, bank to financial liability, then interest to financial liability, then financial liability to bank. Simple. That's all. Once you make the payment. Easy peasy. Nothing is there. But this is interesting. But another example. This is interesting. Sir, what is this, sir? Here, the repurchase price is less than selling price. What is this? Repurchase price is less than selling price. Usually this happens. Here I've written goods. Here you see what I'm going to write. Now, are you able to understand the difference? If you are smart enough, you will be able to understand the difference straight away. Sir. Here you have written goods, sir. Okay, goods are like mortgage and it is a financing arrangement. Therefore, your repurchase price is greater than the sale price because you have to pay it back with interest. But here, in the place of goods, you have machine and your repurchase price is less than the selling price. Which means it is just like a lease. It is just like a rent. This Mokku fellow gave machine, and this Mokku fellow Nana has used the machine for 1 year, and as a result, machine ka value has got reduced. Therefore, he bought it back at a lesser price. Eventually, this guy received 25 and paid 22, which means in a way he received 3 lakhs, and this guy has spent 3 lakhs, which means just like a lease arrangement. Substance is lease arrangement, although the form, the name that you're calling it as sale and purchase of a machine. Understand the point? So how can you identify that? Very simple. Just compare the repurchase price and selling price. If repurchase price is greater than selling price, it is interest. If repurchase price is less than selling price, it is like a rent or leasing agreement. So this is a lease agreement, substance over form logic. So SK used PK Limited goods. Here I should not be writing goods. Let me write machine. Be able to sync well. Okay. Used PK Limited machine for 1 year. So PK Limited charges rent from SK Limited. In essence, that is 3 lakhs. So in that case, it is like a deposit liability. You have to treat it that way. Got the point? I gave you the machine, na? It is worth so many lakhs. For 1 year, if I'm charging rent itself as 3 lakhs, then what will be the worth of the machine? You can do anything with the machine, na? So as a deposit, I'm charging money. So deposit liability, why it is treated as liability from the point of view of PK Limited? I'm getting deposit only as a security for the machine that I gave it to you, which is worth more, even though your rent that you're paying is only 3 lakhs. So if you do something wrong with the machine, I'll hold this liability. You understand the point? But tomorrow, once you give the machine in its perfect form, then I have to repay that back. Now, therefore, it is called as a liability. But the purpose of liability is deposit, as a safety deposit for the machine that I'm parting with. You know, got it? So therefore, you're receiving 25 lakhs, but that is not revenue for you. And it is not financial liability. It's a liability, but it is deposit liability. So you have to be very specific with respect to liability. Okay, deposit liability. Then what will happen? This deposit liability has to be reduced because that guy is using the machine. That guy is using the machine. Financial liability will be increased because you have to repay that back with interest. Deposit liability will be reduced because that guy will be using the machine and therefore machine value reduces. Got the point? Therefore, reduce the deposit liability to the extent of rent. And finally, how much will be the deposit liability after reducing by 3 lakhs? Because credit is 25, debit is 3. So it has been reduced to 22. Then you have to repay back 22. That's all. So deposit liability debit 22 to repaying back, which is nothing but to bank 22. Simple. If you understand the essence, it's very easy, Nana. It's not at all complicated. This one is clear, these two. So only thing that you guys need to understand is that just compare the repurchase price with the sale price. If the repurchase price is greater than the sale price, it is interest. If repurchase price is less than the sale price, it is rent or lease. Simple. Are we done understood? I mean, very simple. Chalo, come here. This we'll see later. Let's look at this. Here, accounting in case of forward agreement and call option. Sir, what is this forward agreement? What is this call option? Okay. To understand that, come back here. Sale and repurchase agreements. Sometimes an entity sells goods but agrees or has an option to repurchase them later. That is there at the beginning itself. That's when you can find out that the substance of the transaction is different when compared to the form of the transaction or name of the transaction. Depending upon the terms, these can be treated as financing, that is the first case, leasing, that is the second case, or sale with return rights. Sir, what is that? Sir, that we will see later. Just wait. Types of arrangements, that is sale and repurchase agreements or arrangement, can be a forward agreement, can be a call option, can be a put option. When it will be regarded as a forward agreement, when it will be called a call option, when it will be called a put option. Very simple. Forward agreement means entity sells goods but promises to repurchase them at a fixed price. Here it is fixed price only, na? And this fixed price can be greater than the sale price or less than the sale price. Fixed price is nothing but repurchase price. So these both are forward agreements only. Both these are forward agreements. In the first case, it is a forward agreement, which is a financing agreement. In second case, it's a forward agreement, which is a lease arrangement. You understand the point? So entity sells goods. It has sold good. It has sold good, but promises to repurchase them later at a fixed price on a fixed date. Promises to repurchase at a fixed price. That's all. He is not mentioning that the price has to be high or low. It can be high, it can be low. If it is high, it will be a financing arrangement, forward agreement and financing arrangement. If it is low, it will be forward agreement and lease arrangement. Clear? So forward agreement can be financing or can be lease depending upon the fixed price, whatever that you have decided, whether it is greater than the sale price or less than the sale price. But in both the cases, forward agreement means what, Ray? Now itself you are fixing the future price. Did you fix the future price at the beginning itself? Yes. Did you fix the future price at the beginning itself? Yes. It's a forward agreement. Forward agreement can be taking a nature of financing arrangement or lease arrangement. That depends. That depends upon the fixed price, what you have already fixed, is greater than the sale price or less than the sale price. That's all. Is that clear? Is that clear? So both these example, what I've seen here is a forward agreement. In one case, it was a financing arrangement. In another case, it was a lease arrangement. I hope this is clear till here. Everybody, yes, just confirm me. Fantastic. Here, accounting in case of forward agreement. Forward agreement only focus. Repurchase price is greater than original selling price, then it will be a financing arrangement. Repurchase price is less than original selling price, then it will be a lease arrangement. So forward agreement can be financing, forward agreement can be lease. Simple, that's all. Is that clear? Now why I've written and a call option? Call option means right to buy. You are purchasing now after 1 year. You are purchasing now after 1 year. Call option means what? Right to buy. Right to buy. So PK Limited has got right to buy. PK Limited has got right to buy. And because it is in his control and already there is an understanding at the beginning itself that this is financing arrangement, therefore definitely he'll buy after 1 year. Therefore definitely he'll buy after 1 year. Because the right is with PK Limited and we are doing accounting from the perspective of PK Limited only. And he has got right to buy, so he'll definitely buy. And as a result, the accounting treatment will be same as forward agreement. That is nothing but what we have done here. So therefore, when I've written the heading here, forward agreement and call option, ultimately the accounting is same. Ultimately, the accounting is same because the right is within PK Limited. So if repurchase price is greater than selling price, the buyer has effectively lent money. So it's a financing arrangement. If repurchase price is less than selling price, the buyer is essentially leasing. Who is the buyer? Who is the buyer? Who is the buyer? PK Limited in both the cases because he's the one who is buying after 1 year. That's why he's called as buyer. Clear? Right. So when it comes to sale and buyback or sale and repurchase agreements, it is referred as forward agreement if you have agreed to buy it at a fixed price. If you agree to buy back at a fixed price. But that fixed price can be greater than the sale price, then it will be a financing arrangement. Less than the sale price, then it will be a lease arrangement. Clear? But no matter what, it is forward agreement. And in case of call option also, the treatment is the same because you have the right to buy. Who the buyer? Who is the buyer in our example? PK Limited is the buyer because he buys after 1 year. And if he has got right to buy, he'll definitely buy because the point is the arrangement is financing. So definitely he will buy at a higher price. Got the point? Here also definitely he'll buy. So therefore the accounting remains the same. Whether it is call option because it will be the right of the PK Limited or forward agreement. In both the cases, the accounting, the entries are same. However, put option is a little bit different. Put option is a little bit different. Why? Because in case of put option, the right will be in the hands of SK Limited. Understand the point? Let's see how this is going to happen. If the customer, because customer is SK Limited in this case, if the customer holds the right to resell the goods to the entity, so we are talking from entity's point of view, then it will be referred as a put option because if the option is in the hands of the entity, it is call option. If the option is in the hands of the other party, in this case it is customer, then it will be referred as a put option. Then the treatment depends upon what the other party is likely to do, isn't it? Because it is not in my control. In this case, this is the accounting that we will do because whether it is forward agreement or call option, it is in my control and definitely I'll exercise. You understand the point? Whereas when it comes to put option, I don't know what the other guy will do. He will exercise only if it's beneficial for him. Correct? Right. So if it is likely to exercise, so you have to start expecting what the other party will do, which is customer in this case. In my example, it is SK Limited. If I am anticipating, that is, if I am means PK Limited is anticipating that SK Limited is likely to exercise the option, which means PK Limited has to buy. Then it can be a financing arrangement or it can be a lease arrangement as the case may be, financing or lease. Then in that case, the accounting will be same. So if I feel in case of a put option that is right of executing is in the hands of the other party, which is out of my control, that is PK Limited. If PK Limited is anticipating that SK Limited will exercise, then you have to look into the repurchase price. If it is greater than, it can be a financing arrangement. In that case, the accounting will be like this. If it is less than, then it will be like a lease arrangement. So the accounting will be same. That's what we have written here. However, SK Limited is not likely to exercise. He is not willing to sell it back, which means PK Limited cannot buy it back. If you cannot buy it back, then the whole thing falls away. It should be treated as a genuine sale. Therefore, account as sale with right to return. That's all. Recognize refund liability. You'll recognize that because once he returns, you have to pay the money back. See, once you sell, PK Limited gets money. right? And put option is in the hands of the SK Limited. You don't know SK Limited will exercise the option or not. If he exercise, he'll give the goods back and I have to pay back the money. So therefore, it's a liability for me. So you understand that. So I'll receive money, so the debiting bank account, but then I have to recognize the refund liability. So once he returns the goods, then I have to pay the money back. Got the point? If he lapses the option, then only I get confirmation that he is not going to return the good. In that case, I can recognize that as a revenue. Therefore, it will be referred as sale with right of return. That's what I've written here in the heading. Sale with return right. So which means in forward agreement, in call option and put option where the other party is likely to exercise, the accounting is the same, which we have learned here. Again, I repeat, in forward agreement, in call option as well as in put option in which the other party is likely to exercise, the accounting is the same. Only in case of put option where the other party, that is in our case customer or SK Limited, is not likely to exercise the option, which means he will not return the goods, which means it should be treated as sale with right to return. Got it? And you will be recognizing a refund liability at the beginning when the sale eventually happens. So if the option lapses unexercised, customer does not exercise the repurchase or return right, the entity de-recognizes the liability and recognizes revenue. So revenue you should recognize after getting clarity that customer will not refund the goods. Customer will not return the goods. On that day when the option is lapsed in the hands of the customer, then only your sale is certain. Till that time there is uncertainty. Then what you will do? So what will be your initial entry? Bank account debit to refund liability. Then once the option gets lapsed and you're sure that now the sale has happened because the customer has no option to return, then you will cancel the liability because there is no more liability for you because you need not refund the money. Then you recognize the revenue. So refund liability debit to revenue. Clear? Are we done with this? It's a very beautiful concept. Okay. Out of all the special cases that we have seen so far, sale and repurchase agreements is interesting. Okay. Now we need to solve question number 66 and 67. If you guys are ready, we'll start. Come on, give me confirmation. Shall we go solving, Nana? Right. 66 and 67. Let's finish it off. Come to question number 66. Easy only. Once you know the concept, it's very easy. See here. An entity enters into a contract with a customer for sale of a tangible asset, okay, on 1st January for 1 million. Fine. The contract includes a call option, right to buy. Okay, that gives the entity the right to repurchase the asset for 1.1 million. Very simple. Call option, forward agreement, the treatment is the same. So repurchase price is greater than the sale price. So which means it's a financing arrangement. So what will be your entry? Initially, you'll be selling for 1 million. So bank account debit to financing liability. Very good. Then interest or financing cost to financing liability to the extent of 10 lakhs or 0.1 million. So that your financial liability from 1 million reaches 1.1 million. And then what you'll do, financial liability debit 1.1 million to bank because you'll be buying back where you'll be paying money. So to bank, that's all. Simple financing arrangement. Okay. Here you have the answer. Amount received shall be recognized as liability, that is financial liability. Difference between sale price and repurchase price to be recognized as finance cost or interest. That's all. Very simple. Done and dusted. Coming on to question number 67. Once you look at the examples, once you are done with the examples, these are very easy, Nana. An entity enters into a contract with the customer for sale of tangible asset on 1st January for 10 lakhs. Okay. The contract includes a put option. You have to be careful. That gives the customer the right to sell the asset for 9 lakhs. Have to be careful. Okay, so the price is less. Repurchase price is less than the sale price. That's okay. On or before 31st December 20x1. The market price for such goods is expected to be 7,50,000. How would the entity account for this transaction? Very simple. You need to see whether that guy will exercise or not. If he exercises, because the repurchase price is less than the initial agreeable price, obviously it will be considered as a leasing arrangement, right? Then you'll have a deposit liability, bank account to deposit liability. Then deposit liability will be reduced to lease payment, and then deposit liability will be debited to bank. That's what your entry will be, right? Everybody, right? But in case if he lapses, then it will be sale with right to return. So initially you'll be recognizing that as a refund liability, and eventually what you'll have, that liability will be debited and revenue will be recognized once the option lapses. That's the usual concept that we have learned. Look at the answer here. In the above case where the entity has an obligation to buy back. Why entity has got an obligation? Because the put option is in the hands of the customer. So if SK Limited has got right to sell, the option is right to sell, then PK Limited has got obligation to buy. the obligation to buy back the goods up to certain date. The entity shall evaluate if the customer has significant economic incentive to return the goods, which means if he will exercise the option or not. The meaning of this sentence is, what do you mean by evaluating if the customer has got economic incentive to return the goods? Because customer will exercise the option only when he has an incentive to return the goods. The logic is very simple. If there is no economic incentive, why would you exercise the option? You'll exercise the option only when it benefits you. Option benefiting you is nothing but economic incentive for you. So evaluating whether your customer has got economic incentive or not is nothing but you are thinking whether the option is exercisable or not. If it is exercisable, then your treatment will be either financing arrangement or lease arrangement, as the case may be. In this case, it will be a lease arrangement. Okay, because the repurchase price is less. If he is not going to return, then it will be sales with right to return. You will recognize the revenue, debit the liability. Since the repurchase price is significantly higher than the market price, therefore, customer has significant economic incentive to return the goods. So in this case, he is going to return the goods. Why? Because customer returning means you will be paying money to the customer. How much you are paying money to the customer? 9 lakhs. Whereas in the market, the value is only 7,50,000. So therefore, customer will have a benefit of 1.5 lakhs. So therefore, definitely he will return. If he is return, then definitely you have to get it back. If you are going to get it back, in the sense you have to buy it back, then you are buying it back at 9 lakhs, which is less than 10 lakhs, at which you have sold initially. Therefore, it's a leasing arrangement. That entries you will pass, leasing arrangement entries. Therefore, company determines the control of the goods is not transferred till the put option exercises. Against payment of 10 lakhs, bank account debit, the customer only has got right to use the asset and put it back to the entity. Therefore, it will be accounted as a lease transaction. Got it? Difference between 10 lakhs and 9 lakhs will be recognized as lease rent, lease income. Get the point? So, at the end of the repurchase term, the customer does not exercise such right, then the control of goods will be passed to the customer. In that case, you can recognize the sale of goods. But anyway, that will not happen. So why did he give you this sentence? Doesn't make any sense. Because it was clearly given in the question that he has got economic incentive. So therefore, customer will exercise for sure. Where is the question of customer not exercising? Because customer has the option to sell it at 9 lakhs when the value in the external market is only 7,50,000. So customer will exercise the option for sure. Therefore, it is a lease arrangement for sure. That's all. Lease arrangement regarding entries only you will pass. There ends the matter. This sentence itself is irrelevant. See, that's what your I say answer. Sometimes it will be like this. We can't do anything. See? Is that clear? Everybody? Hello. Fantastic. Let's continue. We have 6 and 6 and 67 is also. Chalo, let's move on. Come to the next one, Nana. Service concession arrangements. Important, Nana. Mark it as important. Very good concept. Right, Nana. Let's continue. Now, mark this as important because there's a lot of confusion going on with respect to understanding the service concession arrangement. Okay. As I told you, there are certain rare case scenarios in the subject where even faculties themselves, they don't get the clarity, unfortunately, because of the depth and stuff. There are a lot of other things going on. So this is one such area. Okay. I'll tell you when the time comes where the issue is there. Therefore, I want you guys to focus. Okay. Guys are ready? Nana. All right. Now, okay, before we start with this, first of all, let's go with this example. Okay, before that, let's start with this one. Then we'll go for the example. See, first of all, let's try to understand what do you mean by this service concession arrangement? So basically, it is contract between two people. Who are they? One is the operator, and the other one is grantor. So basically, operator is the company or the entity. Grantor is the customer. Okay. Why he is called as a grantor? Typically, it will be the government because he grants the right. Sometimes he grants the revenue. Now, this operator constructs or upgrades an infrastructure that will be used to provide a public service on behalf of the grantor. Basically, grantor is the customer. Okay, right. The name used is as grantor because the logic is that he grants the license. That's the reason. Collect the toll and stuff like that. Anyways, the examples are national highways, bridges, tunnels, airports, public transport, or anything that is of public interest, public use. Okay. So typically, the best example you can understand is highways, national highways. Okay, where the entity or the operator constructs the highway and then the grantor typically grants the license, collect the toll. Got it? Sometimes they will also give money as well, especially when it comes to state highways. Okay, state highways, generally what happens is that they'll not, state governments will not be interested to collect toll. Probably what they'll do is that they'll just pay the payment right away. Okay, and the road will be free for the public to use, because that money is already indirectly collected through your road tax. When you buy a car or a bike, all the money that you pay in road tax na, is in lakhs, eventually goes to the state government, and the state government has to logically use that to build the state highways, which should be eventually free of cost. And the national highways are constructed by the National Highway Authority of India, where anybody who wants to reach the destination at a higher pace, at the higher speed, and wants to move fast, you can use the national highways and eventually pay the toll and then move on. So it should be like a choice. But unfortunately, in our country, what happens is that because anyway, national highway is constructing roads, and people are ready to pay the toll, and they don't question. Most of the state governments, they are not spending money on state highways. Once the national highway comes into picture, they are just diverting that money for all the freebies and toll. Okay, typically that's what is happening in our country. Anyways, having said that, now see here. This basic idea you've understood. What do you mean by service concession arrangements? It's between a company, an entity, okay, who is the operator, and the other guy is the government, who is basically a grantor. Clear? Right. And it involves, yeah, construction of anything that is basically used by the public. Okay. The operator builds and operates the infrastructure. It can be highways, bridges, tunnels, or airports for a specified time, and in return receives either a fixed payment from the government in case of state highways, or right to charge the public, that is toll collection, in case of national highway. Usually that's how it happens. There is an important point that you have to note here. That is the reason I've highlighted this. The infrastructure under such arrangements is not recognized as PPE by the operator. Very, very, very important. Because you don't have the right over the asset. Your job is to just construct it and hand it over to the grantor, that is the government. Because since it doesn't control the asset, the government does, the grantor does. Therefore, you cannot recognize that as an asset. Keep that in mind. Instead, the operator recognizes it either as a financial asset or intangible asset. Sir, what is this, sir? You will understand. We're going to learn this only. Right now, you will not understand this. Keep it as a question mark in your mind. No worries. Now we're going to understand that. Okay. Right. I gave an example over here. An entity builds highway for National Highway Authority of India and agrees to operate it for 15 years. So it means you need to maintain it as well. During that period, the company can either get a fixed payment from the government or right to collect tolls. Mostly it will be right to collect tolls. Okay. Chalo. Accounting treatment differs in each case. That we're going to see right now. So first we will see fixed payment scenario. That's what we have seen. Na? Financial asset and intangible asset. Financial asset in case of fixed payment. Intangible asset in case of right to collect tolls. Financial asset in case of fixed payment. Intangible asset in case of right to collect tolls. That we will be seeing now. Okay, chalo. Let's start with the first example. I want you guys to focus 100% over here. So this will be a little bit, will sting you a bit. Okay. I want you guys to focus. Ready? Okay. Fantastic. Now, okay, Nana. So we have two parties. We already know. One is the entity. The other one is the government. Entity is referred as operator or contractor. Government is referred as a grantor. This we already know. Okay. Now in this example, let us take construction of national highway. Obviously, right? That's the easiest example to understand. Now in this example, let's say construction period is for 3 years. So 3 years you'll construct the road. Fine. Total expenses estimated to be incurred is 200 crores. Fine. For a period of 3 years, obviously, because you're going to finish off the construction in 3 years. Fair value of the construction services is 220 crores. Why do we need fair value? Because Ind AS 115 specifically says once you construct something, you have to recognize that at a fair value, not at the cost that you have incurred. But the point that we will see now. That's why fair value information is also important. Revenue related to the services during operation time is 60 crores, and that will be for 7 years period, and that will be paid by the government. Financial revenue, that is nothing but interest for late payment, because it is government or the grantor. Never you will get your money on time, so therefore always they will delay. So once they delay, they'll also have to pay you interest payment. Okay, so therefore that is also there. Okay, so total cash flow generated by the government is 300 crore, which means it has to be paid to the entity eventually after 10 years. 3 years for construction, 7 years for maintenance. Clear? Which means you will be operating. So this total 10 years will be divided into two phases. Phase 1 is construction phase, 3 years. Phase 2 is operation phase, 7 years. Is this clear? Yeah, this entire 10 years is divided into two phases. This is construction phase, this is operating phase. Clear? Right, fantastic. Now, We need to always focus on accounting aspect as per 115 in the books of the entity. Have nothing to do with the government or the grantor. So who is important for us? Operator, constructor, contractor, or the entity, whichever name you want to call, you can call. Usually we'll call him as operator. Okay. Now let's look at the books of the operator. In this case, it is PK Limited. Obviously, that's the example that I've taken. Right now, see here. I told you that it has been divided into two phases. The entire period of 10 years. First 3 years construction phase. Operation phases next 7 years. All right. Are we done with this? Okay. Now concentrate carefully. Here, because you are getting a fixed payment from the government, that is this one, you'll not get the payment immediately, but you know that you'll get the payment for sure. So which means you have a right to collect, money. The right to collect money satisfies, or right to receive money satisfies the definition of financial asset. Therefore, recognize financial asset. Two, for what you are getting money, because you have constructed a road, and that is a service that you have provided, and the transfer of service did happen, and as a result you have to recognize your revenue, and that revenue is nothing but 220 crore, and that revenue, construction revenue, has to be recognized at fair value. Clear? Fantastic. Next, of course, you have incurred cost, so therefore debit the expenditure, and when you have incurred the expenditure, obviously money will go out from the bank, therefore to bank. So there are two entries. One is recognition of revenue, the other one is expenditure recognition. Revenue recognition, expenditure recognition. Two things only, Nana. Revenue recognition means usually what we'll do, bank account debit to revenue. That's what we will do. But here we can't do that because we are about to receive money from the government in future. Right now we are not getting anything. Therefore, in the place of bank, you're writing financial asset, as simple as that. Right to receive money, right to receive cash, as simple as that. To revenue, which is should be recognized at fair value. And then for expenditure, you will be incurring another entry. That's simple only, na? Expenditure to bank. That's all. Construction cost to bank, as simple as that. This will happen in first 3 years. This is not yearly entries. Please try to understand. That is the reason I've specifically put a flower bracket over here and I've written 3 years. Got it? Don't arrive at a conclusion that these entries belong to a particular year. No. These entries are for all the 3 years put together. For all the 3 years put together. Clear? During construction phase. So these entries relate to construction phase in totality. Clear? Fantastic. After that, coming on to operation phase for the next 7 years, what will happen? Obviously, you have to get further revenue of 60 crores because that's what government has guaranteed for you, that I'll be paying you this much. So recognize that as well. Okay. So that is revenue. Again, you're not getting money, so therefore it will be a financial asset. You're not getting money. If you've got money already, then bank account will be debited. You're about to get money in future, therefore right to receive money. Therefore, we'll call it as a financial asset. Financial asset to revenue, and you'll get it for sure. That's why it is referred as financial asset. Then because you are getting the money late, this money also you did not get as of now. This money also you did not get as of now. So on everything, you have to put the interest as well. That will also be given in the question. So therefore, interest should increase your financial asset, the amount that you need to receive. Therefore, again, debit financial asset to the extent of interest and recognize interest income. It's income only for you. Government has to pay to you. We are doing in operators books, PK Limited's books. So obviously, it's an interest income. Who has to pay interest to whom? Government or grantor has to pay interest to the entity. That entry is also there. And here also, please try to understand this revenue recognition will happen over a period of 7 years, and that interest income is recognized over a period of 10 years. And finally, after 10 years, you'll get the payment from the government. Once you get the payment, obviously, debit the bank account, and whatever the asset that you have created, where right to receive the money, that asset has to be cancelled out because you have got money. This is the entire journey. Now, there might be a little bit of doubt in your mind, but let me tell you, don't get confused. Just understand the flow. Total, there are 10 years, but here the concept is the government is going to pay the money after 10 years. First point. Till that time, you have a right to receive money because government has guaranteed giving you money. There's no question of bad debt over here because it's government. So therefore, you'll recognize financial asset. So during the construction phase, you have constructed by spending 200 CR. So once you have spent 200 CR, for that, what is the entry? Very simple, expenditure. So construction cost to bank 200 CR, done and dusted. Now the fair value of that 200 CR is 220 CR. Okay, and it should be seen as a separate performance obligation because you have already done the job. You have done the construction of road and you have transferred it. You understand the point? So therefore, that job is done. So to that extent, you have to recognize the revenue. Got it? Now the revenue recognition will be what, Nana? Eventually, to revenue, obviously, at the fair value of the construction, which is 20 CR. And if you got the money, you'll be debiting the bank account, but you have not got the money. Therefore, right to receive the money, financial asset. Now you go to the operating phase. That is 3 years is done and dusted. Go to the operating phase. Now in operating phase, first thing is you have to receive further 60 crore to recognize that revenue. And because you are not getting the money, debit the financial asset. So financial asset to revenue, 60 CR. And after that, because the money is getting delayed right from the beginning, for that there will be an interest, and that is an interest income that will also increase your financial asset. So financial asset debit to interest income. In this case, it is 20 CR. Now you know that in totality, 220 plus 60, 280 plus interest 20, totally 300 you need to receive. Financial asset is showing 300. And now you'll be getting that 300 CR from the government. So therefore bank account debit because you've got the money. And now the financial asset is no more required because you've already got the money. Therefore to financial asset, it will be cancelled out and done and dusted. This is the entire flow. Yeah. Right. This is rather simple. So this should not be confusing for you when there is a fixed payment given by the government. So that's what I'm telling you. Receives fixed payment from the government. In that case, you will create a financial asset. So these two are connected. Getting fixed payments from the government, and it will be recognized as a financial asset at that particular point of time because you have got a commitment from the government now that you will be receiving money, right to receive money. Got it? That's a financial asset. Now, this is tad bit easy only. See here. If the entity has right to receive fixed amount of cash from government, in this case, the operator's right is contractually enforceable cash flows from the grantor, which is treated as financial asset as per Ind AS 109. Here, the operator recognizes finance income over period because the payment is getting delayed. During construction phase, record revenue for construction services at fair value. So therefore, financial asset to revenue. How much? 220 CR. That is the fair value in our example. Then you have incurred cost. For that, you need to record construction cost to bank, which is 200 CR in our example. Clear? Next. During operation phase, record interest. That is unwinding of discount on financial asset. So you need to record interest, means that will increase your financial asset, obviously. So financial asset debit to interest income. Then record revenue for operation services as well, because you're going to maintain the road for another 7 years. For that also government has to pay you money, which is 60 crores in our example. That will also increase your right to receive money, right? So therefore financial asset debit to revenue. That is also part and parcel of revenue only because you're giving service. Earlier you have done construction service. Now you are done, now you are doing maintenance service. Earlier you have done construction service. For that you have to receive 220 CR. Now you're doing maintenance service. For that you need to receive 60 CR. And logically speaking, both these two put together for both different services, different POs, you need to ultimately get 280 CR. But you are getting it delayed. Therefore, interest also is added to the extent of 20 CR. Totally, you got to receive 300 CR for two different phases: construction phase, operation phase, for two different services: construction service and maintenance service. Both are not same. Please try to understand. Clear? And finally, record cash received, bank account to financial asset. So the operator is acting like a lender. That is a logic over here. Lender, building an asset and recovering the investment via fixed payments plus interest from the government. So the point, just like a lender. Clear? Right, fantastic. Now, are we done with this? Now, let's move on to another example. This is where things get interesting, so I want you guys to focus. Till here it's clear. Okay, chalo. Now this example, I want you guys to focus. This is an example where government will not be giving you fixed payment. Instead, it will be giving you a right to collect toll for a period of time, 7 years or 10 years or 15 years, as the case may be. So in this case, how are we going to do accounting? Now this is very interesting, so I want you guys to focus. Ready? Okay, now see here. In this case, it's the same example only, okay? Government is the grantor and PK Limited is the construction company, which you can obviously refer as operator or contractor. And it's the same construction of name. And data is also same. Construction period 3 years. Total expenditure estimated to be incurred is 200 CR. Fair value of the construction services is 20 CR. That entire construction phase will be for 3 years. And however, here there is no fixed payment from the government, that is 300 crores. What the government is saying, 300 crores worth money you can collect via toll from the users who are using the highway. And that will be allowed to be collected for a period of 7 years. After that, you will mostly what will happen, you will hand over the entire property to the government. That's why this is not your property. Therefore, we will not record it as PP. That in mind. That I've already given you clarity. Clear? Here, look at the interesting part. Government will not pay, but will give construction company right to operate toll for 7 years. Now, right to operate toll for 7 years is nothing but an intangible right. So you have to recognize that as an intangible asset. So therefore, treat it as intangible asset. instead of financial asset. Obviously, financial asset means right to receive money. Here that's not the case. You have a right to right to collect toll, and that's kind of a license. Therefore it's an intangible asset. Clear? Now you'll have legal documents and all that stuff, obviously. So it satisfies the definition of intangible asset. It is identifiable and you also have a right. Okay. Now let's see how the entries will work when it comes to books of what? PK Limited. First 3 years during construction phase, what happens is that you have to recognize your revenue. In the last case, you are done and dusted with your construction services. So therefore, one service is done. Once it is done, you have to recognize revenue as per Ind AS 115. In last case, you are not getting money, but you have a right to receive money. Therefore, you used to debit financial asset. Now, in this case, you have to recognize your revenue, but you are not getting consideration in the form of monetary compensation. Instead, you are getting non-cash consideration. This is where many people forget to understand the depth of the concept over here. Are you able to understand? So people, sir, to revenue you have written, sir, you're recognizing revenue. On behalf of the revenue, you should get something, na? Then only we call it as revenue means what? Sales. Sales means what? You sold something, which means you should have received money. That's obvious. Which means consideration should be there. In the first case scenario, when there is a fixed payment on behalf of the government, do we have consideration? Yes. Government promised to pay you 300 crores. Only thing is that it will take time to pay you. So therefore, I know that in future he's going to pay me money. Therefore, I'm recognizing that as a financial asset. So this is your consideration. So it's clear. There is no confusion. Whereas in this case, where is the consideration, Bapre? The consideration is nothing but the non-cash consideration kind of have asset in the form of consideration. So therefore recognize intangible asset to revenue. Obviously revenue. Construction should be recognized at fair value. That will be your revenue. Clear? Construction cost entry obviously will come. Construction cost to bank. There is no difference in that. This is what happens during the construction phase. Fantastic. Now remember, this is one PO where construction services is done and dusted. Done and dusted. Now come to operation phase. Here maintenance services is what you are providing. At the same time, you are collecting the toll. Okay. So therefore, what you will do, first of all, you already have an asset. Asset is nothing but intangible asset means what? Why it is valued at 220 CR? Because you get that much of benefits in the future because of that intangible asset. So therefore, asset always has to be depreciated. Because it is intangible asset, depreciation will be referred as amortization. Therefore, amortize it based on straight line method. That's all. So now you are using the right which was created earlier. Right means right to collect toll. So therefore, you have to amortize that. So do it for next 7 years. That is the entry over here. In other words, depreciation of the asset, Nana. That's all. Simple. Okay. At the same time, you are collecting toll, which is nothing but toll revenue, toll revenue, toll revenue, and therefore you are getting money. Therefore, debit the bank account. Now the point is, people tend to get confused between these two revenues. Look at one doubt from the student. Do not get confused that revenue is booked twice. That was one doubt from the student. Sir, are we booking revenue twice here? No. That's why I've written, do not get confused that the revenue is booked twice. It is not booked twice over here. Okay. Another student doubt is, this student in the chat box, he was trying to clarify the doubt of student 1. He was saying that no. Revenue is not booked twice. If you observe, revenue booked for receiving intangible asset, that is fair value of consideration, is getting reversed later through amortization here. Whatever you booked here, 220 CR, is getting reversed now, because as you can see here, 220 CR is created, here it is getting debited. Sorry, ITA is created, ITA is getting created over here, it's getting reversed. So eventually this is your actual revenue, was the answer of another student. And honestly speaking, there are certain videos that was shared by some of my students, and I've gone through certain faculties as well. Sorry to say, they were also going with the same logic. But in reality, is it true? That is the correct way of interpretation of what is happening over here, the form of two revenues that you see here? The answer is not. It's different. So for that, I need to dig deeper. So therefore, I want you guys to stay with me. This will take a little bit of time, because otherwise you will never understand this. You have to by heart. And you know, both of us know that neither I nor you like by hearting. So let's go through the logic. Now, to understand this, only the second case where government gives you right to collect toll. Okay. Step by step we'll go. So I want you guys to focus. Okay. First of all, revenue is being recognized . twice? The answer is no. Revenue is not getting recognized twice. Clear? How, sir? We'll see. See, you are actually have to write along with me. That's the reason I'm also writing over here. Got it? Write along with me. You're recognizing revenue for two different services. This is what I'm trying to explain right from the and different. All right, Nana. Two different customers and two different times. Are you able to understand what I'm trying to tell you? Sir, Fit sir, you are two different customers. What sir nonsense you are talking? One by one, I'll come. First, what did I say? Two different services. Construction service. Two different customers. Government customer. Government is the customer. Two different times. First 3 years. Sorry. All right, Nana. This one is clear. Look at the other example. Now, numbers and all those things we'll see different, okay? Right? That we'll see different. Other one is, okay. Maintenance service. Customer is what? Toll users. Not right, toll. Road user. Next 7 years. This clarity is there for you. If you can get clarity over here, rest of my explanation will be very easy. Clear? So two different services, two different customers, two different timelines. Not get confused over here. Question of two revenues. It's not the same revenue. That's what you need to understand. The totality, you have to see them from different perspectives. Construction phase is different. Operating phases. Clear? ये तो clear है. Now, let's try. Here's 115. Now tell me one thing. Ind AS 115 talks about revenue recognition. When you'll recognize revenue? When who is satisfied. Any doubts in this? Clear? When PO is satisfied? When transfer of control. ये तो clear है. This is Holy Trinity. I've told you so many times. Let's start with first PO. Because I told you there are two PO over here. What is first PO? First performance obligation. Construction service. Who is the customer in this case for construction service? Government. You can also refer him as grantor. Correct? So when this PO is satisfied, because only if it is satisfied you can recognize revenue, na? Correct? Over time, not at a point of time. Okay, what is the consideration in this case? Consideration. For construction service, what is the consideration? Tangible asset. Very good. Till here it's clear. Any confusion? No. Very easy to understand. So here some people are having doubt. Please try to understand. Yes, sir. Clarification. Are you guys writing along with me? Remember, Ind AS 115 does not say revenue is recognized only when cash is received. We discussed this point so far? No. There is no rule in Ind AS 115 that you have to recognize revenue only when cash is received. Non-cash consideration is accepted. In fact, we have gone through concept with a heading called non-cash consideration. How can you forget that? So consideration always need not be cash. Okay. So there is no link between revenue recognition and getting a cash. What does Ind AS say? Revenue recognition will happen when PO is satisfied. When will PO be satisfied? When transfer of control happens. Transfer of control of what? Goods or services. I'll write here of goods or services. This is the concept that we have learned. If it is non-cash consideration means we'll measure it at fair value. As simple as that. That's what we have done. Therefore, ये तो clear है. Therefore, during construction or during construction phase, okay, you will recognize revenue because this is a different PO, performance obligation, and the transfer of control when it happens, obviously, to revenue at fair value, which is nothing but 220 CR. And what you'll be debiting, it's a non-cash consideration in the form of intangible asset. So intangible asset debit, in our example, it is 220 CR. So what is the meaning of this? What is meaning of this entry? I'm trying to open banana, put in mouth, in the sense, it's a Telugu saying where we try to, explain things in a very, very, very simpler way, simpler fashion. I don't know whether people can understand that or not who are watching in other languages, but anyways. Right, now the point is, this actually means I have completed, okay, construction services worth 220 crore for the government, because the customer is government, na? And in exchange, what did I get? I have earned ITA, non-cash consideration, which is intangible asset. That is kind of economic, right? So the revenue is final and it is complete. It is not provisional. That's all. Recognized, done and dusted. Because my job is done. Are you able to understand? The moment you are done with your construction, then the consideration is in the form of intangible asset. So you are recognizing intangible asset means this PO is satisfied already and you have got it. Clear? Okay. Now, so ये तो clear है? First PO. Let's go to second PO. Now tell me, what is second PO? You people tell me now. Very good. Operating the road. Or correct? We'll go in the same flow. So first PO is construction service. Now, who is the customer in this case? Will tell me. Public. You can also call them as road users, not the government. Please try to understand this. Okay. What service are you providing? Access roads or highway. Okay. Or you can also call them as roads. Are you able to get it now? Should be very clear for you, right? When PO is satisfied, that is also important question. Because only when PO is satisfied, we can recognize the revenue. Right? At the point of usage. Okay. What is point of usage, sir? Each vehicle passage. Once the vehicle passage is done, respective PO is satisfied. Clear? What is consideration in this case? For each vehicle passage, when the PO is satisfied, okay, you will be recognizing your revenue, and that revenue is nothing but cash toll collected. Now you are not collecting cash, so therefore I can simply call it as toll collected. So therefore what you will do, you will pass the entry for toll collection, which is cash or bank account debit to toll revenue, because here you are getting revenue for the operating services, right? How much is that? 300 CR. To that extent you can collect. So what is the meaning of this entry? The meaning of this is I've completed construction services worth 220 CR for the government, and in exchange I've received the non-cash consideration, which is intangible asset. Here what is the situation? I am now providing road stage services, and users are nothing but my customers paying me for that service. Simple. And that whatever they are paying me is considered as revenue. This has got nothing to do with construction. Please try to understand. This revenue has nothing to do with construction. Clear? Now the next question is, then why do we amortize the intangible asset? Very simple, matching principle. Na? This is not revenue reversal. That is where the problem comes. I'll write that question also. Then why do we amortize, okay, intangible asset? Answer, matching principle. Forget all these basics of accounting. This is not revenue reversal, which many people are understanding the wrong way. This is not revenue reversal. Clear, right? It's just matching principle. Intangible asset is consumed as the road is used. That's all. Each year, part of the right is exhausted. Therefore, you are trying to amortize it. That's all. So I'll write that as well. Why amortization? See, Nana, why do you depreciate your asset? Because your asset is getting used. So each year, the value of the asset goes down. Therefore, you are representing that in the form of depreciation. Simple. Amortization also is for intangible asset is the same. Na? Each year you're using the asset, the value of the right to collect keeps on going down. Therefore, to that extent, asset value has to be reduced. Na? Simple logic, na? Simple logic. Get it? The intangible asset is consumed as the road is used. Simple. So each year that passes by, what happens? The right to collect toll or intangible asset value is getting reduced. So now this is what is happening. That has to be accounted, na? And that is what you are accounting it by way of amortization of intangible asset. Simple. So therefore, what will be the entry? Amortization expense to intangible asset. I'm consuming my right to charge users as I operate the road. As simple as that. Therefore, this is not like reversing your construction revenue. It recognizes the cost of using the right. That's all. Am I clear? Right. I hope this is. That is the reason. Don't arrive at a conclusion that you're recognizing revenue. Booked revenue is booked twice, or you're reversing the initially booked construction revenue. No, both are two different POs. Okay. I'll put an into over here. I'll put an into over here. Wrong. Wrong. So we took a lot of time to explain you the whole thing. I hope this is clear. And you guys have written along with me. You'll not get clarity anywhere in the ICA book. All these things will not be there. Please try to understand. Okay. People tend to get confused. This is the real clarity of what's happening. What? Clear? Done, understood? Right. So with this, we'll wind up the session right now. In the next session, I think we are done with the concepts. One problem, I think so. Yeah, 75 problem is, okay. That problem we'll try to finish. Okay, that we'll do it in the next session. I want you guys to revise this and come. Revise this concept, and then I gave you the logics over here. Na? This logic also try to revise. Clear? Right. Is license of intellectual property. Okay. So here we have first a basic idea. Then after that, you have right to access intellectual property. We have an example for that. Then right to use intellectual property. We have an example over here. Then we'll do two sums, in which one question is really good. Chalo. Let's start learning this concept. Chalo, Nana, first we'll start with first example so that we'll be able to understand this. But before that, just a basic idea. What do you mean by intellectual property? So it's simply you're getting license. Okay, you're getting license to use something. For example, it can be software, it can be technology, it can be media or entertainment content, movies, music, and all that. Franchisee, patents, trademarks, copyrights. So basically, you are getting a right to use them. As simple as that. That's what we call license, and that represents licenses generally will be taken for intellectual properties. Now, the only thing that you have to understand from accounting point of view is the license can be of two types, either right to access or right to use. Now, when it comes to right to access intellectual property, I have written here over time. Right to use intellectual property, I have written here point in time. I was indirectly talking about revenue recognition. So when the license is in the form of right to access, the license of intellectual property, then you will recognize revenue over time. When the license of right to use the intellectual property is the is a right to use, then in that case your revenue has to be recognized at a point of time. So this is a final answer actually, but you will not understand anything right now. So therefore what we are going to do is that we're going to go through examples. Okay, let's start with the first example over here, case 1. Now what's happening? There is a music production company ABC. Okay, yeah, it grants license to streaming platform, okay, XYZ company to use its music library for 2 years starting from 1/4/X1. Now what you need to understand here is that whatever that is there in the music library as of now, plus in the next 2 years whatever that is going to get uploaded newly, plus any other changes, everything can be enjoyed by ABC. That's the point. Okay, sorry, everything can be enjoyed by XYZ because ABC is the company that actually is granting license to what? XYZ company. Got it? So ABC company regularly updates its music library by adding songs throughout 2 years. So this is where we use the term right to access. So this license provides access to dynamic content. Focus on the word dynamic. Dynamic means what? Exactly opposite to static. Static means when I provide you license at that particular point of time, let's say I've got 100 songs. So you have license to use those 100 songs. That's all. Sorry. Are you able to get me? That's all. Only those 100 songs you can use. That we call it as static. Dynamic means as of today, there are 100 songs. Tomorrow it can become 120, 130, 140. So whatever the new things that I'm going to upload it, that also you can enjoy. Therefore, the kind of license that I'm giving you is a dynamic license. So the content, and that changes over time. The content also changes over time. Probably new content will keep on getting uploaded. Maybe some of the old content will be removed as well. Either way, it will happen. Ultimately, change will happen. Now, this XYZ company was purchased the license, benefits from updates during the license period, obviously. ABC company has ongoing obligation to maintain and update for the 2 years for which you have actually sold your license. Okay, so therefore, this is a perfect example for right to access intellectual property over time, because the service that is being provided by ABC company to XYZ company is gonna be over a period of time. I've gave you 2 years license now, and the content that I've gave you is gonna be dynamic. So therefore, I have to keep on providing you the new content. Are you able to understand? Which means I have to keep on providing you the service over a period of time. So therefore, the transfer of control of services will happen over a period of time of 2 years. Therefore, PO will be satisfied over a period of time. Therefore, revenue has to be recognized over a period of time. Now, in this situation, we call this as right to access because you have right to access all the changes that's going to happen in next 2 years. So therefore, in this case, revenue will be recognized over time because the service keeps on changing, the service keeps on getting updated, and therefore the transfer of control over service happens over a period of time, and as a result, PO gets satisfied over a period of time, and as a result, revenue has to be recognized over a period of time. Simple. Now look at this case too, you will understand the difference. Same music company, ABC company, licensed an existing album with no updates or changes during the license period. Let's say there are 6 songs in that particular album. Only that album license I gave you, that's all. Nothing. These songs you can use. There ends the matter. The streaming company gets static copy of the album, no dynamic copy, which means the moment I gave license, my transfer of control is done. Transfer of control of service is done. Therefore, PO is satisfied. Therefore, revenue can be recognized on day 1 itself, the moment access is given. The moment license is given. You understand the point? So therefore, this we will call it as right to use. You should not use the word right to access. Why? Because there are going to be no future changes. Na? So whatever that is there, the static content, you can use it for 2 years. That's all. So therefore, you should use the word right to use. Here, that is not the case. I can't say whatever the content is there, you use it. No, because the content is going to change. Therefore, I will use the word right to access. Right to access. Are you able to understand? So therefore, in the case of right to use, because the content is static, There's going to be no changes whatsoever in future. Therefore, the moment I gave you the license, the transfer of control of service is done. Therefore, PO is satisfied at a point of time. Therefore, revenue also will be recognized at a point of time. That's it. So only to understand whether transfer of control of intellectual property is happening over a period of time or at a point of time only, we have seen these two examples. Got it? Now let's revise. See here. Licensing can grant either right to access intellectual property over time or right to use intellectual property at a point of time. The revenue recognition pattern depends upon which of these applies. Case 1, right to access. In right to access, what happens? If the license provides a right to access intellectual property as it exists and evolves over time, the revenue is also recorded over time, recognized over time. All these three criteria must be met to call it a right to access. What are the criteria? The entity is required or expected to perform activities that significantly affect the intellectual property. Like you need to update the entire platform, you need to maintain the entire platform. Then the license exposes the customer to the effects of these ongoing activities, receiving software updates and all those things. The entity ongoing activities are not separate performance obligations, they are part of the licensee's essence. So tomorrow you're going to add one more song. Can I call it a separate performance obligation? No. Tomorrow you're going to add one more feature. Can I call it a separate PO? No. Everything put together forms part and parcel of the license that has been given. That is why we are using the word dynamic. Dynamic means all the changes are also included. So whatever that is going to happen in the platform, you will have license for a period of 2 years. Therefore, tomorrow I'm going to do something. Tomorrow I'm going to add one song. Tomorrow I'm going to add one feature after 6 months. Then can I say that that service, transfer of control of that service has happened today itself? No, it's gonna happen over a period of time. After 2 months, I'll upload something new. After 3 months, I'll upload something new. After 5 months, I'll remove something that is existing. After 7 months or 8 months, I'll upload again something new. You understand the point? Just like Netflix. You subscribe to Netflix. Netflix keeps on changing things. Adds movies, removes, adds content, removes. So which means, is it dynamic or static? Dynamic. So from Netflix point of view, what is that? When we buy, we get the license to watch it, and tell me, is it right to access or right to use? Right to access. Right to access. Netflix is a prime example. Prime also, anything. All the platforms are ever changing. They're dynamic in nature. So say for example, you'll have a normal content and then it becomes 4K. It keeps on changing. New features keeps on coming. You understand the point? So it is right to access. The Netflix, what you're doing, all the subscription, pretty much right to access. Got it? Right to use means, say for example, let's say, suppose you are making a movie and you wanted to use songs from an old Ilayaraja Sir's movie, for example. I don't think everybody will understand what I'm trying to say right now. Those who can understand, if you know, you know. Okay. So therefore, you want to use the song and you know that obviously you have to get the license. So you go and get the license over there and you say that I'm going to use it for another 2 years for whatever the movies that I'm going to make. Now here, if you take license of that particular album of Ilayaraja Sir movie, right, then that is right to use, because now no change is going to happen. It is just static. So that will be regarded as right to use, and the moment Sir gives you license, you can recognize the revenue. Who can recognize the revenue? Sir can recognize the revenue at a point of time. Got the point? Chalo, I hope this is clear. Easy peasy. Everybody, right? Shall we go for solving sums now? Yes, 69 and 72. Now, question number. Okay, come to question number 69, everybody. An entity, a music record label, licenses to a customer 1975 recording of a classical symphony by a noted orchestra. So I think this is static. Let's see. The customer, a consumer products company, has the right to use the recorded symphony in all commercials, including television, radio, and online advertisements, for 2 years in country A. In exchange for providing the license, the entity receives fixed consideration of 50,000 per month. Per month. The contract does not include any other goods or services to be provided by the entity. The contract is non-cancelable. Determine how the revenue will be recognized. Actually, it's a very easy question. The moment you see right to use, you know that transfer of control did happen at the beginning itself. Therefore, PO is satisfied at the beginning itself. Therefore, you have to recognize the revenue at the beginning itself. But, he's gonna pay you 50,000 per month. So this will create some problem. Let's say he says 10 lakhs is paid at the beginning itself. 10 lakhs revenue will be recognized at the beginning itself, isn't it? You understand the point? So now tell me how to recognize. First, transfer of control is happening over a period of time or at a point of time? At a point of time only, because license is given for that particular symphony, which means PO is satisfied at a point of time. Yes. Okay. Which means, can I recognize the so-called revenue at the beginning itself? Yes. Then how much I need to recognize? That's the biggest question. How much? Now you people tell me. Tell me, Nana. Easy answer. Revenue recognized upfront at the beginning itself or over a period of time? At the beginning itself. Now the twist in this question, this also I've seen students doing mistake. You know what? They'll see this. They know the concept. They know that right to use means obviously it's going to be static, and as a result your transfer of control happens at the beginning itself at a point of time. So PO is satisfied at the beginning itself. Therefore revenue has to be recognized at the beginning itself. They have that clarity, but by the time they come to this particular sentence, they'll see, oh, you are paying 50,000 per month, which means we need to recognize revenue over a period of time. No, all the revenue will be recognized upfront. Total revenue will be recognized upfront. Monthly consideration means revenue over time. No, wrong. Somebody has given answer here also. Wrong. Total revenue will be recognized upfront. That's the answer. Clear? And remaining, you can just copy paste the entire concept of right to use. This you can copy paste. This sentence and all. That's enough. That will be your answer. Don't go through your IC answer. This is the answer. Total revenue has to be recognized upfront. Exactly. Clear? Are we done? Monthly payments is irrelevant, Nana. It has got nothing to do with things here. Your performance obligation is granting license, Nana. Is it granted? Yes. At a point of time, yes. The moment license is granted, you have to recognize the entire revenue. Clear? That we don't know, so you just write the sentence, total revenue has to be recognized upfront. That's all. Clear? So one student is asking, sir, that means 12 lakhs has to be recognized at the beginning itself, at the commencement. Yes. But your eyesight did not give you the answer, because if you look at the question, he has asked you how the revenue will be recognized. He did not ask you how much. So therefore, your eyesight did not mention the amount. But if you want amount, okay, 2 years into 50,000 per month, which means 12 lakhs. Will be recognized at the inception itself, at the commencement of the license itself, at the beginning itself, even though the real payment will happen over a period of time. So you will put it as receivables, that's all. Simple. Yeah. You understand the point? Clear? Shall we move on? Right. Moving on. The question carry. 72. Now come to question number 72, Nana. Question number 72. Ready? Okay. Sports team D enters, this is important and mark it as important. Okay. Sports team D enters into a 3-year agreement to license its team name and logo to apparel maker M. Okay. The license permits M to use the team name and logo on its products. Okay. Including display products and its advertising or marketing materials. Determine the nature of the license in the above case. Next. Modifying the above facts that sports team D has not played games in many years and the licensor is brand collector B, an entity that acquires IP such as old team or brand names and logos from defunct entities or those in financial distress. B's business model is to license the IP or obtain settlements from entities that use the IP without permission, without undertaking any ongoing activities to promote or support the IP. Very intelligent business plan, this fellow says. Would the answer be different in this situation? It's a good question. So now that you know that, there are only two types of intellectual property license. One is right to access, the other one is right to use. Right to access means the kind of access that you get is dynamic in nature. Therefore, the transfer of control of service will happen over a period of time. Therefore, PO will be satisfied over a period of time. Therefore, revenue has to be recognized over a period of time. The other one is right to use, where you will be given a static content and the content will never change. Therefore, at the beginning itself, at the inception of the licensing itself, you have to recognize the revenue because PO is satisfied at a point of time. Clear? This is what the concept that we know, but that needs to be applied over here, and that's going to be very interesting. So I want you guys to just read the question. I'll give you some 30 seconds. After that, I will solve it. I'll take time and then I'll solve it. We'll look at the facts of the question slowly, slowly, slowly. We'll start it. Only then this will sit here. Otherwise, this question is a little bit, yeah, it will sting. It will sting for sure. Right. Read the question. I'll wait for 30 seconds. After that, we'll start. All right, are we done with your reading? Okay. If you want my answer is very simple. Determine the nature of license in the above case. That is by reading these 3 lines. The answer is right to access. Right to access. Therefore, revenue will be recognized over a period of time. That's the answer for first part of the question. Second part we'll discuss later. Now, if I tell you something like this, can you understand? You can't understand anything. Sir, how, sir? Just by reading 3 lines, how are you able to come to that conclusion? I'm not able to understand. Then it means that we need to dig deeper. So let's start solving question number 72. Do along with me. Question number 72. Do along with me. Ready? So first we'll start with data from question, because based on that only, we need to analyze naturally. Let's start with data from the question. I want you guys to have question in front of you. What is there? Hardly it is 3 lines. You can easily remember also. Chalo, tell me. What's happening over here? You have sports team D. Yeah? Okay, this gives license. This fella gives license. Okay, what kind of license it is giving? Team logo and name. Like for example, let's say this is RCB. You can use that, okay, on apparel, okay, on display products. That's what now, advertising and marketing materials. A lot of people will buy, na? You understand the point? This is what is actually happening. And remember, the most important point is this team is active team. What do you mean by active team? It is playing. It's playing. Look at the wording. It is active because in the second case, he's saying that the same team has not played games in many years. Which means if you look at the first sentence, it enters into 3-year agreement to license its team name and logo to apparel maker M. The license permits M to use the team name and logo on its products, including display products and its advertising or marketing materials. Sir, here specifically nothing has been told the team is active. Yes, but you need to understand, use the smartness. Here, modifying the above facts. He's saying that this guy hasn't played anything. This team has not played any games in the many years, which means it automatically confirms the fact that here this team is playing games and it is active. This understanding is very important to arrive at the conclusion answer. Are you able to understand? So, even though here there is no clarity, but then by looking at this sentence where he starts with saying modifying the above facts, which means whatever the facts over here, for that this is opposite. And the opposite fact is this guy hasn't, this team has not played any games, which means here it has to play games. So therefore it is an active team. So if you can decode this, the problem is done. It's easy. If you are not able to decode this, then Maybe coincidentally your answer can be right, but you did not apply the concepts properly. Once I finish off the whole thing, you'll understand the depth of what I'm trying to say. Anyways, clear? Huh? Ready? Okay, now tell me one thing. What is the intellectual property over here? Team logo and name. This is the IP. Now the next question is, what is the value of this IP? It is dynamic. Why value of this intellectual property is dynamic? Because the value of IP depends on team performance, isn't it? Suppose during that time only this guy has won, RCB has won what? The IPL Cup. Don't you think that their value will increase? Exactly. More and more people will buy. The apparel, display products, advertising and marketing materials will work. So when this team is an active team, it continues playing games, field competitive teams and brand visibility will be there. So therefore, it will significantly affect the value of the team name and logo, which the so-called Maker M is using on its apparel. You understand the point? Apparel, right? Clear? Remember, one thing where students get confused is that these activities, which are done by the active team by playing games, do not transfer goods or services to Maker M. But it affects the usefulness and value of the intellectual property. The more and more these guys participate, the more and more they are active, the more and more they're performing really well, the more and more the perceived value of this intellectual property will increase. Now tell me, so more and more these guys are playing, more and more it will increase means what kind of intellectual property you have got? Is it right to access or right to use? It is right to access. Why? Because here itself I gave you clue, it is dynamic in nature. Therefore, the answer is right to access. Now, when I say right to access intellectual property, naturally you people will tell me what happens because of this. PO is satisfied. Over period of time, naturally. So which means what you have to do? PO is satisfied over a period of time. Then revenue is recognized. Correct. Revenue is recognized over period of time. Typically, it will be straight line basis, Nana, for 3 years. Normally on straight line basis, which means equally. Unless another pattern is given specifically in the question, otherwise it will be straight line basis. Did you arrive? See, this is what the thought process that went when I've read the question at the beginning itself. So I know that because in the second part of the question, he's saying that this particular team is not active and it is not playing games from many years, and he's using the word modified facts, which means obviously opposite should happen at the beginning of the question. That's the understanding. So therefore, the team has to be active. When the team is active, the more and more they perform, the kind of things that they do affects the perceived value of the intellectual property. So the intellectual property, if they have performed pretty bad, let's say 5 matches they have lost, then the perceived value of the intellectual property will fall. You understand the point? And then after that they starts winning, then again this will increase. As a result, the sales will increase. You understand the point? So therefore, it is dynamic in nature. Because depending upon in future what these guys will do, what kind of matches they'll play, how they'll perform, depending upon that, your value of the intellectual property keeps on fluctuating. So therefore, it is right to access because it is dynamic. The moment you see a situation where things are dynamic, you should use right to access. And therefore, the transfer of service will happen over a period of time because the performance will happen over a period of time. Therefore, performance obligation or performance satisfaction, PO is satisfied over a period of time. Therefore, revenue will be recognized over a period of time. In this case, it is 3 years. So over a period of 3 years, it will be recognized. Clear? Clear? Right. So this is the answer for first part of the question. Very interesting. That's why I said this problem is important. Now let's come to the second part of the question. I think some of you have already got the answer. Okay. So what's the situation? Sports team D. What's the situation? Has not played games. Inactive. Okay, and who is the licensor in this case? The one who has got the license. Brand collector B. In real life also, there's a guy like this who collects all the acquires old and defunct brand names. Classic Legends. I don't know whether you guys know or not. Classic Legends comes under Mahindra. These guys keeps on buying Java, SD. Are able to understand? BSA, all these old brands, defunct brands are being bought by these guys, and then they try to, relaunch them again. You can see that's why you go to Java showroom, you will find bikes with respect to all the three brands: SD, Java, as well as BSA. Right? So, anyways, in real life, Classic Legends is a perfect example. Like this guy, brand collector B. So, what this guy does acquires. If you look at the question, old or defunct brand names or logos. In this case, we need to understand that this sports team D comes under this category because they are not playing games. So, they are old or defunct and they have been bought by brand collector B. So, he gives the license now. Clear? Hello? Yes. So now this license is given to this Moku fellow, Maker M. Now tell me, because this team is inactive, are they going to perform anything? No. Because of that, when they are not performing, when they are not being seen outside, will that change the perceived value of the intellectual property that you have bought right now by Maker M? No. Are you able to understand? Direct marker. Maker. You got the point? So there is no ongoing activities. So that will not affect the form, functionality, value of the intellectual property and all those things, which means it is static. The perceived value of intellectual property in this case is static. Character, fixed existing brand name or logo. That's all. IP exists as it is. So customer benefit, customer is nothing but licensee, Maker M. Customer benefit is not dependent on future actions because there are no future actions. You understand the point? In that case, it will be referred as right to use. Right to use. So obviously, at a point of time. So what will be your answer? PO is satisfied at a point of time. When PO is satisfied at a point of time, what will be your revenue? Revenue is recognized when license is. Which means at the instant of contract. It's a very, very, very good question. So you can answer these kind of questions only if you're conceptually strong. Okay, so you need to understand, okay, fine. If these guys are not playing any games, then they are not going to do anything in future, which means whatever the value that you get today by getting the license, the value will remain exactly as it is. So nothing is going to change in future. It cannot increase, it cannot fall down. So therefore it becomes static. And as a result, it is right to use. And therefore, the moment the license is granted, immediately you can recognize the revenue because PO is satisfied at a point of time. Very, very, very beautiful question. These are all the kind of questions that actually needs to be asked at final level. Okay. But sometimes that's okay. Anyways, did I say it does not make these kind of questions nowadays? In IFRS, you will find these questions pretty well. Right? Are we done with this? Shall we move on? Right, that's it.